The world is evolving, and you're a different choice. It has always been ours. You can chase the trend or choose to trade with purpose. It's time to find the signal through the noise. We'll meet you at the beginning.
All right, let's get ready to rock. Today, welcome to the Tradier SIBO Summit. I'm your host, Lex. Today, we have a big day planned for you. Before we get going, we have a couple surprises. First, let me introduce my co-host on the brew, Molly Morris, who will be joining me to co-host this event today. Molly.
Hello. Good
What's
morning,
happening?
guys. How's it going? I'm excited.
Are you going to match my shirt changes the whole way?
We're totally going to coordinate, Lex. We're going to coordinate this.
All right, good. Well, we're going to get rolling. We got a big day. We got to stay on schedule. So, one last minute change. Our 1 p.m. slot with Marcus has been changed to his business partner, Mark Hodge. Unfortunately, Marcus had a unexpected conflict arise last night, so he could not be with us. So we're sorry for that. But Mark is awesome. I've been with him before on presentations. He's terrific. Here's what to expect. Easy rules. It's a long day. First of all, we will have a break. We absolutely encourage questions and comments. As always, let's keep it PG, be respectful. You know the rules there. Each presenter will spend about 40-ish minutes on his or her presentation and topic. Then Molly and I will come back in for a little Q&A. That's a good time for you to hit the comment section with your questions. We will star questions that we can bring. We only have about 5 minutes for questions because we have to keep rolling, okay? And for the first time, we are providing the Kahoot quiz at the break. It's a 10-question contest. There are prizes, first, second, third. We'll talk about that in a little bit because we want to get going. But you will need a smartphone to scan a QR code on the screen to play. It's measured on accuracy and speed. So get your thinking caps on for that one. So, Mal, you ready? We're going to get on with this, right?
And by the way, do not get fired out there. I know this is going to be a fun day, but you can replay this later. So make sure you tend to business.
You got it. All right, let's get to it. First up, the Tradier CEO and co-founder, a great friend of mine, my boss, Mr. Dan Raju, is going to come on and give us the welcome address and the keynote address. So let's get rolling, Mal. Here we go.
Hey, Lex, how are you?
Good
day. Hey, Lex, how do I share my screen? So let me get how this just there you go. That's the present button. I see it here. I'm all ready to go. Computer. Lex, can you help me share my screen if you don't mind? 1 second. Present slides. Give me 1 second.
Yeah. Dan, can you hear me?
Yes, I can.
Yeah, okay. Just hit that present button, pick the screen you want to share, and then choose window or files and hit share.
Can I just give me 1 second? So,
Yep.
So if I say present, it says slides.
Yep. Find those, click them.
Your computer, upload file. All right. Give me 1 second.
All right. The technical difficulties of live trading, of live studio.
Okay. All files. Okay.
All right. Bear with us. Dan will get this up here in a second.
All right, Lex, can I send it to you if you don't mind?
Sure.
All right, I'm just going to. Hey guys, so sorry about the difficulties. I'm just going to send it off to Lex so he can actually get it up and running. Anyway, thanks so much for coming. I really appreciate it. Sorry about the technical difficulties. From the very beginning, right? wanted to it up and running because that's what our customers have always asked us to do. So, the mission for Tradier has always been, then we were basically trying to create the right concoction of education, platform choices, and price to focus on the active trader. And that has been our mission since day one. So today what I'm going to do, and Lex, let me know when you get the slides up and running, if you got it. What I'm going to do is I'm going to talk about those three main things. First of all, let's talk about why we are doing these summits. See, what we have found over the years is the fact that the traditional trader, the trader who comes into the market for the first time, is different than a graduated investor who comes in, who's been in the market for a long time, thinks differently, engages differently, and most importantly, he actually goes ahead and operates differently. And so for that reason, we felt like the active traders needed a special attention. They needed better platform choices. They needed better education. They needed to have a community around it. They wanted to have great content. And most importantly is that we wanted to make sure they have got great service and value. So with that was kind of the intention. And for that reason, we wanted to put a show together that kind of delivers strategies, education, tools, and engage them in a very productive way. And that has been the reason why we launched the hub. We launched the hub with few shows. Today we are doing 15 live shows a week. We have about 7 to 8 summits that occur. We have literally tens of thousands of people who attend these. But the reason they do it is because it is purely done with the simple intention of providing great education. And so that's kind of the heart of what we do, right? And I want to talk about a few things that we are currently seeing in the market. Number one is I want to talk about what we are seeing on the ground as it pertains to the retail options trader. You see, at an average, right, what we see in 2024 is there's an average daily contract volume of 46 million contracts in 2024. But if you take a look at this contract volume, I'm talking about the overall market. If you take a look at this contract volume, it has grown during the 2021-22 timeframe at almost 50%. But we see it right now more in 2024. The rate of growth is more around 10%. So you certainly see what I call as a little amount of what we call as, slowing down of the rate of growth. I mean, 50% growth is almost like unsustainable anyway. So I think this one basically provides us that this one basically kind of self-explanatory in the sense that we are still seeing growth, but certainly not growth at the rate that we used to see before. One interesting thing, but on the Tradier side, right, on the Tradier side, because our cohort of customers is extremely active trading and option centric, we see about a 42% growth in options volume in 2024. And we had seen almost a 75% growth in the year 21-22. So certainly more concentrated because of our customer base. But what is absolutely clear is that retail options continues to basically have great adoption, number one. And if you think about why the options market has been growing, and we have spent quite some time thinking about this. It's largely driven by there is a graduation effect in the market, guys. Folks who have come in during the pandemic have got educated, active, hyper news sensitive, and a hyper social market during the pandemic, and they now continue to engage in the market. And now they have graduated from those experiences and are looking for better experiences. And the reason and you see that in the market, tremendous amount of tools, and a lot of them use our API who come and build amazing platforms for the retail investor. And so we see that tremendous amount of growth basically occurring. Lex, if you can go to the next slide, slide number 3, next one. Yeah, good. Yeah, and so if you could go to the earlier slide, if you don't mind. Yes, go to the next slide. And the next slide. Right. And this is what we see, guys. If you basically take a look at why you have seen this growth, like I was talking, there is a graduation effect in the market. There's a lot of tools that have propagated into the market. There is an interesting phenomenon that's occurring in the market that I call as unbundled education. A lot of education that was traditionally provided by what I call as brokerage firms has now kind of crept out of the four walls of a brokerage firm. You have social communities, so many great educators. Some of whom you're going to meet today. They deliver better education and better responsible education than the brokers do. And those educators, those influencers have actually created a tremendous amount of what I call of propagation and penetration of options into the activities of the graduated investor. So tremendous involvement with that. And third thing we also see is that the trade decision making actually has been occurring more outside the four walls of a brokerage firm than ever before. And even if you take a look at our volume today, I would say almost 70% of our volume actually comes from these great educators, platform providers who provide some great responsible education, and we get responsible trading coming from that. So I see there is an unbundling of, in so many ways, unbundling of education. I see an unbundling of what I call as education plus decision making. And most importantly, I see in the market a tremendous growth in the number of educators that have come into the market. One of the fundamental reasons we wanted to launch the hub was to actually provide this booming ecosystem. Nobody talks about this, guys. This booming ecosystem needs a home, right? And in the past, they were all they were all kind of owned and coordinated at the brokerage level, and we kind of re-envisioned this market, saying we as a brokerage firm can act more as an enabler, and that is the reason why we do these events, and that's the reason why we are seeing so much amount of participation. It is this unbundling of trade insights, unbundling of education, and unbundling of functionality that has been creeping out of the traditional brokerage firm. We can go to the next slide. Go to the next slide, Lex. All right. And I want to talk about a few things that we're actually seeing when we take a look at the traders that today, right? Number one is these traders that we're talking today, I see a kind of basically a squeezing of the trade, right? What I basically mean by that is traders, if you take a look at the chart that I'm showing on the screen, all the way from, it's a chart that I got from NYSE. If you take a look at single contract option trades, you see a growth in that single stock option trades, contract options trades till 2020, 2021, and you actually see it off, right? And they're sticking somewhere on the 7 to 8%. And in our case, we are seeing roughly around 3%. So what I'm trying to say is there has been an increase in the number of what we call a single contract option trades, but at the same time, I think we have certainly seen that basically taper off a little bit. That only tells me that a lot of people have jumped into the market and now have got sophisticated and are involved in more and are involved in more sophisticated instruments. We'll talk about futures in a second. The other thing that we also see is we see a tremendous growth in short dated options, right? And the reason basically that we are fundamentally seeing is also because of the graduation effect, but there is a tremendous amount of what we see as increase in the 1 to 5 day short dated options that are there, that have been creeping up, right? But if you take a look at the Tradier ecosystem, today we do about more like 15 to 20% of that short dated options. But on the whole, the reason I was putting these two numbers up is both these slides show that there is basically a graduate investor in the market. He starts off in a certain way, but over time he basically gets sophisticated. So there's certainly an interesting trend. We have tried to build product. In fact, a lot of our education that we see on the hub mentions this, and we have tried our best as an educational operation that engages a lot of these educators to try to focus on what we are seeing in the market. So that's Lex can go to the next slide. And one interesting thing, and I think some of you had asked me to talk about this, and so I'm not sure if actually fit some theme over here, but I did want to talk about this in the sense that more recently, every time I get asked saying, are you seeing tremendous amount of volume every time a meme stock rally occurs? There's quite a bit of noise that I get asked about this every time. But when I take a look at the raw numbers, our numbers certainly don't indicate those volume growth. Some marginal volume. In fact, we see volumes timed totally different. For example, there were recently a meme stock rally, And if you take a look at our volumes, they don't even time along with when those rally occurs. So one of the stuff we are trying to do is there's a tremendous amount of distraction coming from this. So we're trying to have our educational community, try to push responsibility and clarity around this. I think some part of the what we see is the media hypes it up, and every time you see some micro price stock double itself, we hear quotes on the television channels basically saying the retail is back, we're back to the growth. It's not all true, guys. There's and we don't really see that. I think there's some fluctuation, there's some volume growth, but if you compare that volume growth in the overall market versus volume, the timing of the volume that we see on our side, I'm not totally sure that I think some of that the size of discussion that occurs in the media versus actual reality actually has a correlation. But this is what I expect, guys. I said this a few days back in the media. Graduation effects will taper these meme stock rallies. I think you'll see fewer and fewer of them. I'll tell you, most of the traders that we speak to consider these meme stock rallies as what I call as baseless media frenzy. I mean, that's how I think about it. And at the heart, as all of you guys know, it's really not based upon any fundamentals. So I think that's really the heart of it. Lex, can you go to the next slide? Right. From a Tradier perspective, last time I spoke at the keynote, some of the folks had asked me saying, "Hey Dan, can you cover what's coming at Tradier? We hear so much about what's coming. I mean, I think it'll be great for you." I know, we have always tried to keep these events not focused on Tradier, but actually, focused on education and trying to basically pass on responsible content to our ecosystem. But a few have asked us to, because I think I understand the part that so much of that ecosystem growth is enabled by functionality at the core at the back office. So I totally can understand where they're coming from. We have a few big releases coming up, guys. We have Tradier Futures, which we made an announcement. We hope to get it out in the next few weeks. Really excited about it. I'll talk about why we launched futures in a second. We basically have we actually are launched. We actually launched futures already in beta with a good partner of ours, Rob Hoffman, who's going to be speaking later today on wealth charts. We had seen tremendous success both in adoption and it helps us actually understand the cohort of users. So I think it's amazing. And what kind of cohort does our ecosystem attract has an important point of discussion for us. So we kind of launched it a few weeks ago, like actually more than 2 months ago, actually, with tremendous success. We're about to get it out in the next couple of weeks. The product team, Peter, Stefan, and the folks are working very hard, and Jason are working hard to get it out. And the next thing is also mobile, right? What we have fundamentally seen, I think the days of thinking of mobile as something that only an early stage stock trader basically uses, and most options trading is desktop based. It's actually still true. I mean, it's still true, but at the same time, we are basically seeing a tremendous growth in what I call as the traditional, what I call options volume occurring on the mobile side. I think the next time I speak, I'll try to get you a little bit more analysis on what the behaviors of a mobile options trader are. But from what we can see, there has been a growth in both overall in the market and also in our ecosystem, that options traders are adopting mobile much more. Not the basic options trader, even the advanced option traders are basically adopting mobile in a major way. And so what the product teams have done is it's going to get out in the next couple of weeks, but we are relaunching the mobile with a much better trading experience, number one, much better navigational experience. I think they have re-engineered the way I think we can build a spread trade seamlessly on the mobile app, which will be fascinating and will support a lot of traders who use that mobile app. I think they're trying to change the interface of how do you stage a ticket before you actually place it. That's another great improvement that's going on. Just because of the convenience factor, I think the product team have introduced your touch-based kind of trading, which is the traditional swipe touch kind of an experience, which will make mobile good at what it is. So that's also we're going to do. And lastly, and most importantly, is what has made Tradier, its partners, everybody, right, so much more effective, and what has created so much amount of growth for us over the last 12 months is particularly the fact that I think we provide great service. So we're actually going to make it super easy for people to actually access service and support also through the mobile app. um, that's something that's coming. Then also, we're on this, guys. I know there's a tremendous demand for us to release portfolio margin. I do want to give out a shout to the folks at Apex who are clearing firm, who have been working with us tremendously, helping us launch a great responsible product. We are testing it. This is something that as a firm we measure, I guess, 10 times and cut once, but we're going to get it out. I know there's a tremendous demand for this on the side, and we will. And when the product gets out, we will actually engage the hub, the partner ecosystem, and our direct to consumer messaging about how to responsibly, use the product. At the same time, how do you basically be equipped for something like this? And lastly, and most importantly, is thanks so much, guys, on the hub. I mean, we right now have tens of thousands of people who engage with the hub. I mean, our social media, what adoption has gone up so much. We literally have tens of thousands of people who watch our videos every month. And Lex has kind of become a YouTube star these days for all I can see. I think, but tremendous. So we are trying to couple that with greater performance improvements at the same time, navigational improvements on the hub. So tremendously, excited about what's going to come. So let me say a few more things about why we are launching features. Lex, can you go to the next slide? Right. I'll tell you, for a long time, we've been in business for about, as you know, for about 10 years, right? We always, are a firm, and we'll always be a firm which will measure twice and cut once. And more importantly, we learn from our consumer base and our partner base. We are not like other firms where, we are launching a product and see how it sinks in the market. That's not what we do, right? And so we're very incremental about it, but we're always more successful at it too. But a lot of people have asked me, why launch futures and why launch futures now? One thing, basically, if not for anything else, I think the basic reality is that I think a lot of our traders are active traders. I mean, they basically are in the business to spend a big chunk of their day engaging with the markets. So, I think futures contracts, particularly because of the option-centric nature we have, and in general, futures contracts are highly leveraged products and traded on margin. It gives our customers, a much better way to deploy their risk, right? And I think, we're tremendously excited about this, and we have tried to create a great product. We are right now, the folks at Darman and a few other FCMs who have worked with us over time have tremendously helped us. So we're getting ready to launch it. So, but one of the reasons we're trying to is that the leverage factor is one of the main reasons that we see that our customers are asking for it. The second thing is volatility, right? Futures provides traders with this. I mean, there is continuous volatility, and because of the active trading nature, I think our customers like it. So I think that's one of the reasons why we actually see a tremendous amount of what we call as interest in this. And I think we're coming to a point where more and more markets are going to become extended hours. Futures are open 23 hours a day, right? I guess 5 days a week. So, I mean, that kind of basically lets them actually deploy their strategies and engage in the market continuously. This is something that we are trying, when we launch, we'll try to provide you the best support we can, and combine that with great education like we always do. And lastly, and most importantly, one of the reasons why we are launching the hub is that's what our customers are telling us. The customers are basically telling us, we basically have an account. For most of our traders who come and participate in the hub ecosystem or a trader in general are generally not brokerage account holders, right? They're generally at a traditional legacy broker. They've been there for a while, have been stuck with sometimes confusing pricing, and most important, sometimes lack of service, and they have a brokerage environment like we basically propagate, right? But we found a lot of our customers still have at some of these locations, and so they've been asking us, saying, we'll move the whole wallet here if you can provide this. So it's, I think we are trying to basically launch futures. So, so that has been the reason why we're launching futures. So we have an exciting, we basically have an exciting product roadmap for all of you folks. We are focused on the hub. I appreciate all the folks who actually come and get educated. great partnership with CBOE. I basically wanted to say, if not for them, we probably would not have jumped into this with the amount of aggression that we did. They provide us participation, they provide us support in every way. I mean, great support from CBO on this. Let's can go to the next slide. So, and I think I hope I was able to give you folks. Sorry about the little bit of technical PowerPoint upload glitch. What I was trying to do was try to get to you the mission of what we try to do, what are we seeing on the ground, and most importantly, what is coming. And I'm going to get out of the way. Today we have some absolutely great, what I call speak, or focused, who get up each morning and do one thing, and they want to do right by the retail customer. And so I think folks do, and I'm super excited. Today we have Kirk. Kirk is a good friend, runs an amazing platform called Option Alpha. Then we have my friend Rob Hoffman from WealthChart, super smart guy. Rob just, I think, won the what I call as the World Championship of Trading. I'll let him speak about it. Super excited to have him. Then we have Mandy from CBOE. I think we have Marcus's partner on the call on the show today. And one thing, we also have Luis, I think. So Luis is a good friend. I do want to make a comment about Luis, and say Luis was the single most important reason why Tradier has focused on. We always wanted to basically focus on the Spanish and the Latin market. We could never find a voice that helped us understand and do better for that market. And Luis has been a big force behind a great partnership with Luis, and Luis is going to be speaking today. And then you got my friend Steven. I've known Steven for as long as Tradier in my life before. Then you got Bobby and Jim. Great show. And finally, I think we have one of the hosts on the on the hub, Molly, also speaking today. So I'm going to get away from where get away from you and from the actual content. And once again, thank you for taking the time. A great welcome to all of you. Welcome to all the partners. I know so many of you folks are actually come and log into the hub. I encourage people to come to the hub. It lets us engage with you better. I know there are a small subset of people who watch it on YouTube. We will make it available on YouTube, but the hub lets you actually engage and also provides you a fuller experience. We'll update you on videos that come up. Let us help you, and you can help us in return. Anyway, thank you so much. Thanks for joining the show. I'll try to come in, but Lex, you're muted.
Thank you, Dan. That was amazing.
Yeah,
that was
thank you. Thanks for that. That's a great overview of the market. Unfortunately, we don't have a ton of time for questions. One quick one though. People are asking about crypto. What are your thoughts on crypto? I think I know the answer, but I'll let you answer real quickly. We got about a minute for an answer if you have one.
See, I mean, what we wanted to launch crypto, spent quite a bit of to actually get crypto up and running. Kind of held off on it. I think we are going to wait to see what the regulatory environment for crypto is, and get to it. I don't expect to touch crypto this year in 2024.
Okay.
For 2025 for us.
Perfect. Good to know. And quite honestly, once we get the futures rolling, there's crypto products and futures that you can affect the same results, or mostly the same results. So that's good news as well.
And Dan, I know Kirk is coming up, so I'm excited about that. But question: so GameStop's back in the news. What do you think about these meme stock traders? Will they be valuable to the ecosystem, and where do you see their future?
See, my take on the meme stock rallies, I expect them that. I think you'll see lesser and lesser of it. I as a trader and and being on the brokerage side, want people to trade on fundamentals, and I don't consider this trading to be fundamental driven. I encourage them to basically come and watch the hub and actually get educated on some of the fundamental analysis that we do. So, but that being said, I think as the graduation effect kicks in, you'll see lesser and lesser of it. If you take a look at in 2021, 2022, that time frame, we were doing 30, 40 meme stock rallies in a given year. We're hardly seeing 5 or 6.
Right.
I think they will zero, but I think there is a tremendous. I look at the meme stock rallies and find purpose for stuff like the Tradier hub on it. I think there's fundamental education is key. I think these social communities kind of create a fan following around a few securities. But I think, as you can see, the last one that we saw with GME and AMC, I mean, hardly lasted a day, right? So I think you're going to see some of that.
Right.
I think that's a good point. And we have Lex and other market makers, which really add on the Tradier Hub, which adds to that third component of the acceleration of pricing, which is also incredible resource. So thanks, Dan. This is great.
Thanks,
Really
Dan. Great job. Thanks for kicking us off in the right direction. We appreciate it. We're gonna move on to the next presenter. Join the Tradier Futures waitlist. Access the gold, oil, index, currency, and crypto markets with Tradier Futures. Make sure to join the waitlist now so you know when we launch this powerful product enhancement. Catch the options quiz by Kahoot at 12:45 p.m. to win great prizes. First place, $1,000 into your Tradier account. Second place, a year's free subscription to Tradier Pro. And third place, a Tradier Hub swag bag. Mal, you want the third place swag bag prize.
I know. I told all of production, like Max, Matt out there, Louise, you guys are not allowed to play.
All right. We got to get moving here. Next up, good friend of mine, just a super great guy, great business. Kirk Duplessis from Option Alpha. He has a great presentation here. I've been with him before. Love this thing. I learned so much from it. So let's get Kirk out here right away. What do you say, Mal?
Let's do it.
Bam. Hi.
I was like, you always look way better. What's going on, guys? All right, so we're going to get right into it. So I think you guys can share my slides here and put me up here. So first of all, I appreciate the invite to speak here. Hope everyone's having a good day. I'm going to try to squeeze this one in 45 minutes because I know that I did this one before and it was just about an hour. So I'm going to go through a little bit fast, but I think you guys will really enjoy it. And this presentation I did at Luis's summit in Florida, and it was awesome. It was a great summit, by the way, great event. And it's basically why bot trading is dominating the options market. So I want to start off with a little bit of a story and like kind of background here just to kind of get you guys thinking in the right mindset. So imagine that you're walking into a casino, and this is usually what every single person looks like when they originally like first walk into a casino, right? They're super excited. They want to, they know, there's hopes and dreams of like winning a bunch of money, right? And the reality is that once you actually get into the casino, you kind of look like this, right? Where like money feels like it's getting sucked out of your pockets and out of everything, right? And this is no surprise to anybody, right? Anybody who's ever been to a casino, anybody who's ever been gambling before, like this is just what happens. Like it all starts really good, but then it ends, terribly wrong with all of your money getting sucked out. And this is because the house has an edge, right? Now, look, the funny thing is we instinctively know that this happens, right? Like we know walking into a casino that the house has an edge. In blackjack, the edge is like less than 1%. In European roulette, it's about 2.5%. In American roulette, it's about 5%. So we know that this happens. And it's just a matter of time that the house eventually wins and always wins money, right? So if you're going to play roulette, which is the wheel that spins with all the numbers, right? And it's got the black and the red and the greens. First of all, if you're going to play roulette, you play European single zero style roulette because the edge is less to the house. But just literally adding the double zero, of course, increases the house edge to 5.26%. And so what casinos know and instinctively do is they get you to the casino, make you stay, right? There's no windows. They pump oxygen. They give you drinks, right? They want you to stay and play. But intelligently, what they also do is they make you and force you to bet within a parameter, like a set of parameters. So like if you look at a casino, they don't allow you really to go and say, I'll do $10,000 on black right now, right? They don't do that because they know that the best way to get all of your money, because they know they have an edge, is to make you play over and over and over again. That's why they have table minimums and table maximums and table limits. They know if they have $10,000, the best way to get your money is not one roll, not one spin. So if you actually look at the roulette probabilities of winning, after one spin of the roulette wheel, you are likely to be behind the casino 51% of the time, right? So again, casinos know this instinctively as you go in. that in order for them to win, they have to get you to play 1,000, 10,000 times. That's why they limit your bets. They want you to spend your $10,000 $5 at a time or $10 at a time. Because after 100 or 1,000 or 10,000 spins, there's no chance that you're going to walk out of that casino with money. They know that they fully captured their edge, right? So the funny thing is that of course casinos make all this money. We know that this happens as traders, right? Like as traders and humans and just people, like we know going into a casino that they have all the edge and everything's favoring them, but yet we still go in there and do this, right? Well, casinos got smart because eventually, like way back in the day, and I think this photo was from like the 60s or early 70s, right? Way back in the day, casinos had this edge, but it was all human driven. And what I mean by this is that if you went to a casino 40 years ago, 50 years ago, right? There were mostly humans in that casino. Human like dealers were at the table dealing blackjack and playing roulette and doing all this other stuff. And what casinos eventually did is they started to migrate into electronic trading, even through electronic slot machines, even through and using slot machines. And then even the slot machine itself was very much a manual thing up until about 1964. So casinos had slot machines, which was just like one version of a game that had an edge. But in 1964, with the Money Honey, they eventually launched the first electronic slot machine, which was, in my opinion, truly a change because now at this point, you didn't have to have these people who tended to the machine, right? Like you didn't have to have people who ran around and, replaced coins and did all that stuff. Like, no, you had something that was more electronic. So it was this first gravitational pull to something more programmatic, more technology driven. And you saw this happen in casinos. So what happens now is that now you walk into a casino literally anywhere in the world and you don't see a bunch of table games. You don't see, that's kind of like the rare thing now. So you don't see humans dealing cards that often. I mean, obviously they're there, but the vast majority of casinos now and floor space is made up of these electronic gaming machines, these slot machines, right? And so if you look at the revenue of casinos, it went from essentially about 40% was generated through slot machines. I think it was like 30 years ago when I pulled these stats, right? And then now upwards of 70% of a casino's revenue comes from electronic gaming and slot machines. So the vast majority of money that casinos are making, and we should use this as like an analogy for where trading is going, is coming from machines that are playing games, right? So it has to make you wonder, and did for me, like it has to make you start to think, okay, like if casinos went through this progression and this like history, then is there the same history starting to play out in the options market, in the trading market? So let's go back, right? 1903, here's the floor of the NYSE, right? And at this point, this was all floor trading. You couldn't make an electronic trade. If you physically wanted to trade, you had to go down to the stock exchange and make a trade, right? And like think about it as a casino. Like if 40 years ago, if you wanted to gamble, you had to physically go to Vegas or a place that had a casino and walk into the casino. Hopefully there was another human on the other side of it and you'd have to, gamble and place a bet. But now you can gamble on your phone, right? Like you can gamble online, you can do whatever, right? So now technology has completely disrupted that industry and it's happening the same way in the options market, the trading industry. So eventually, and I know Lex, we talked about this, the last one, Lex, I think actually had a Quotron, but eventually you had this thing called a Quotron, which replaced the ticker tape. The ticker tape was a real thing where like the tape would actually come out of a machine of all the stock prices. Well, that eventually got replaced by this thing called the Quotron, where you could type in a ticker symbol and then you could get digitally the ticker, like the value of that security. Now, if I put this in front of a regular trader these days, you guys would, your heads would explode, right? Like having to type in the symbol for everything you wanted to look at. But imagine that's what you had to do. And that was, again, another progression of this technology that's disrupting the industry. And then you had the first electronic exchange in 1971 with the NASDAQ, of course, and that changed everything again. That was like another huge point. I would say that this was similar to the point in which casinos started to launch the Money Honey electronic slot machine, like a very similar thing where now all transactions could be done electronically. So fast forward all through that time. And even since then, everything that's evolved and all the sweet computers and technology and everything we have and all the new graphic interfaces, the harsh reality of trading is that you're still the bottleneck. So really, in our opinion, not much has happened between 1971 and today. Yes, you can trade mobily, you can, trade at your computer, you can log in from places, but you're still the bottleneck of your trading strategy and your system. And if you're thinking to yourself, I can trade mobile, well, now you're a mobile bottleneck. So it doesn't really matter that you have the ability to pull up a stock chart on your phone now, because if you don't log in, if you don't look for the symbols, if you don't look for trades, it doesn't happen as a retail trader. And so you've become a desktop bottleneck, and now you are a mobile on the go bottleneck for your own trading. If something happens to you and you forget, trades don't happen, right? And this is a problem. So what we need to do is we need to continue down this path of disruption. And that's where I think bot trading and automated trading has been and is going, is because it's the natural progression of what is going to happen and already happening in this industry. It's just going to become even more prevalent in the future. So what happens with disruptive technology is that the first thing that happens, and this is like that number one here, is that technology overshoots your needs, right? And that's kind of where we are at this point. It's like there's so much technology, but it's overshooting our needs. Like there's not much that's really improved things with most legacy platforms. And so you get a lot of incumbents that are improving, sustaining technology. I mean, some of the biggest platforms that have been around for a decade and a half have legitimately not changed at all in that time period. And so nothing has happened. It's just a different skin or a different layout or a different UI experience. But the actual mechanics of trading really hasn't changed. And so it's not until you get a disruptive innovation that kind of breaks through that you start to see people being forced into adoption. And I would argue to say that eventually that forced adoption is going to get faster and faster. And this is what happens all the time with all technology, is that eventually, like slowly things happen, and then suddenly it becomes the new norm in the future, right? So remember that disruptive technology doesn't change what needs to be done. It streamlines the process by which it's accomplished, and it removes inefficiencies. And this is so important. This is not saying that bot trading changes what needs to be done, or automated trading changes what needs to be done. Rather, it's going to streamline that process by which it's accomplished and remove inefficiencies, namely human inefficiencies that we just can't overcome, right? So to give an example of this, like Blockbuster and Netflix, or Blockbuster and any streaming service, I remember going to Blockbuster as a kid, having to rewind the videos. And like if we wanted to rent a movie, we had to go and we had to hope that the movie was there. Then we had to drive it home and then watch it, right? Like I still remember doing that. But here's the thing, when streaming services came out, like Netflix and whatever, it didn't change what people wanted to do, right? Like we still want to watch movies. We still wanted to rent movies. But what it did is it made it easier and more efficient and removed inefficiencies, right? And now it's at scale. Like now, legitimately, everybody has a Netflix account, right? I would assume. But originally, when it came out, even in the early years, not everybody had a Netflix account. It's kind of like, oh yeah, my friend has one, but now everybody has it. It's standard. Actually, most people don't even have TV. They just have a Netflix account, right? So that's the slowly, and then suddenly it's going to become the standard moving forward. And so I would argue that if you like objectively look at most platforms out there, like seriously look at most trading platforms out there, what has seriously changed in the last 5, 10, 15 years? Everything is the same way to execute a trade, which is that you as the trader, as the retail person, have to log in, have to find a symbol, find an option strategy, find a chart, pick something, right? Like there's so many things, and you have to do it, right? And if you don't do it, then it doesn't happen. And so, new platforms that have better looking, graphics and UI elements and user experiences, that's awesome. But it hasn't actually changed the process of trading. So I would say that the bots are the next evolution, and they are the next evolution. They're the next evolution of trading, just like slot machines and electronic gambling was the next evolution for casinos, right? That's what's going to happen. And it's this shift that is going to happen and already happening between the manual way of doing things, which is very time consuming, very expensive mentally, right? Error prone, inefficient, to a new automated way of trading. And we've already seen this start to accelerate. It's just going to get faster and faster. And so here's a a chart of the algorithmic trading market by size. And you can see that even in 2018, 2019, it was already $11 billion. 2024, it's expected to be upwards of $18.8 billion. So electronic and algorithmic trading is continuing to move at a really, really fast pace. And so if you're not on board with this, you're going to miss a huge opportunity to get ahead of the curve here and to jump in at the ground level. And so let's take an example here just because I want to show you guys a little bit about this. And this is a chart from before that I used in the presentation, but let's just say you're looking at some stock and you have some indicator that tells you that you want to get into a bullish or bearish trade or whatever the case is. It really doesn't matter, but you find something and you want to trade it. Your process of trading right now as a trader looks something like this. You go to your favorite broker platform, right? And you type in the ticker symbol, and then you're presented with a list of all the different expirations. Now, here's your first roadblock is you have to choose what expiration you want. Do I want 0 DTE? Do I want 10 days, 30 days, 40 days, whatever the case is? How do I know which one's better? There's all these numbers here, and some have weeklies, some are not weeklies. I've heard that monthlies are better. I've heard that weeklies are better. Everyone trades 0 DTE, but I don't know if I should do that, right? Like, there's no objectivity to this. It's just subjective picking and choosing. I heard from somebody that I should do around 30 days. So maybe I pick 30 days, right? Okay. So you go in there and you say, all right, maybe I pick 7 days or 30 days, whatever it is. Now you open that option chain and you do it on your phone, you do it on your desktop. It doesn't matter. You open that option chain. Now you have all these different strikes to choose from. Again, you're presented with the same thing, which is, what the heck do I do here? Like, what do I trade? Do I trade at the money, out of the money? You know, like, do I do a 30 delta, a 50 delta? What do I do? Do I do an iron condor? Do I do an iron butterfly? There's so much choice here, and you are the bottleneck of all this choice. And so even if you do that and you get to this point, you say, okay, I heard that I should trade, you know, whatever it is, a 15 delta call spread. Great. So I'm going to trade a 15 delta call spread. You load up that position on your broker platform. They might give you a couple little data points. Like, they might give you the probability of profit, or they might give you the days to expiration or something, right? That in and of itself is not enough to make a trading decision. And that's the problem that a lot of traders face, is that although they might get to that step of finding something they like, right, and feels good just on a gut hunch or an opinion, right, an emotional opinion, they don't actually know if it's a good trade or not. And they can't, because they can't analyze it as fast as a computer can analyze it. So if you take this same trade, right, or, well, here's the deal, right? If you're doing this right now, you're a blockbuster. Like, you are literally a blockbuster trader. There's going to come a time where you don't exist anymore, because things are going to move so fast that this older way of doing it is going to completely disappear, right? This manual, we're going to laugh one day and say, like, kids, I used to manually trade. I used to point and click, and I used to choose every strike. Like, that is going to be something that we laugh about in the future, right? So you're blockbuster. And the problem is that you're blockbuster because this is your trading strategy, right? So in the comments, right, for sure, is this your trading strategy, right? This is kind of what it looks like. Sticky notes everywhere. You kind of have some things scribbled down. You really don't know what you're doing. You're just kind of like, I call it like the rodeo cowboy. Like, you're just walking into the market every day, gunslinging, shooting at stuff, and just hope you hit something pretty good, right? Or if you're like me trying to describe my strategy before, like, it looks something like this. Like, it's a little, you know, you're like, I need a cigarette in 15 minutes and I can kind of get you to where I am with my strategy, right? But if that's your strategy, you know that that's not sustainable, right? You know. So here's the reason why traders do this. And this is where it gets to, like, the whole ethos of what we believe at Option Alpha, which is that you have these two parts of your trading strategy. And right now, as a trader, you're using one side of your mind, one side of your brain, which is your mind. I call it the mind side. This is market intelligence and nuanced decision making. This is the rational, logical, strategic side. When people talk and write and podcast and do whatever, this is the side of your brain that you're using, right? If you were to describe what you do to somebody else, they would basically say, yes, I understand what you're saying. And you would describe it really well, because you're using your mind. You're using the really smart, logical, rational, strategic side. And everything sounds really good and probably is, like, makes sense in your mind. The problem that traders have is that when they actually walk over to the other side to start executing their strategy, they hand off everything to the other side of your brain, which I affectionately call your fool. And your fool is the side of your brain that you allow to manage and execute your strategy. And it's frequently oblivious, it's an overestimator and a luck seeker, and it's inconsistent, brittle, and susceptible. This is the side that 99% of the time is managing your trades, right? We've all been there. We've all been, at the plate. Like, we've all had all of the trading psychology, pitfalls and drawbacks. And that's because we'd have our mind that does okay, right? But then we hand off execution to the fool. And that's where we mess up. We hand off execution to the fool, and we believe that as intelligently as we could craft our beautiful strategy, we can as equally and as intelligently execute that strategy flawlessly in the market. So we've been there, right? I've been this person, like, you've held that one little bad trade that you're still hoping turns around, right? Maybe some GME traders are actually those traders right now who bought GME a couple days ago or last week or whatever when it was up and they thought it was going to go up to 100 or whatever the case is. Like, you're still holding on to that, right? But that's the fool inside of you. That's the fool who's now executing and managing the position. You can't rationally have an argument with that person, right? And the problem is, as traders, is that we are susceptible, because we're humans, to all sorts of cognitive biases and flaws, right? It's like, here's a really funny one. Like, is this 3 or 4? But if you really look at it, like, it looks like 3, no 4. It looks like 3, no 4. Like, so even if we look at stock charts, like, you might see something different than I see. And you might be like, that is a Head and Shoulders. And I'd be like, I don't even know what you see, right? So there's all sorts of these biases that we have to contend with all the time. Here's a really fun one. If you've ever done this one before, I did this at a live audience. A lot of people got this wrong, but are A and B the same color on this chart? So is the little block A the same as B? A lot of people would say no, but the answer is yes. They are exactly the same color, right? And it's that fast that I can trick your mind, myself included. Like, you can trick your mind so fast. Here's another fun one. So are these two tiles the same color? You would say to yourself, absolutely not. They're not the same color. But the reality is they are the same color. So if you have like a blackout in between them, you can see that the faces of these two tiles are exactly the same color. Again, that's how fast you can trick your mind. Here's a really fun one. If you haven't Googled this before, you can Google it. It was a study done with these kids who were bouncing a basketball. I don't know if anybody's ever seen this before, but they were bouncing a basketball back and forth. And they asked participants in this study to just count the number of times that kids passed the basketball back and forth in this like short video clip. And I remember doing this in school originally when this came out, or like at some point it came out. And I remember counting it. I was like, man, I nailed it. I got all the basketballs. I counted every single time that they passed it perfectly. But what you miss in this clip, if you've never seen it, is that during this study, they walk this dude in a gorilla costume right across the screen. And nobody sees it, because what you're trained on is you're trained to count basketballs. And so what the analogy is to trading is that as a trader, we're trained almost to a certain degree, because we're humans and we just have a limited scope of conscious energy and focus. We're trained on just looking for that one thing that we want to find or are trying to look for. And maybe we get really good at it, but we miss the proverbial 800-pound gorilla that walks across, right? Like, so we're looking for our one trade, but we miss a billion other better potentially trades because we just don't have enough conscious energy and like focus and attention to do that, right? Whereas a computer, a program, a bot can do that, right? So let's go back to this example before, right? Remember, this was the example, had an 83% probability of profit, which is cool. It sounds really good. Like, maybe that's a good trade for you. If you take this trade and you now use it inside of Option Alpha, plug in that exact same trade into Option Alpha. Again, this was from before, but I took the screenshots literally side by side, so it's really good, a good comparison. You can see that inside of Option Alpha, we calculate about the same probability of profit, about 83%, right? So you're thinking, okay, this kind of jives. But the problem is that we also do massive statistical analysis and use computers and big data centers to basically run even more calculations than you could possibly run yourself or do in your head. And what this trade actually ends up being is it ends up being a negative expected value trade with negative alpha. And what that means is that although the trade on the surface looks like a good trade, when you use computers and technology to really dig into some of the numbers, it looks like this trade ends up being net a loser long term. And that's the difference between trading manually the old way and using technology as a tool and a resource to help inform new trading ideas and things you're going to do moving forward. Because now, if I look at this trade in Option Alpha, or my bots look at this trade in Option Alpha, then I know that this is a negative expected value trade, which means that there's not a good likelihood at all that long-term this trade ends up working out. I don't care that the probability of profit is high. It's just not collecting enough money when it wins to cover the losses when it loses, right? That's the difference in trading. And so when you're trading right now, you're trading against supercomputers who are basically doing this on the other end. And you have no idea this is happening because you're just sitting there trading. You're just like, I like RSI. I like this. I like all these things. I want a meme stock. I want a whatever. And you're just feeding the other side of this. There's no way that you could possibly continuously win in this market environment when your competition is mega supercomputers with unlimited computing capacity to really calculate what a good trade looks like or not. You have to have something comparable to level the playing field. And so what I want to get you to the point of doing is using your mind. I still don't want you to avoid using your mind. I think that's a misconception. It's like when people hear bot trading and automated trading, they basically think to themselves, oh, they're just going to do it. It's just going to be a trading machine, a little, gambling computer that does it. No. Like, this is much more than that. You still use your mind. Use the God-given talents that you have for logical, rational, strategic evaluation of what is a strategy. That's what we're good at. As investors and humans, that's what we excel at, is that higher level thinking, right? But instead of offloading the execution to your fool, using your mind to then execute your strategy, why not offload the execution to bots? And in this case, bot stands for Better Operating Trading System, which is more data-driven and technical on the implementation side, or tactical on the implementation side. So yes, use your mind to do what you do well, and then offload the execution and management of that strategy to a bot. That's it. It's really simple. It's what casinos did when they said, we're going to create a game that has odds in our favor, and then we're going to let people play it on an electronic machine that we don't have to manage, right? So create a strategy that makes sense to you, and then execute that strategy with a bot so that it's done perfectly, so that you can analyze that performance of that bot or that strategy or whatever. And then you don't have all of the pitfalls of being a manual trader and letting your fool take over, right? So to use an example and kind of walk through it, if you use something like trade ideas, which you can use inside of Option Alpha, instead of coming in and just randomly guessing when you walk into the market, no, you come into something that is doing the work for you and leverage that technology. In this case, trade ideas, what it does is it analyzes millions and millions of possible combinations of spreads. So when I took the screenshot, it was 41 million trades that were analyzed by noon, like it was 12:30 Eastern time, right? So if you can't analyze 41 million trades perfectly, then like how can you possibly choose what are good trades versus bad trades, right? So you use technology as something that you can lean on, that you can use to improve your trading. So you come into trade ideas, you come in here and you say, all right, I'm looking for a trade that is a credit spread trade for a particular symbol like SPY that's bearish with 7 days or more to go till expiration and with an expected value of $5 or more. So this is a completely different way of trading, because instead of going into the market just kind of picking and choosing, hoping and praying, you're coming in with an objective and you're saying, this is what I need. This is my criteria. I want this, and I want this. Now go find it for me. And that's what you're essentially doing. And so now you've got a very curated list of much better trading opportunities with expected values that are positive versus negative expected values from which to choose from, right? So maybe you look at this first one here and you're like, okay, this has a 62% chance of profit. The expected value is $5, right? So if I were to make trades like this long-term over and over again, I would expect, to make $5, per spread that I traded, right? So now you look at this trade and you say, okay, this is a trade that I could possibly make. You load this trade up. And now what you do is you throw this trade into a bot for automation, and you let the bot take over the management. In this case, you can set things like exit options, which now you no longer have to manage the position at all. Like maybe you were part of entering the trade, but now you can let a bot take over management. Again, a bot is not doing anything other than what you tell it to do. You're telling the bot in this case, hey, take profits at 75% of the credit. So if I get to that point, then I want to take profits. I could also execute at the same time a trailing stop loss where I can say, hey, once I reach a 30% profit, start to trail that profit by 10%. Again, you can't do this as a manual trader now on any platform. You can simultaneously do all of these things in one single trade. Or you could say, hey, if none of these happen, 2 hours before expiration, close the position, right? So now your entire trading life cycle and all management is taken care of. You can take profits, you have trailing stop profits, and you have expiration taken care of, right? That's kind of like wrapped up in these very nice little exit options. Now, if you like all of that, you can have your bot auto trade that type of setup. You can manually do it. And we see a lot of people use Trade Ideas and Option Alpha just as an engagement tool, and then they get more comfortable with it. And then eventually they start manually trading it, right? And so now you can say, hey, bot, I want to auto trade this setup. And what you're doing at this point is you are now the instructor of a machine. That's it. Like, don't overthink what it is. You are now instructing a machine to do your strategy execution. And guess what? Your bots, they don't get tired, right? Like, they love crunching numbers. It's literally what they tell us they love to do, is like eat numbers all day, every day, breakfast, lunch, and dinner throughout the trading hours. They just work, right? And they allow you to instruct them and be the general of your strategy without having to dig through the market to find ideas. And so now when you go in here, you connect it to your account, you can set scan speeds, you can add other automations into your bot. And automations are just simply a set of decision criteria. Like, this is one inside of a bot that I run, which is basically this idea of like checking if the position that I'm about to enter is spaced appropriately. So like all of these decisions, you just have your bot make and you tell it what to do. In this case, what I'm doing here for this is I'm saying, hey, I want to make sure I ladder my positions at least 3 days apart. So for me, I don't want to enter a trade every single day. Maybe I'll enter a trade every 3 days. And then I have the bot check my beta exposure. And this is super cool because now you can have a bot do even more things than just find a position and get into it. It can analyze its own portfolio. So the bot can self-analyze and say, whoa, I've got too much bearish exposure, or I've got too much bullish exposure, and I want to add an opposing position. Or if I'm kind of perfectly balanced or pretty neutral, find an iron condor or an iron butterfly. Now you have something that is self-correcting to the market. It's adjusting itself so that it doesn't add 10 put credit spreads and then get crushed when the market reverses the other direction, right? And all you're doing here when you're telling it to find a new position is you're using this idea of shopping for a trade and telling the bot to go find trades that meet your criteria versus just randomly picking and choosing. So in this case, I say, hey, go find a put credit spread that's 20 to 45 days from expiration. And I want to get into one contract if you find it. And I want to do pricing 4 cents from mid price. So I'll allow a little bit of slippage. And my exit options for that trade will be set to 40% or 1 hour before expiration. The entire trading strategy is completely done and wrapped up in this. I don't have to touch anything. I don't have to manage anything. It's in there. You can also set additional criteria, very similar to how you would order a meal, or if you order something online, it's like, yes, I want this, or no, I want this. I think the analogy I gave before is like if you order a sub or a sandwich or food, right? You're going to say, yes, tomatoes, no ketchup, yes, mustard, right? You just do this for the same thing. Tell the bot, hey, I want only positions that expire before FOMC meeting, only positions that expire before the ex-dividend date. Make sure any position you get into has positive alpha and positive expected value per contract. Make sure its probability of profit is at least 60%, and make sure that the max loss per contract is less than $500, which for me is small, so I wanted to keep my position sizes small. So you're telling the bot, this is your criteria. You are allowed to find anything you want that meets these criteria, and once you do, you can rank it by whatever metric you want to rank it by. Again, what you're doing is you're instructing technology to work for you. You are not the bottleneck, right? You can do a ton of other things in here, like add conditions, send yourself notifications, tag, open positions, close positions, right? It's completely up to you how you want to run it. Here's one that you can do for assignment risk. So if you're thinking, well, maybe I want to manage positions when they get close to expiration and there's a high risk of assignment. Well, before you would have to do that as a trader. Like, you have to remember that the position is close to expiration. And then you have to remember, what does assignment risk really mean, or how can I tell? Now what you should be doing is just offloading that to a bot. Let technology do that for you. So here I basically say, hey bot, go through every position, and mine do it every single minute. So every minute it's going through my position, checking, is it less than 5 days? Is it less than 5 days from expiration? Is it less than 5 days from expiration? And they don't care that they check that often, right? But once it gets to less than 5 days to expiration, then I say, okay, yes, it's less than 5 days to expiration. Now I want you to check a set of decision criteria to check and see if I believe that it's at a high risk of assignment. Like, is the position's underlying price below my short put strike? Well, that would probably mean that I'm in the money and there's a pretty good chance that I get assigned, right? Well, now I can also check, is the short leg chance of being in the money greater than 70%, which means that am I in the money by a penny or am I in the money by $1? You know, like, is there a probability to that? And is the short put leg extrinsic value less than 10 cents? So am I in the money and all of the extrinsic time and volatility value that's in that contract has all of that been eroded away? And if all of those are true, it's not that I'm 100% going to be assigned, but I have a really high likelihood of being assigned. So I allow the bot to then close the position. So see what happens here is that if all of these are true, I tell the bot, yes, you may now close the position. This is a completely different way of trading versus you being the one that is the bottleneck to remember how to do this and when to do this moving forward. Or you could do something like this, like on specifically Fed days, you could tell the bot to send you notification that it's a Fed day. And you could adjust your profit targets to 90% for the 1 hour of time around the Fed announcement, just in case there's a wild swing. You basically give your bot more flexibility for that wild swing just in that focused like area of time, right? And so that's really cool. It's like that, now you can see like it's infinitely flexible what you can do. Tell your bot to send you a notification. It can self-correct, self-adjust strategies and profit targets and things like that, and then correct back to it if it needs to later on. So this is why bots are so cool, because they basically are like little machines that trade for you with all of your decision criteria kind of wrapped up in there. You can have switches in there so you can turn things on if you want to. You can set dynamic watch lists so that the watch list will update of like the most volatile tickers or an uncorrelated list of tickers or tickers with high RSI for the day. Like there's so many things that now you can leverage by using bots. So hopefully what you've seen is that what you should be trying to do, whether you do it with Option Alpha or try to do it someplace else, is you should be moving from bottleneck to bot manager. So like you shouldn't be your bottleneck anymore. You should be a manager of these bots that are digging through trades and trying to find the gold for you, essentially, to use that analogy. And now as a trader, your dashboard doesn't look like a bunch of charts. What it looks like is it looks like an activity of what has happened during the day, like a performance activity of saying, you know, like, welcome, good afternoon, Kirk. Your bot's opened 30 new positions today or closed positions or whatever the case is. And now you come in and you can view those positions and say, oh, great. It grabbed this XSP position with a 62% chance of making money and a high probability of profit or whatever the case is. Now you're a true manager of positions versus a hunter and gatherer of trades, right? So remember, mind, you still want to use that you can't avoid that. Like that side of your brain is super important. It is even more important because bots are going to be an amplifier of everything, right? But now offload the execution to bots moving forward. The reality is, if you think that this is an opportunity where you're like, yeah, that's cool, Kirk, I'll get to it later, I'm telling you, the roads are closing fast. So if you've come to this point now and you're watching, you're like, yeah, that sounds pretty cool, but it's maybe a little confusing. And I don't know if I want to go down this path, right? I'm telling you, the roads are closing fast. Here's why I know they're closing fast, because you're going to be priced into adoption. And what I mean by this, and this was taken as a screenshot from a very popular online broker, right? It's not Tradier, it's another popular online broker. When they don't do this, right? But another big guy, right? But look here, if you go in for broker assisted, so if you physically call and get the help of a human, it costs $25. So like they're pricing you into adoption where you are going to have to do things less and less manual. If you want manual help for anything, it actually costs more money nowadays because they don't want you to do it. You're going to be priced into adoption. So all I'm saying, and all I hope you do, is just literally choose to get on a different path. I've shown this thing a million times. It's the perfect descriptor of where you are right now and where you want to be and what happens in the future if you don't just choose to get on a different path. So here's where you are right now. You're right here making this decision. Should I do this or not, right? And all I'm asking you to do, because the gap is very small right now, I'm asking you simply to take one step towards learning more about automated trading and bot trading, because once you take one step, you get on a different trajectory, right? Where you go in and maybe find one trade idea. Just explore it. Just like figure out how you can find a trade that meets your criteria versus going around and picking and choosing random trades because you heard somebody talk about a trade before and you kind of think that that's how you trade, right? But find a trade that will lead you to then building an automation. Then you build a bot, then you have a bot portfolio, then you connect and share with the community, and you basically get on this momentum path, right? And it starts off very slow, but the steps right now are very easy. Like, it's just explore it and see what bot trading and what automated trading, could do for you or how it works, right? But if you're like most people, and I hope you're not, then you probably get on this drifting path, which sounds something like this. We've all been on it at some point for different things, right? I'll do it later. It's too hard. Crap, I forgot about that thing Kirk talked about at the, Tradier Summit. Oh, there's too much to remember. I don't have time. And then you give up, right? And that's it. And that's what most people do, is they give up. But the longer you wait, the wider this gap becomes, because while you're doing this, there are 10,000 traders who have already started on Option Alpha. We've helped them trade over $1.5 billion worth of contract volume. People are doing this now at scale, at a lot of scale. So if you are not there yet and you're not using this, you're starting to miss the boat. The tide is going out on you. There's a couple quick reasons why it's so important that bot trading is going to dominate. One is the collapse of latency. So the time between attaining information and that information being used to price the market is almost non-existent. And here's an example of this. This was the best example that happened. It was like a month and a half ago or so. Lyft, right? Do you guys remember what happened? So Lyft published their earnings and they had a typo in their earnings, and AI machines were reading their earnings report, read the typo incorrectly, which the typo was that they had a adjusted EBITDA margin expansion of 500 basis points, but it was a typo, literally 1-0 typo. But because AI machines were reading that and then adjusting and trading it, Lyft took off, right? And it went from $12 to $20 like that. Now, when somebody caught it, it went back down. And so now you're seeing like latency is almost zero. Like, there's no information arbitrage that you could possibly capture as a trader. And by the time it gets to you, something has already traded it and it's moved so much faster. The second thing is the explosion of choice. So more choice allows rapid movement of investment capital between markets. Now, remember, back in the day, if you're an OG trader, you used to have just monthly expiration options, right? Then they released weekly expirations. We're like, oh my God, now there's a lot more choice. Well, now they're releasing daily expirations for everything, right? So now this explosion of choice has allowed capital to very quickly move from Friday to next Thursday, and next Wednesday to 3 Saturdays from now and back, or whatever the case is, right? Like, capital can move so fast between markets that it creates a lot of volatility, and pricing is there for something and then gone. And if you're not taking advantage of it or have something that can take advantage of it, you're just missing all these opportunities all over the place, right? Here's just a chart here you can see from the OCC too, of just the absolute explosion in weekly and daily contract. It's just insane, right? Like, the number of choices that we have is insane. The other thing that we're going to start to see more of, I believe, is we're going to start to see more 24/5 trading. In fact, imagine a world of 24/7, 365 options trading. I don't know, maybe it's far off, maybe it's not too far off, but imagine if the markets eventually get to the point, and I think they will, where the options market is open all day, all night. Like, there's no reason, like, at that point, you physically can't stay up enough to watch the market. You're going to be required to have something watched just in case the world doesn't blow up overnight and crush your portfolio. So if we have this explosion of choice and we have even more access to markets around the world, 365, 24/7, it necessitates the need to have something watching for you or managing or helping out, because you just can't physically do it as a human. And the last thing here is that agility is vital. Investment agility is comprised of the flexibility of your portfolio and the ability to change entire strategies at a moment. The problem with many traders is that you are still a one-trick pony to some degree. Like, why are you still trading meme stocks, right? If that's your thing, like, it's really hard to then wait and find a better opportunity and hope you nail it, right? If you're a one-trick pony trader, it's like time is ticking for you. right? This is probably some people, it's like, you're my one and only strategy, and I just love you so much. And I get it. You understand every little intricacy that's a part of your strategy. You get every little like part of it and every little nuance and whatever. But the reality is that trucks and cars replaced horses because they were more flexible and agile. They could go places horses couldn't. They didn't require the care and the maintenance and whatever. And so you could use this chart and kind of overlay like horse trading as essentially manual traders and the automobile as bot traders and automated traders. And like, it's going to overtake them at some point. It's going to happen rather fast. And so if you're a one trick pony, I'm telling you, you're skating on thin ice. Your strategy could be here today and gone tomorrow. And here's the analogy for this. If you guys ever remember this was Volmageddon back in 2018. If you traded through this event, you remember it happening. If you didn't, you should look it up in Volmageddon. But it was a period where the VIX essentially went from 10 to upwards of, I think, like 40, 45 in about a day, right? Huge event. In that time period, XIV, which was an ETN, completely disappeared overnight. Had a market value of $2 billion the week before. Strategy that had been around for a long time in a single event was gone, disappeared. So if you have a one trick pony strategy that you're like, this strategy is working and I love this strategy, that's great. But just understand you're skating on thin ice because it could disappear overnight. Because this ETN, this XIV disappeared overnight and was worth $2 billion. And now it doesn't exist anymore, right? If you look at like other ones, like you might say to yourself, well, I could just buy and hold, or the market always goes up. Not true. And I would say that we're probably in that same paradigm right now where like it seems easy to just buy and hold, or the market always goes up. But that's what happened here. Does anybody know what this market was? If you can just add in the comments or whatever. Yeah, this was the Nikkei, right? And after that point in 1989, it took 34 years for the market to get back to the same level. Now, I'm not saying we're going to go through that exact same thing, but we could, right? Like we're so complacent to believe that markets will always do what they do here because that's what happened. And for the sake of argument, that's what happened in Japan for about 40 years, right? But until that point, about 40 years, right? And so until that point, nobody knew any different. And what if we're at the same point right now, like where we need a different strategy? We have to be able to move nimbly from strategy to strategy. And that's what you have to do. You need something that you can turn on and turn off. That if you're trading a strategy and you need to move to a new market, you can turn something off and turn something else on without having to be a one-trick pony that has to relearn everything all over the place. And that's why bots are going to be so important and will continue to dominate the options market. Remember, you have a choice here, which path you want to be on. You either want to be on the path of gaining momentum and getting on this adoption curve because it's coming, it's here, it's going faster, or you can just forget about it and you can continue to drift. And that's okay. That's your choice. But I'm telling you, the momentum curve is a lot easier to get on. It just takes one step. Just try to start to explore automated trading, bot trading moving forward. I think you'll really appreciate that in the future. So again, the path is long. It's a windy path, but I hope you guys really enjoyed it. It's a really fun one. So.
Hello, Kirk. Thank you for that, Kirk. That was awesome. Can you hear me okay?
Yeah, man.
Oh, good. Awesome. I love that presentation. It makes me think all the time. Unfortunately, we don't have any time for Q&A. I apologize for that.
That's okay. I was trying to go fast, but
I know you were. I could tell. I'm sorry. But no, we'll catch up. Some great questions out there, around your presentation. So we'll get those out to you, and maybe we can get those answered in some sort of format.
And by the way, you have great articles. So go to Option Alpha, really good stuff. And I was going to ask you about the 390 leading to the PDT rule, but we'll get to that later. That's some interesting stuff.
Thinking PDT rule.
I have a ton of questions for you, Kirk, but I can't ask them. I know
you're inventing a dating algo, right? It's automation, right? So stay tuned for
that.
God. No?
Negative.
All right, Kirk. Thanks so much. That was awesome.
Thank you so much.
Thanks, Kirk. That was really great.
Well, isn't that cool? All right, guess what? We got to get moving.
Kirk is amazing. I want to applaud that one. I love that one.
I agree.
He was really great. I was looking forward to that.
Next up, Andrew Giovinazzi. I always say his name wrong. I think I got it close that time. Andrew's a great friend as well. Andrew spent a lot of time on the trading floors like I did, some part on the Pacific Exchange out in San Francisco, a little bit in Chicago, worked for Group 1. So he's got a lot of market making background. He is now with Option Pit with another couple great friends of mine, Mark Sebastian and Leisha Leslie. And Leisha's on your panel later, which is awesome. Let's get right to Andrew because he's going to talk about the VIX and volatility and all kinds of good stuff. So Andrew, you're up next, baby. Let's do it.
I'm here. Oh, I think while I'm in it, let me present my screen really fast. How is everybody doing? Hopefully okay. Okay. Present screen. Can I share my screen? There we go. All right. Hopefully you guys, can you guys see that okay? Oh, good. All right. And I'm going to do this here and try to make it a little bit more organized than it is. Give me 1 second. And there we go. And up, I'm moving. All right. Hey, I got it. All right. Hello. Yes. Andrew, Joe, let me get rid of this. I have to follow that last presentation, which was pretty good. So what I'm going to do here is just walk you through how I trade VIX. I don't trade the VIX futures. I trade the options. And again, like Lex said, I was a market maker on the CBOE and P-Coast. I didn't learn anything about VIX until after I was a floor trader. So I was a floor trader for 15 years, moved to Maine like almost 20 years ago. And I kind of been on this rock teaching retail traders how to trade options now with Mark for about 11 or 12 years. So let's get into it. So I'm going to talk about VIX futures here. This is going to be kind of an educational thing. This is like basic understanding on how to trade or how the VIX futures work and then how I use them. And at the end, I'm going to talk a little bit about, I think the VIX curve is probably the best market information. And then I'm like, if I have like 5 minutes toward the end here, because I went on 11:20, now I'm looking at the time. I'll try to do a little freewheel on when I look at the vol curve, what I get from it. So one thing I think I try to teach my students at Option Pit is you take all the market information that you can that is available to you. So the VIX futures curve gives a lot of information. I'm going to talk about contango and backwardation, those goofy terms, concept at Option Pit. And I think it's used around other like vol gravity, how the futures work, what you expect on how they trade. And what I call the easy direction, where I think you can have an opinion, but VIX wants to move. The VIX futures want to move the way they're going to move. So you got to understand how that is. And also degrees of backwardation. So basically how unhinged the market gets, you get a signal from the VIX futures. And if you understand how the market's going to trade, then in my mind, it changes the way you put positions on, right? You basically don't want to walk into a buzzsaw. So the first thing is this is not a complete list, but this is a list of products that I use that trade from the VIX futures. So the first thing is, what ETFs use the VIX futures as an underlying. So one of the misconceptions I think people get is, they call it the fear gauge and all this other kind of stuff. Really, all the volatility products trade off of the futures because the futures in the makeup of the product. So VXX, UVXY, those are two long vol products. SVXY is a short vol product. And then the options that trade off those. The VIX future is the thing that moves those contracts. Now, VIX does move, and it does move the futures for sure. But in order to see how those contracts are going to move, you have to see what the VIX futures are doing. So understanding how to trade VIX options, you have to get a sense of how the futures are going to move. So that's kind of what we're going to discuss here. Now, the product that uses VIX cash as an underlying 1 day per week. So the VIX cash only really becomes the underlying on settlement. It is an indicator of where the futures are going, right? Futures moving toward the cash VIX. But all of the options are going to trade off of the future, not the cash. They're only going to trade off the cash 1 day a week. So when you're looking at how the things are trading, you have to keep that in mind. Like where you think VIX could go is one thing. It's actually how the futures are going to move during that time that matter, not necessarily just what you think VIX is going to do. So what I do is the first thing you have to do is like read a vol chart. Now this is a very old one. So in order to make trading VIX easy, right, which I don't know if it's easy, but to make it easy, you have to understand first what the futures are and then what the VIX cash is. So this is VIXCentral.com. Anybody can go to this website. It has delayed data from the SIBO. It works perfectly fine if you just want to get, especially for this kind of analysis. So the key thing is the green line is VIX 978. So for all of you right now that have lived through higher vol, VIX has been much lower than this over the last 10 years. Like in 2017, we spent so much time in the 12 handle and below, it was crazy. So, but right now, what you can see is the VIX futures are stacked on top, right? In this period of time, all these VIX futures are higher. And what we call VIX future premium is the distance between whatever the VIX futures are and whatever the cash is. This whole curve here, these are all settlement dates for VIX futures. In this case, what I would say is they're sloping upward from left to right. Right? So the back month is higher than the front month. So what happens is over time, there's a gravitational pull for the VIX futures to go to cash. So when again, like a sample thing, when I was a floor trader, and maybe Lex remembers this, but you trade and you go home and the vols that you put in to the machines, like to our Quotrons and stuff, boy, I'm dating myself. But anyway, you adjusted vols during the day. And then the next day, the vols were the same unless we changed them. So my general approach to trading VIX is it's going to stay where it is until there's a reason for it to move. So when I'm looking at putting on a position, can my position make money if VIX stays where it is? So again, that sounds like that's a topic maybe for discussion, but that's how I start a lot or most of my vol trades. Now, so again, the secret of trading VIX is making money from the cash to the future, or the future to the cash. So anything you do in VIX ultimately is going to be a function of how the futures are moving around. And they're going to move around a certain amount. So those futures are going to drift down to the cash number. Now, VIX can move up. They can move up into the futures, up and over the futures. But during the normal course of the day, VIX grinding down to the cash price is pretty normal. Like it's going to decay just like an option is going to decay. Now, when volatility goes up, options stop decaying, right? It's the same thing with VIX. The futures stop going down, stop decaying down as soon as VIX cash starts going up. So understanding that basic dynamic is going to help you trade VIX. Because if you're focused just on what the cash is doing, you're going to miss out on all of the products and all of the options and everything else that are connected to the future. So you have to start to understand the dynamic between the futures and the cash, and that's what we're going to do. We're gonna start to make sense of it, right? So, right, it's kind of like making sense of how the VIX cash is, right? You think about it like SPX is a cash trade. So again, VIX is a cash index and SPX is a cash index. Now, the problem is if you want to trade, like if you want to sell options in SPX, right, to sell volatility, right, the credit spreads and iron condors and all that and butterflies and stuff like that, the problem is path dependency. And path dependency is just like, okay, the market moves too much. So it's not that your iron condor, let's say, wasn't priced right. It's just SPX decided to go straight up for 2 weeks and blew through the top of your iron condor. You were right on the volatility going down, but your trade lost money because SPX moved basically out of your risk tent. So if you want to trade VIX or volatility as a direction, that's why people like VIX. So you can say, I think SPX volatility is too high. In the old days, right, when I was a trader, we would sell all the options around VIX, all the out-of-money calls, puts, whatever, wait for the vol to collapse. Now you can just buy a put, let's say in VIX, and ride the volatility down and not be so stuck with the path dependency in SPX. That's another reason why I like trading the product, because you don't have as much management to do. It's not easy, right, to trade VIX, I should say, even though this is really an easy VIX presentation, but you don't have sort of the same path dependency issues that you do with SPX if you want to sell vol, right? You could just buy puts in VIX and, right, watch the futures drop and make your money on the puts. Again, if you want to learn more about trading iron condors and flies and all that advanced stuff, you can go to Option Pit. We teach our students how to do that all the time. So your VIX trade is a direction in volatility futures. All right. Now, the idea here is SPX is going to do what it's going to do, but the volatility in the SPX is mostly going to be anti-correlated. So SPX goes up and volatility VIX should go down most of the time. So, or if SPX goes down, VIX should be going up most of the time. So you have generally, right, you could call it like a non-correlated asset, right? Meaning SPX is going to go up or down and the VIX, right, should move a little differently, right? And move generally the opposite. So sometimes, right, when the market is doing all kinds of crazy stuff, like the fact that VIX is going up and rising in value is one of the few assets, like gold isn't, bonds aren't, whatever, but VIX actually, you get some performance out of it. And then, and you can recall like in 2020, when VIX went to 100 because of COVID, like the vol products, like a UVXY, all those products, had their moment in the sun, right, where they went flying higher. So trading it is learning how to trade sort of a non-correlated thing, non-correlated asset. So what is normal? So normal is a contango curve. Now, this funky looking equation, right, is the forward volatility equation. And all this equation means is when implied vol is lower in the front in a slow market and higher in the back, it's going to produce higher forward volatilities. And if you have higher forward volatilities, the VIX futures curve is just a forward volatility curve. So all those futures are going to be higher in the future, the lower volatility is in the short term. So when the market's not moving very much and implied volatilities like they're doing actually currently into this NVIDIA earnings, right? So the market's not moving much, realized vol is pretty low, implied vols are super low in the front. Those are going to produce higher forward vols, and the futures are going to price higher according to this equation, right? So T1 is just a short-term vol. T2 is the back-term vol. So you can see in the equation, the lower T1 goes, the higher the forward vol is going to end up going for the equation. So anyway, so VIX, right? So future prices should be higher under normal circumstances, meaning VIX futures in the future are going to be higher under normal circumstances. This is another reason traders like selling volatility. And the idea is how selling volatility with VIX options, you could either sell the calls, right? Because there's call skew, they're generally expensive, or you can do a lower risk put purchase, either one. But you always, for the most part, when volatility is low in the front, you are getting, right? You are getting higher future prices that you can sell. I don't know if I would call it like the vol risk premium that everybody talks about. I guess you could loosely. But in general, insurance is priced more expensively in the future, right? Not less. So what that gives you is, right, that gives you some opportunities. Now, also VIX moves a certain way. VIX cash moves like few products do. I think, to be honest, it's unique. It's a volatility product. It is not something that Black-Scholes assumed that had a normal log normal distribution as far as, kind of paying a dividend and going up every year. VIX moves like volatility, what they call reverting, kind of up and down. So it moves differently. It goes up for a while, right? Tends to crash up. And then it melts down, not quite as fast as it goes up. Usually just think of it this way. It's like, it's basically like a match, on gasoline, and then it takes a little while to put out the fire. So VIX tends to go up quicker. Now, VIX futures tend to move on a delta to the cash. So a general rule of thumb is the 30-day future will move around 50% of the cash price when we're in contango. And remember, because those futures are already priced higher, VIX can have a little move, and you won't get as much of a move in general out of the future. So when you see people saying, oh, VIX has moved a ton, VIX has moved a ton, but you're not getting huge immediate performance out of your trade. Let's say you bought some calls. It's because there is a delta to that future, a 30-day future. Now, these are general notes. Again, we teach this in some of our courses at Option Pit, probably now in Trading Desk and Weekly Profit Cycles and in Pro, stuff like that. But what I want you to notice here on this screen is that VIX cash is moving, right, up. But all of the futures that I have circled there are moving at different speeds, basically. So what you can see here is you have a move in VIX cash. The 29-day future covers about 50% of the move, right? The one-day future is covering around 90% of the cash move. And then again, the difference between the 1 day and the 30-day is about 10% per week. So basically, if a 1-day future is moving around 90%, an 8-day future around 80, then 70, then 60, then 50. So you think of it basically, 30 days out, you have a 50% move, 3 weeks in around 60. So what it does is the futures move kind of, this is roughly, not exactly, but roughly on that ratio. When you have a couple of days to go, the future is, like I said, will move around 90%. With 30 days to go, the future is only going to move around 50%. So if you're trading it, you have to have an idea of how much your underlying is going to move if VIX moves. Again, these are approximate, okay? They're rarely exactly this, but in contango, right, generally like this. And remember, contango is just that upward sloping curve from left to right. So how I trade or create VIX trades is I think of it two ways. You have a shock trade or an erosion trade. A shock trade is basically when I think VIX is gonna fly. Okay, so I think the cash is going to jump higher, or I think the cash is going to ride lower, sharply. And I'm going to pick a different strategy than if I just think that the future is going to erode down to the cash over time, or the future erodes up to the cash over time. So you have kind of two speeds. So VIX itself as an underlying cruises at two different speeds. So the futures will erode every day, right? But they also can move in a shock when VIX moves hard. So the first thing in my head is I have to decide what kind of move I'm going to get out of VIX. What is vol going to do? Again, spending my whole life as a floor trader, basically, or my pre-option pit life as a floor trader, all we did was trade volatility anyway. So it's not too big of a stretch for me to trade it now. So this sets up, again, basic strategy, shock or erosion. So when do I want to trade for shock? When do I want to trade for erosion? So you got two speeds, right? Shock speed, erosion speed. So a shock is when the VIX cash moves so fast that it'll actually pull the futures out of their current shape. That's when you can make money, let's say buying calls in VIX. When VIX spikes, it rips the futures higher and they're moving enough for you to make real money. 2020 is a great example of, VIX continually going up and up and up and shocking up. Then it spent the next 4 or 5 months sort of coming back to earth, slowly but surely, down to the 50s, then the 40s, then the 30s, then the 20s, and, slowly but surely. Okay. Erosion tends to take some time to happen. Basically, if VIX doesn't do anything, what are the futures going to? The futures will gravitate toward that cash number. So I always think of this as the futures always move to the cash. Now here, again, we're focusing on which way things are going. So now when we look at a contango curve again and what vol gravity is, and then my students always ask me, what's moving, like the VIX or the futures? Well, the futures are always moving to the cash. Okay, always moving to the cash. So the easy direction in this case is down. So again, you're looking at the cash here is 1190. All these futures are in, 14, 13, whatever, all the way up. The easy direction will always be down. Right. So there's a lot of folks that, buy puts in the vol products like UVXY and stuff like that, or buy calls in SVXY. It's because that decay, that gravitational pull, right, is changing the value of all those contracts, right? Because they all own VIX. VIX slides, UVXY goes down, SVXY goes up. So again, the vol gravity tells you where the futures are going to go till expiration. So unless something in the market changes, the futures go to the cash. Like literally, if I go 30 days from now and VIX is 1190, that near-term future will be 1190. Okay. Now, something different. Okay. VIX in backwardation. This is a totally different curve. So you have VIX trading 23, almost 24. And here the futures are all underneath the curve. Again, via the forward vol calculation that I gave you earlier. Again, don't have the whole, we only have 40 minutes here, so I can't work through all the numbers and everything, but just trust me, that's kind of how it works. So what's going on is every day that goes by, as long as VIX stays at a 23.57, all of these futures are now going to rise up to the cash. So again, changes how I strategize, right? What is the way, right? What is the way volatility is going to go, right? The futures are going to keep moving up to the cash. Now you're saying, Andrew, what if VIX doesn't stay at 23.57? Well, it can't. So, but I changed the structure of my trade slightly because I know day after day, as long as the conditions are the same, whatever made VIX go up there, until that changes, right? Until that thing changes, VIX will not come back down again. Now it might change tomorrow. But in the short term, the gravitational pull is upward. So, call spreads, call butterflies, stuff like that, right? Remember, the underlying price is very low relative to where the cash is. So instead of me paying $24 for an underlying, if I'm buying calls, I'm only paying $21.87 if I'm trading an option with 60 days to expiration. I'm only paying $22.27, or like almost $2 below cash. So calls trade low. So if you stay in any kind of a vol event, right, the futures start moving up toward the cash, it makes calls relatively inexpensive. So this is kind of one of the odd things about VIX. When you're in backwardation, calls and call spreads, call butterflies, things like that trade cheaper because the underlying is so low. When you're in contango, it's the opposite. Your underlying price is relatively high because the VIX future is so far above the cash. And then all the puts tend to trade inexpensively. So you work your trade, right, depending on sort of where the easy direction is going. At least that's what I teach my students. It tends to work pretty well. So most successful, again, in my opinion, successful VIX trading is based on vol gravity. So you can be one of those traders that says, okay, VIX is 12. It ain't going to stay here, and I'm going to buy calls and sell puts. I'll do a risk reversal until vol goes up again. And that could work. Okay. That could totally work. The problem is, we could stay at a 12 for a while. We might, right? Vol might not get off the mat, and then your risk reversals basically gets smoked. You don't make any money on them. It doesn't, right? So you could trade VIX cash like that for sure, and you're trading the futures, but the gravity part is not going to go away. So when you're in contango, remember, if you're buying calls, you're always spending more money on those calls. Right? Doesn't mean they can't make money, but you are starting paying more money from the get-go. All right, I only got a couple more minutes left, I think, according to my calculations. So remember, your futures are the underlying for the options, and you have to figure out the easy direction, the gravitational pull first to start your position. So when you walk into backwardation, okay, you know that things should be lifting up unless VIX does something drastically different. Same with contango. So, right? So the degrees, the next part is your degrees of contango or backwardation will show market sentiment. So I got like 3 minutes left, I think, till Lex pops in. Again, my rule is this: IV stays the same until it has a reason to change. Now, people can disagree with me all you want, but that is my assumption when I trade vol. I just have to make sure that my position makes money if implied vol stays the same. Will I make money, right? If the realized vol stays the same, will I make money? Again, if all these concepts are foreign to you, stop by Option Pit. Again, this is what 15 years of market making taught me, right? That's what it is. So it's the tendency of implied volatility to move to the realized vol. Okay, that is a long-term tendency. Realized vol is just how the underlying market is moving. It doesn't always do it instantly, but it's a strong gravitational pull. So VIX futures generally go to the cash. Okay, because remember, they're going to expire into cash. So this gives you like a little flavor, right? So when the VIX cash is the black line, our green line, what I call slight backwardation. Slight backwardation. Meaning the market is getting a little bit jiggy. Okay. The second, right, let's say second term you see here is now your tip is pointing up, but more of the back term is relatively low. The green curve is still almost, you could say it's a contango looking curve, but VIX cash is relatively high. So the market is starting to pick up momentum. As soon as the front of the curve gets higher than the rest of the options, then again, I would call medium backwardation. And everything is, the market is definitely starting to freak out. The last one here is when we're in what I would call total backwardation. Total backwardation, meaning VIX cash and every term behind it, VIX cash is the highest, And then every short-term future is above every long-term future. That's when the market is totally unhinged and you expect, SPX to basically do anything. You can move 1.5 to 2% per day in the underlying. So the shape of the curve, again, we go more into this in detail on Option Pit. This is a very short presentation. But what I'm showing you is the fact that you have those VIX curves changes shape. The market is telling you expect a certain speed out of SPX. And once you learn how to do that and do it relatively well, it helps you position if you want to trade SPX, you want to trade equities. And it makes life a lot easier, at least in my view. Okay. Now, a couple of things. Zone one, and this is sort of a Option Pit thing, but whatever, we break VIX down into quartiles. Zone 1 is 9 to 13. Zone 2 is 1301 to 1799. VIX spends 50% of its time below 18 and 50% of its time above 18, right? Actually, so this is data that I looked at years ago. It's roughly still about the same, even though we've had higher vol recently. Zone 3 is 1801 or 18 to about 2399. In zone 4, the last quartile is 24 and above for VIX. So when you go back to this curve, right, these numbers here roughly coincide with where VIX cash is. So the green curve, orange curve, and red curve, right, when you're in zone 4, that's super high vol, danger zone. Zone 3, you have like mid volatility. The market is just kind of getting moving. Zone 2, that green curve, is when all of a sudden VIX just pops because the market does something, but we don't get out of, the shape of the curve doesn't change very much. What you're getting is just all of a sudden vols in the short-term pop in SPX. Zone 1, where we spend most of our time, right, 9 to 13, is that contango curve where you have volatility very low in the front and volatility's higher in the back, produces that contango curve. So what I'm saying is, like, the nature of the backwardation you see when I set up vol trades, let's say in trading desk, is it's very curve based, meaning we're in zone 1, 75% of VIX is higher. All right. When you're in zone 4, 75% of VIX is lower. So when you're trying to set up trades like that, you're sort of leaning in a certain way based on where you are in the zone. So you have a couple of things when you think about setting a trade up, right? What the curve shape is, what zone we're in, right? And what direction vol has just gone. Now, so what I do is, like, if you want to trade VIX options, again, this is how I trade them. You can trade them any way you want. But what I do is, you want to start, right, with the degree of contango or backwardation that you see. Like, how steeply pointing down are we? How steeply pointing up are we for backwardation? That does is that gives you like a kind of an idea of velocity of the market. Again, if these terms are foreign to you, sorry, but I'm trying to, use terms that people can understand, especially if you're new to VIX or volatility. Again, setting up the direction, right? The next thing is pricing the easy direction. Is where is the future moving to? And then the next thing is I pick duration, again, based on where we are, creating the right position for the term, and then estimating the risk and payout of whatever trade that we see. Like, does it look like a good enough trade? And ultimately, when you go through, right, your process, right, this is my process for trading VIX. What that does is it helps me put on a particular type of trade. And I think, yep. And then we're at the end, right? So I think, I guess, Lex will be coming in here in a minute or two. So what I want to just point out is just, okay, if you have a live curve today, what are you doing with the live curve today? Let's see. So VIX futures term. So when I look at this curve, so you're like, you see this funky kink here, first off, right? That is just the election. The market is pricing election madness, and it's not going away for right now. So I look at that as kind of an outlier. Another thing too is I don't like trading a lot of VIX over 60 days. The reason why is the futures at such a high premium to the cash, when you're going farther out, they don't move very much. So one thing you'll notice is all the volatilities of VIX options, the farther you go out in time, is actually less. It actually works opposite than regular equities and index options do. Because the future premium is so high, like they don't move, basically. So if you want action in VIX, all the action is basically 30 days and some 60 day. I don't see a ton of action past that. Doesn't mean you can't put on like a Vegas centric trade or something, but I don't trade it because it doesn't move enough for me to care. So right now you have VIX is trading 1356, the June contract, and the July contract is 1443, trading well above where the cash is. So that means VIX puts are relatively inexpensive. Like right now, so personally, right, I'm buying 14 puts and I'm spending just like tiny amounts of money to hedge that position because I'm basically waiting for the puts to pay me pretty decent money, should pay for whatever the hedge is. And then, but basically the easy direction for me is down. As low as VIX is, I plan for the vol futures to keep going down. And then I hedge for what I don't expect to happen. Meaning that we have some event, like maybe the NVIDIA earnings are terrible, who knows? And we drop to 5,000. I don't know, it could happen, right? But I generally hedge for what I don't, what I don't expect, but I'm going to trade for what I do expect and what I see in front of me. So when I'm looking at vol futures where they're currently priced, I see them slowly moving down to the cash. So I'm going to set all my positions up, or most of them anyway, right? Short vol by buying puts. And then I see what happens. I basically turn it on and let the music play. And with that, I think I'm kind of done. I don't know, Lex, if that's 40 minutes, but that's sort of how I see what the market is right now, and how I'm trading it, which is basically just buying a bunch of VIX puts and hedging. And I guess there was a couple questions. Doesn't look like many.
It seems like you have your followers in tow here. AG. I just realized that they call you AG.
Yeah. Well, it's Andrew Giovinazzi is a whole lot of
I'm used to a lot of letters with my name.
A lot of vowels.
Yeah.
You have a very nice background, Lex. I like your cherry. The whole thing you got going on there is quite nice.
Thank you. That's a Boda jacket, by the way. Someone just said, "Hey, I love your Boda jacket in the background."
Oh my gosh, it's been a while. I just had to think about that. That takes me back like 25 years.
That's right. That's right. Yeah, we have time for a couple quick questions, if that's okay. So, what's the highest VIX cash reading you've ever lived through? And you were here for 2008. I know that. Were you here for 87? And I know 87.
No, I was still in college for 87.
Okay.
So I didn't see that number. I didn't get on until 89. And
okay.
That was, I think, and there was really no VIX then. I guess what index vol and OEX must have gone sky high. So I think that just recently it was just what was it 95, 99 or something in 2020, I think.
Yep.
It got pretty up there.
I can't remember what 2008 did either for the flash crash. I think it was pretty good there as well.
Right. It had it like instant, and it was instant vol, and then it went away kind of, right? So you had like the spike and then gone.
Yep. Now real quickly, can people use your analysis of VIX to overlay it in other parts of the market? Apple, Tesla, obviously SPX you can, I get that. But anywhere else they can they can use this analysis to sort of position themselves accordingly?
Yeah, I mean, so I basically use VIX puts as like something to pay the rent. So let's say I think the mark if you think Apple's going up, when vol is relatively low, like I'll buy Apple strangles and VIX puts against it. So that is just a straight trade because I basically think, if Apple's going up, it's kind of, semi-index anyway.
Right.
But if things kind of die a little bit and we lose momentum, then I expect the VIX puts to pay. So you can use it as like right now, if you're expecting the market to crash, it can, but there's vol traders are not looking for that, right? There's vol's at a, basically low of the year. Nobody is expecting it. And, doesn't mean it can't happen, but I wouldn't spend a ton of money buying SPY puts right now. Or I wouldn't spend money buying Q puts just because that's the condition that we have. We just have a low vol. So
right. Okay.
It's not something. So I use it that way for individual equities. I think it's hard, but I would use the product to pay for equity juice.
I got you. That makes sense. Yeah. And one last one here before we have to run. So you showed us that dimple around election time, right? In the VIX curve, the contango curve, I think it was. Are you at all? Do you think the markets and the VIX curve are underestimating the geopolitical risks that lie out there? Seems to me that it is potentially. I know the dimple's there for an obvious reason, but I think even before that, there's some geopolitical sort of risk that kind of wafts over this whole market. And I'm wondering, if it's underpricing it.
Well, I mean, so everybody knows the world is crazy, right? Just in general. So but the market has rallied in a crazy world for hundreds of years, right?
Yep.
The problem is when the geopolitical risk, I think, becomes uncertain. So right now, or it's like there's a new wrinkle. So we kind of know the current wrinkles. So all current information is in the VIX curve. It's when you have the new wrinkle, like something happens to Putin or Z or like something kind of out of left field, like Iran sending the missiles into Israel like a month ago. Like that was kind of like, and then VIX goes instantly parabolic. So then that's what I say. Vol will stay the same until there's a reason to change. Like when missiles fly, VIX goes parabolic. And then if it's not terrible, then it all comes back down again, like instantly. So I think part of that is like basically the vol is ready. There's upside skew in the options. So they're pricing the crazy. It's just not necessarily happening right now, I guess you could say.
Okay, good enough. All right, well, thanks, Andrew, for that. That was great. Mal, you have a quick one? We got to get rolling.
Yeah, I was just going to say, I always wonder if the Fed is watching the VIX to see what kind of pressure they can put on the market. I know they shouldn't be, but I'm always wondering. And then I wanted to see, we have elections coming up. What do you think? How is that going to...
Who's going to win or what's it going to do to the VIX?
No, what is it going to do to the VIX?
I think going into the election is going to spike for sure.
Yeah.
Like 100%. I think we'll probably see prior with a week before, 2 weeks before, like a 30 vol, a 30 VIX.
Okay,
I think people are just going to be.
Do that.
I mean, you think about what happened the last time. It was not, we were in the mid 20s, and I think if anything, it's worse.
Yeah.
And you have such great discipline. You have such an amazing history as a market maker. If we're going to show some of the videos that you guys, the two of you went through, it's incredible. But market correction, do you expect something to happen? Or is something coming our way? And before market corrections, how does the VIX perform usually? Is there a lull? Is it a gradual spike?
The first thing is like you see the curve flatten. Like that's step one, sort of. So you generally will see that somewhat first. Or you also see like some disconnected movement, like SPX is going up aggressively and VIX is starting to go up aggressively as well. Like they're almost moving up together.
Yeah.
Okay.
That's always something is goofy there. You can have some like small moves, but if you're going like a week or 2 weeks when SPX and VIX are literally going up together, everybody's like, they don't quite know. They don't like the rally. Like Main Street is buying stocks, but the traders are like freaking out, and that's generally kind of
Right.
why
Right.
that is. So
I
if
was
you
just
see
gonna say
that
that.
would be like scaredy time,
Yeah, and the last thing I'm going to say is Vol Gravity sounds like a really good cocktail you drink while doing the contango. I'm just going to say that.
Leave it to Molly.
See,
Right?
I was about
How
to
do you
say,
respond?
I've only been saying that crap for 10 years and never thought of anything that clever. Not even close.
That's awesome. All right, Andrew, great to see you as always.
Thanks.
We'll catch up later. Optionpit.com, right? And then you guys do a Friday show on the Hub
We do.
early in the
Yep.
morning. So make sure you catch that too. Go to hub.tradier.com to see that. Andrew, thanks for coming, buddy. Have a great rest of the week.
Thanks,
All right,
Andrew.
Thanks a lot, Lex.
All
Nice
right.
meeting you. Bye-bye.
Next up, Mal, we have a trading champion, Mr. Rob Hoffman of Wealth Charts. The bio says 32-time domestic and international trading champion. However, I think he just won number 33. We're going to let him tell us that.
He's won more awards than Phelps.
That's a good point. More gold medals. That's a good
Right.
point. So we're going to get right to him so we don't cut off any of his time here. Rob's going to show us some things on the wealth charts, I'm sure, and some great setups. So let's let Rob take it away from here.
Hey, everybody. Can you see me all right there? Oh, let's see if we can share the screen. All right. Let's see. I don't hear Lex and Molly. Let's see, guys. I see people saying hi, so I guess you can hear me okay. Lex, Molly, I apologize. For some reason, I can't hear you. I did the audio test a little bit ago with the gang, so I'm in the show, ready to go. Boy, I'd love to be able to talk to Lex and Molly because Dan, Lex, Molly did a great job. Can't wait to be with them at Wealth 365. Kirk and Andrew both did a great job. It's gonna be a wonderful event. So, unfortunately, I can't hear or see them at all. My apologies. But I guess what I'll just do is get going. And of course, Lex, if you want to give me a call on my phone, because I know you've been talking with the other group there, so I'm not sure what's happening, but I've completely lost you for some reason. So well, I tell you what, gang, if the audience can just there's Molly.
Hello. Sorry,
Hi.
you were supposed to come on solo, but we're going to crash the party. So we're going to grab Lex to come back in.
Okay.
So I'm a big fan, so good to see you.
It's great to see you, Molly, and I can't wait to be with you at the upcoming Wealth 365 Summit. That was such a huge blast together that we had with you and Lex and everything else. No, I didn't know if you guys were going to come in and originally do an introduction or so, or anything that you wanted to say. So I'm ready to get going. It's nice to see both of you, and I said great job to both of you so far today. And of course, Dan doing his intro about what's coming to Tradier, very exciting. And Andrew and Kirk both did a phenomenal job. So you got a great lineup of people today, and I'm ready to get into strategy. In fact, one that I used to help me win the competition last week, the Champions Cup.
Congratulations.
Yeah, that's great, Rob. Congratulations. So here's what's going to happen. Molly and I are going to disappear. It's your show for the next 40-ish minutes, and we will come back in and have a few questions at the latter part. How's that sound?
No, that's great. That's great.
Yeah, we might prank call you on your phone and tease you on all of your devices.
All right.
But other than that, we'll be off the screen.
That sounds great. All right, guys.
Go to it, Rob. We'll see you in about 40.
But what's that?
We'll see you in about 40 minutes. We'll come back on about 40.
You got it. I'll go ahead and take the screen here then. You should be able to see the screen. Wonderful. All right. So with that, I want to get right into it here today. What I want to focus on is just actionable strategies. And this will apply to futures, options, individual equities. Whether you're looking at 0DT options, you're looking at futures trading, or you're looking at daily or weekly charts of options. So this strategy, it's just going to be focused on teaching you a strategy today that you can take away, across the board there. So I know I've got a limited amount of time, so I'm going to really kind of go through things, and hopefully we'll have time for some questions at the end. Okay. So just a reminder, though, trading does involve risk, not just reward. I'm sure because it's a wonderful brokerage event, they'll remind you of those things too. But I like to do that as well, right? Because when I follow my rules, I tend to do really well and neat things, and when I don't, bad things can happen. So there's always risk there. And then if you're trading hypothetically, those have inherent risks. My trading was live with real money in the trading competition there last week. And of course, options. There's all of these great places you can go to learn more about individual option strategies, risks, and that, because a lot of the great speakers are teaching different types of strategies here. And we may talk about some if we have time here today. So the thing is that I've been around the markets for many years here. So it's not my first day, my first rodeo. And I've been since about 2011 doing these real money competitions around the world. So it's really exciting, kind of put it out there against man and machine alike. And some of these are pretty intense when you get a lot of these traders from around the world representing their countries. And I was fortunate to win that Champions Cup last week in Rimini, Italy. So that was exciting. I don't have all the new photos yet because photographers take a little bit of time to get them to us, but this was last year in Italy. And it was very exciting, to be able to teach the audience and bring home some awards and have the judges kind of, checking things out there. So in the end, before we get into the actual strategy here, why it matters is this is why it matters for me. My lovely bride, Sarah, we've been together now for over 15 years. I've got Logan and Mackenzie here, and they're my wonderful kids. And I love representing the United States in these international trading competitions there. So I got the little U.S. flag in front of me. And whether it's trading against these other, wonderful people, this guy almost looks like Kurt a little bit there. It wasn't, but Kurt did a great job earlier. And but we, speaking of, automated, I've even done trading against automated systems and algorithms like Maurizio went ahead and was using during one of our trading competitions. So it's great to go and be able to test my abilities at all times, and have been doing that for quite a while. And then the reason why I do all this craziness is for these lovely people you see on the pictures right there. So with that being said, let's get right into the strategy. And again, whether you're a day trader of futures, your zero DT options trader, or your swing trader of options, this is going to be appropriate for you. I did use it last week in the futures trading, actually using my Tradier futures platform there. So that was pretty exciting. We'll take a look at that in a few minutes as well. So let's talk about this strategy first. We're going to talk about the IRB and the reverse IRB strategies. So what is it? The IRB strategy, I'm going to explain it, and then we're going to look at a lot of pictures and a lot of live charts. So what is it? It's a price action based trend continuation trade. And I wanted to have things that would work with other people's strategies that we're talking here today. So Kirk with the bot trading, with Andrew and volatility trading. You can apply these different things that you're going to learn from them. Bob and Luis and the gang today that will be coming up. So I feel as this is an addition, not a you have to pick one or the other kind of strategy. All right, these things can be used together with the other things that you learn from the great speakers today. So it's a price action based trend continuation trade. It's most effective in trendy markets, and it can be amplified even by strong fundamental analysis. So that's kind of like techno fundamentalism, if you will. That's not a requirement, but of course, when you got a great fundamental story and you got a great technical story, that can lead to some long-term opportunities. The reviewing this, what I'm looking at is over the last 20 periods. For the signal bars, where the open and the close are approximately 45% or more off their high in an uptrend or low in a downtrend. So think about the rule of 45 there. Now you'll notice it says 20 periods. The reason why it's so important is if I'm day trading futures or I'm zero DT options trading, that might be a 1 minute, 5 minute chart, for instance. If I'm looking at daily or weekly charts, that's going to be 20 days or 20 weeks or more of data that I'm looking at. So that's why it says 20 periods. So what I'm looking at is typically entering these signal bars that we've just talked about. Typically 1 tick, 1 cent, 1 pip, doesn't matter because you can use the strategy of Forex as well, even though we won't be focusing on that today. The crypto as well. I know there's some crypto questions earlier in one of the presentations. I think it was Dan's presentation asking about crypto. So can be used with crypto as well. In fact, I was trading against the guy who was trading crypto last week as well and during the competition. So the exit is typically a trailing a profit stop or at the next key support resistance level for the exit. And the stop loss is typically 1 cent, 1 pip, 1 cent below the opposite side of the signal bar or predetermined loss value. And of course, with options, you have even more options, all pun intended. So a couple things to remember: the rocket fuel, the concept of rocket fuel. If it moves too far too quickly, so like the current bar is typically 2 to 3 times the size of the last few bars before it, that might have used up too much rocket fuel. It has diverse applications across different types of instruments like we've been talking about. And of course, time frames. Cannot emphasize that enough. Like I said, I was using it for day trading futures last week, but as we're going to talk about a lot today with the options side of it, has really neat applications across the board. And then trail the entries to reduce the risk of reversion to the mean, and trade in the direction of basically your favorite trend trading strategies. Okay. Wealth Charts has a lot of them in there. And of course, you can build your own with Wealth Charts there. So we're not going to be focusing on Wealth Charts so much today, other than, Tradier has incredible connectivity with Wealth Charts. They got the wonderful futures integration here. So I'm excited when they launch the big launch. But of course, we already have futures available for you today with Wealth Charts and Tradier. So pretty exciting. That's what I used again last week. So looking now at these strategies. So in a downtrend, what I'm looking for is bars that are 45% or more off their lows in a downtrend. And you can see each one of these bars is at least 45% or more off the low. Now, where I'm looking to enter the trade is 1 tick, 1 cent, 1 pip below the low of that bar. Okay. And the stop loss is typically 1 tick, 1 cent, 1 pip above the high of that bar. Again, with options, you got even more opportunities. But just looking at it individually, like from a futures trading perspective, which a lot of you guys are going to start futures trading as well very soon. So the one thing to note, you'll notice the size of this bar. Now, because remember, the entry is down here. That means in this case, it's got to go from way up here all the way back down here before the entry. Well, if that bar is, the last couple bars before it, let's say were this size, right? Well, now look, it almost these last 3 bars can fit into the size of this. Then that's too much rocket fuel. And then this is one I'd rather pass, right? And that's why I wanted to share that with you. And as we get into lots of examples here on live charts in a few minutes, this will make even more sense. But there's certain ones like this that I like to stay away from, because these can actually be short-term bottoms in the market. So, but you'll notice this is 4 individual examples. This is not a pattern, even though you will see sometimes multiple IRBs side by side or back to back. But these are, so it doesn't matter whether it's a small red, a bigger green. Again, it's another type of small red, a medium green. It doesn't matter. What matters is it's at least 45% or more, in this case, off the low in the downtrend. Now, the key thing to note here is it's officially 45%, but some people are like, well, I don't know, is that quite 45% or not? Obviously, on things like Wealth Charts, we've automated that. But if you don't have that and you're just looking at this on your own application, just kind of eyeball it. Is it 50% or more wick off of the low? And you can see here that is clearly 50% or more wick, right? So and then this one here is like 90+% wick, right? So then in an uptrend, what we're looking for is just the opposite. In an uptrend, we're looking for 45% or more off the high should be wick. All right. Now, there's a lot of strategy and psychology. And if we had more than 40 minutes, I'd love to discuss every nook and cranny of it so you understand it. But what I want you to think about is this psychologically for a moment. How many of you have gone ahead and you were in an uptrend and you're thinking, I'm going to go and put on my favorite, long side option strategy. I'm going to put on my favorite, futures trade. But then the market starts to pull back and you say, whoa, I'm not going to take that trade. Boy, every time I do this, I get into a loss or whatever, the market turns around and goes against me. So you see the market start to pull back, type in a number 1 if this is you, because if you are the kind of person that you start to see it pull back, so you avoid the trade only to watch it a few minutes, a few hours, a few days, a few weeks, depending on the time frame you're trading, you watch it go right back the way it was going to go. And you're like, I knew it was going to do that, but they spooked you out of the market. You didn't get the trade because it short-term pulled back against the direction you were looking for it to go. So you missed the opportunity, but you were right, but you missed it because you got scared with the market going ahead and pulling down temporarily against you. Type in number 1 if that's you. Yeah, thank you for the ones there that I see in the chat. And and by the way, hello to you guys as well. So with that, what's important to understand is this is a short-term pullback with institutional money against the predominant trend, and that's the key. We're being trend traders with this strategy, and we're looking for a short-term pullback where one or more institutions is either temporarily selling, they're pulling back from their buying activities, allowing the market to settle down temporarily. It spooks out the retail trader clientele, and then the market's free to go right back on board the original direction. The problem is it goes without you or I. And then it's like, I knew it was going to do that, but we stepped aside. So that's what this strategy is trying to work around, that psychological barrier. We want to think more like the hunter, not the hunted. Okay. And that's what this strategy is. So when I start to see pullbacks against the predominant trend, I'm actually looking to see if we can break above those areas. Then the market's free to resume the original direction. Now, let's go ahead. Before, what I want to do is spend all of our time just looking at example after example after example after example. So I just want to, before we get into the classic inventory retracement bar, I want to actually cover the reverse inventory retracement bar as well. You'll remember initially that in the uptrend, we were looking for bars that are 45% or more off the high in the uptrend, or in a downtrend, 45% or more off the low. Well, just as the name implies, the reverse inventory retracement bar is effectively the opposite of that. So the only real change between the classic inventory retracement bar and the reverse is this section right here. Now, the one thing is this basically doubles effectively the number of opportunities that you're going to have at your disposal. So it's a very important tool. So now you'll see, looking back over the last 20 periods for signal bars where the open and the close are approximately 45% or more off their low in an uptrend, or 45% or more off their high in a downtrend. Okay, so that's the big difference. That verbiage right there, that's the difference between these two. So let's look at this. You'll remember before, in a downtrend, we were actually looking for these bars that were off the low. Now what we're looking for is, in an uptrend, we're looking for it to open up and go down first. Okay, so usually what the difference is here is it's the same psychological thing. You're being the hunted and you're not being the hunter. What happens is, the market's going up, and just think about all the times. And I appreciate those of you that typed in the 1 or were being honest about it earlier, because it happens to all of us. So, I appreciate the honesty. And what happens is that now the market's in an uptrend here. The market opens up and immediately goes down, right? So you're sitting there, okay, if this keeps going up, I'm going to get into this trade. I'm going to get into this trade. Yeah, this is looking really good. I think I'm going to get this trade. And then it opens up and it goes immediately down. So right there, no sooner were you getting ready on the next bar, whether it's a 1 minute chart, a 2 minute chart, a 5 minute chart, a daily, a weekly, you're getting ready to get into this trade. And then all of a sudden the market has a short-term pullback right off that new bar's creation. It causes the same effect as the classic IRB. It spooks you out of taking the trade. It's just that where the trade usually the pullback takes place. With a reverse IRB, a lot of times, these are very powerful, by the way. It'll open up, it'll go down first. You get spooked away. You're like, oh, forget it. Look at that. Good thing I didn't take that trade yet. And then it turns right around, starts breaking back up through the open of that bar and taking off. I actually have a trade around that. We're not going to be able to discuss that today. It's kind of called the gotcha trade that focuses more on the actual open, but hopefully we'll be able to talk about that at one of the upcoming events we do together here. So so this particular trade, it focuses on breaking above the high of the bar for the entry. So we're in an uptrend. It opens up, it goes down first, then comes back up. When it breaks above that high, 1 tick, 1 cent, 1 pip, that's where I'm looking to do the entry. Officially, the stop loss, especially when trading like the futures, that is often right back behind it. Again, we do get extra options with our options, which is why it's wonderful that CBOE is part of this. And I know Mandy's going to be speaking later in that. So, so with all that being said, that's the entry, the exit there. I want to get to real charts here in a few moments, but I just wanted to explain it again. These are all individual, unique examples, so it doesn't matter. Medium gray, green body, small, thin red. Here back over here, different types. None of that matters. What matters is, do I have bars that are 45% or more off the low in this case in an uptrend, or 45% or more off the high in a downtrend? Because what's happening here now is, this is where those times where you're thinking about putting on your favorite bear strategy, and you're looking to go and buy a put. You're looking to do whatever type of spread you're looking to do. You're focusing on a bearish trade here. And so what's happening here is, or the future, you're getting ready to take the trade. So what happens now is, in this case, the market's in a downtrend. It opens up and immediately you're getting ready to, okay, if this keeps going down, I'm going to enter that short. But instead what it does is it opens up and goes up against you. Okay. And so you're like, whoa, good thing I didn't take that trade. That would have been another one of those losers. So then you step away from that. You go look at another stock. You go look at another futures contract, whatever the case may be. You're basically going off to look at something else, because it's like, okay, good thing I didn't get into that trade. That would have been another one of those losers. This market's reversing. I don't want to be anywhere near it. Then you come back to it a few minutes, few hours, few days, few weeks later, depending on what time frame you're trading. And it not only went back your way, it went back your way significantly, because what happens is it's shaking out the retail trader community, and then the market's free to go back on board the original direction with the fewest retail traders as possible. Okay. And so the short-term institutional inventory is being exhausted, and that could be for any number of reasons, gang. They may have been like in a long position, and they're trying to lighten up their position, and now they're they're just trying to sell that down. So it could put some short-term pressure on it. They could go and be executing a short position, in the short term here, and so they're selling into this area. But it's not like they all get together and sit there on while they're golfing in that and saying, hey, we're going to be putting in several $1 million of shorts in Apple or Tesla or something on Monday. You guys want to get in on that too? That's not how that works, right? I know a lot of people think it is, but it's not. And the reality is that this allows you to kind of see, okay, great. So there's some short-term activity against the predominant trend. But if the market starts to resume that trend, when that one or more institutions has exhausted their inventory, now the market can really whoosh back into the original direction that we had. Okay. So with that, let's go. I'm just going to show a couple charts here, and then I want to switch over to live charts. So again, the reason why I showed this 5-minute Tesla chart is because you'll see the same thing happen for our zero DT options traders. In fact, how many of you here, type in number 2 if you do like to trade zero DT options, and then type in number 3 if you like to swing trade options. And then type in a number 4, of course, if you're a futures trader. So just kind of seeing some of the different audience there to make sure that we understand, who's doing a little bit of what. Okay, great. Yeah, thank you very much. So we definitely have the zero DT options traders, the options, and we got the futures there. Wonderful. And great to see all of you here. Thank you very much. So whether you're using this on an intraday basis for a short-term options trade, whether you're using it on and I want to get the live chart, so a daily chart, all of these things, are useful. So what I want to do now is, and this process that I'm about to show you is automated for all of you that have wealth charts. And a lot of you were given an opportunity to get wealth charts earlier this year with Tradier. If you missed those opportunities, sit tight. Lex and Molly and I and Dan have some great events coming up where you'll be able to get access to, some of these wonderful things that we're talking about. So let's go ahead and bring over here now live charts. Okay, and this was what I was trading last week. All right, and so I kind of want to get right into this. This was a 1 minute chart of the Nasdaq, a 5 minute chart of the Nasdaq, an hourly chart of the Nasdaq, and a daily. Well, what do we see? The daily was in an uptrend. The hourly was in an uptrend. You may remember this. This was the infamous CPI day. Okay, so you had early in the morning, you had CPI data going ahead and firing off there, and then it continued on 5 minute and 1 minute. So now what we're looking for in an uptrend, remember, we're looking for bars that are 45% or more off the high in the uptrend, or 45% or more off the low in an uptrend. These little triangles here are all the bars that qualify and are within the trend at that time for that direction. So in other words, these are uptrend, they're up triangles, and then you'll notice each one of these bars, so 45% or more off the low in an uptrend, 45% or more off the high in an uptrend. Again, 45% off the low, 45% off the high. So all these bars, what these are doing is it's identifying, this is just called what we call an IRB tracker. It's identifying all those bars that are IRBs. Now remember though, there's the bar itself, and then there's the actual entry associated with it. And you'll recall, the entries are actually, for instance, here's an IRB. I'm looking to go long 1 tick, 1 cent, 1 pip above the high of that bar. So that's why you'll notice that the bar, so the ones that are in orange in this particular case, those were reverse inventory retracement bars. And that's because, 45% off the low in the uptrend. When it breaks above that, the bar fires off right away and says, hey, that's it. So I get a pre-alert, and then I get the actual alert. This is just one of numerous different strategies that are in wealth charts. It's just one of my strategies. And the reason why I decided to show this was because this is what I used last week in Italy, during that Wednesday trading competition. And so I feel it's kind of important since, it's not theoretical. It's something that was used just last week. And I said, help me win the 33rd real money trading competition. So here we have now another bar, see 45% or more off the low in the uptrend. So when it breaks 1 tick, 1 cent, 1 pip above the high of that bar, that's where the entry is. So this is a 1 minute chart. And so on the futures side, I was looking for long side trades. So I was firing off multiple long side trades there during the competition. But now if I was looking to do this as a 0DT option, if I'm looking to do this on a 5 minute chart, an hourly chart, a daily chart, the concept is still going to go ahead and be the same. I'm just entering the order here. When we're breaking above the high of that bar, whichever bar is signaling and then firing off, right? So like here, this bar signaled off, the next bar fired off. So I'm looking to put on my favorite bull side strategy right there as we're breaking above the high of that bar. Again, whether you're trading the underlying instrument, an option, or a future. Okay, it's so important that you understand that. But I wanted you to see what I was looking at here. The little magenta triangles, they help you identify these bars that I just showed you the strategy on. And the good news is Lex and Molly had mentioned to you, you guys are going to be able to watch the recording on this over and over again. And also Lex and Molly are going to be joining me for a big event that's coming up here soon. Where I'm going to be doing days of training, at no cost, but just days of training where you guys can come join us and we can spend a lot more time, together during my events. And then you get to learn some neat things from Molly and Lex as well. So fear not. Don't feel like, oh my gosh, I got to get every question answered today or else I'll never learn more about this, because you can get the recording of this and other special events with us after this. Okay. So what you'll see here is that the signal bars, 45% or more off the high in an uptrend. When we break 1 tick, 1 cent, 1 pip over the high. Now here you'll notice the next bar did not fire off a signal. Why? Because this bar right here, the high was exactly the same high. It's got to be at least 1 tick, 1 cent, 1 pip above that high. So the next bar actually got 1 tick, 1 cent, 1 pip, 1 tick higher, and so, which was 1 tick in this case. And so that's why the bar fires off in real time once it's breaking above the high. Does that make sense? So there's like this pre-alert bar, it's the signal bar, and then there's the entry bar. So type in a lucky number 7 if this makes sense to everybody. And Georgia B says, this is really interesting. How do you scan for the opportunities? Well, so inside of wealth charts, there's a whole actual scanner. If you just type in IRB here, you'll see there's an IRB scanner that will actually find those for you, Georgia. So you can put in your favorite if you're looking at futures, you're looking at equities, so there's ways to go ahead and find these in an automated fashion, scanning for them. Okay. So and again, if you guys missed the great opportunity to get wealth charts with Tradier, back earlier this year in January, it'll be even more important for you to go ahead. I'll give you a little link to come see Lex and Molly and me and Dan, here shortly. We can, and maybe they can put that in there, joinwealth365.com, joinwealth365.com. Lex and Molly will be speaking here at this event. There's Dan, he'll be speaking, of course, as well. And Lex and Molly and I, we had so much fun together. It was like really great. So I wanted to do this like every week with them. It was so fun the last time, looking at individual trading ideas on a day trading, swing trading strategy, and saying, here's the great technical trade setup. Let's talk about the favorite options trade that would go around that. So a lot of fun. We're going to be doing that again. It's going to be a 6-day event, 60 different speakers, and some of your favorites in the Tradier community. And so definitely join us there. It's joinwealth365.com. And again, we'll hit a lot of these things even more intensely there. So let's go ahead and but this is what now you can see, hopefully typing in a lucky number 7 there. If you see why I'm looking for this strategy that day, it's a trending market. We have the signals firing off. We're breaking 1 tick, 1 cent, 1 pip above the high of those bars. So all I want to be doing is focusing on a fresh long side trade. Now, if it breaks down below the low of that, that's not what's supposed to happen. What's supposed to happen is this market's supposed to continue on. Once that institution, that one or more institutions does their temporary selling, takes their foot off the gas with their volume, then the market's free to go back on board the original direction, and usually would do it with even more veracity. So what I call the whoosh, okay? And so what I'm not expecting to have happen, I'm not expecting to get into this trade and then all of a sudden have it start breaking back down below the low here. So that's why I was saying the stops can be actually fairly tight in a situation like this. And even if you do get stopped out, let's say it did come down below the low here, and then it turns around and comes back up, I'll look to re-enter that or wait for the next signal to go ahead and kick in, like right over here. You can see then the next signal fired off right here, 45% or more off the high in the uptrend. And when we break 1 tick, 1 cent, 1 pip above the high, then we're expecting, continuation, okay? And again, I can't emphasize enough, because I know last week's competition was with futures. But if you're doing 0 DT options, if you're going ahead and doing traditional swing trading, whether you're looking at a daily, weekly, or monthly chart, this is so important. And I know it was Georgia B there that was asking about scanners. So Georgia, there's other types of scanners in wealth charts too that can just help find some of these types of candidates in addition to the actual IRB scanner. So but you'll look here as we're like Texas Instruments, see the same concept. So we're in an uptrend. We're looking at a bar it's 45% or more off the low in an uptrend, right? Or 45% off the high in an uptrend. Well, notice, remember what the rule is. Then if it breaks 1 tick, 1 cent, 1 pip of that high, that's an entry, which is why this signal fired off. Breaks 40, 1 tick, 1 cent, 1 pip of the high, that's an entry. And then right over here, a classic IRB, 45% or more off the high in an uptrend. When it breaks 1 tick, 1 cent, 1 pip above that, that's an entry. So you can see, you can find some of the stocks that are performing the best, why they're performing the best, right? You can get a lot of technical, fundamental, different types of research here, that you can do, and then look for these types of patterns. Okay, so let's go ahead and take a look here at just multiple daily and weekly charts here. Now, I know I talked about day trading futures and 0DTE options. Just let's go back to our traditional options, bread and butter here as well. So on the left side, you just got some daily charts. On the right side, you got some weekly charts. And the reason why I wanted to do this was because, some people say, oh, well, that's great for the day trading, but what about the swing trading? And I can't emphasize enough how fractal this is. And that's why I really wanted to kind of, come back to this and help you with this. And as I'm doing that, so Luis asks, I'm trying to answer a couple questions along the way there. I hope that's okay. But so will your stop go below the low? Yeah, particularly Luis, you can put the stop right back down below. Now there's a couple other factors that you can, figure into this. There's some other great tools in here, like in Wealth Charts, call it the Champion Trend Pack. So I can put some additional really neat tools on here. I'll just do that for a moment because there's other really neat trend continuation type strategies inside of Wealth Charts. And then I've got the Champion Trend if you're trying to actually swing options trade, there's other even more powerful tools that can help with like the swing options trading from my perspective as well. If I'm day trading and I'm being very aggressive and I either want that momentum to stay with me or I immediately want to be out, Luis, then that would be a situation where maybe using that low in the uptrend, the opposite side of it, the low, or in a downtrend, with the opposite side would be the high side as the stop loss point. So, particularly being very aggressive, like with futures, for instance. But if I'm swing options trading here, then, I've got some other really neat tools that I can use in Wealth Charts called the Champion Trend Pack that can help give me some additional opportunities to give it some more room to breathe. So I'm not just like trading in and out, especially if it's a swing trade. I'm going to have more options, all pun intended, for our wonderful options program today here, to give it more opportunities. Does that make sense, Luis? So hopefully that, that will make some sense for you there. So there's really neat additional opportunities. And thanks for the great questions, gang. So now what I'm going to do is I'm just going to hide back a couple of these things that was good for helping you understand there's a lot of additional opportunities to really benefit from these strategies. But I just want to focus on this strategy itself here for a moment so that we can go ahead and just let you understand the power of just even this one strategy by itself or in combination with things you learn from Kurt, Andrew, you'll learn from people today. I know Mark's coming in for Marcus, if I heard correctly. You're going to have Mandy, Bobby and Jim. So you got a great group of people today. They're going to, teach you additional strategies and see how maybe this can tie in with some of the other things that you're learning, along the way. Okay. That's all I want to do here today to help you. All right. So as we're taking a look, AutoZone here. All right, AutoZone's in an uptrend. So what am I looking for? In an uptrend, I'm looking for bars that are 45% or more off the high in an uptrend or 45% or more off the low in the uptrend. And either way, when I get those bars, like right here, this is a classic IRB, 45% or more off the high. Right here, this is 45% or more off the low. Do you guys see? You see how having both the IRB and the reverse IRB strategy give you all of these, not only these initial entries, but re-entries. I want you to really see that 45% or more off the low, 45% or more off the low, 45% or more off the high, 45% off the high. off the high, right? Off the high, off the low, off the high, off the high, off the low. You see how that's why for years I only taught the classic IRB, and I kind of kept the reverse IRB to myself. This was decades ago. It's like, well, I can't give away all these wonderful things. Well, then I came to realize the market is much bigger than any one of us, and so I'm like, the reality is I trade the reverse IRBs just as much, and they're very powerful. So here decades later, I'm going ahead and focusing on publicly sharing the reverse IRB too, because it's very powerful. Market opens up, it goes immediately down against people, makes them not want to get into the trade, goes right back up, and then off to the races it can go again. So it's important to know both of them. So in the uptrend, we're then looking to spot the initial bar, with which I do in wealth charts called the IRB tracker, and then if it does break 1 tick, 1 cent, 1 pip above those bars, then it will go ahead and fire off. Okay, so when it breaks above those bars, it fires off, and that's what these dots are. The green dots represent it breaking above a classic IRB. The orange dots, or burnt orange, represent it going above a reverse IRB. Now, to me, they're pretty much both the same. I just wanted to draw the distinction so you could see, like, oh yeah, there's the reverse IRB, 45% or more off the low in the uptrend, and then it breaks 1 tick, 1 cent, 1 pip above the high of that. So now, whoosh, I'm expecting it for the continuation back to the upside. Okay, so now let's go ahead and take a look at downside here too, right? Because the same thing, to the downside, except that in a downtrend, now I'm looking for 45% or more off the low in a downtrend, right? Or 45% off the high in a downtrend. Those are the IRBs and reverse IRBs in a downtrend. The entry is still the same. It's 1 tick, 1 cent, 1 pip below the low of those bars. Okay. 1 tick, 1 cent, 1 pip below the low of those bars. All right. So, but it's to the downside now. So if you want to put on your favorite bearish strategy, which I think with the world we're living in these days, gang, we all have to be prepared for our favorite bullish and our favorite bearish strategies. And so this one is universal. It can be used on the bull side or the bear side. And so that's why I want to show you some bear side examples as well. It's the same concept. It's just that now instead of the 45% off the high or low being entered in an uptrend on the high of the candle, or 1 tick, 1 cent, 1 pip above the high of the candle, now in a downtrend, I'm looking to enter 1 tick, 1 cent, 1 pip below the low of the candles. Okay, that's what we're looking to do here. Okay. That's the big difference. So the signal bar fires off, the candle, that 45% off the high or low bar. And then the entry is when it breaks 1 tick, 1 cent, 1 pip below the low of that area. That's what the red dot is. Or a magenta dot is for reverse IRBs, just to help you identify them here for the purpose of learning. Again, both from my perspective, they're both red, or they're both green. They're both meant to be a short. I trust them both equally, although reverse IRBs, they're really exciting, and they can lead to some very big whooshes very quickly. In fact, you see one right here. But I trust them both equally, if that makes sense. So I just wanted to kind of show that to you in the downtrend. These are all daily charts on the left side. These are weekly charts on the right side, because I need you to understand it just doesn't matter whether we're looking at a weekly short, a daily short. So there's the signal in a downtrend, 45% or more off the low in the downtrend, right? So 1 tick, 1 cent. There's another signal bar over here that we can't see, which is why it's firing off here. But you can see then 1 tick, 1 cent, 1 pip below the low of this classic bar, and then back over here there was another signal bar, which is why this one fired off. So when you get below these IRBs, that's when it fires off, and it fires off as it's breaking through. I'm looking to take that trade as it's breaking through. Okay. I can wait till the bar closes, but then in many cases, well, you can see like right here, the whoosh, right? I just missed, some of that opportunity right over here. Same thing. Look at how much this moved. If I'm waiting till the close of that bar, then what ends up happening is I may end up, missing it. And also when you're, depending what kind of trade you're trying to do, if you're trying to collect the premium, well, am I more likely to still get better premium when it's up here? Right. So if let's say I'm trying to sell a call, right? Am I more likely to collect better premium up here or after it's already gone down and everybody else sees how obvious it is? Does that make sense? So that's why I like to look at it as it's breaking through versus, because whether you're talking premium collection or being in it part of that whoosh, that's why I do it intrabar. Doesn't mean that you need to do that. Maybe, especially if you're testing this out, do it on a simulator. Wealth Charts has built-in simulators in that for you to go ahead and test these things and use these things. You can also take these indicators and then build your own favorite indicators that maybe you learn from some of the other wonderful presenters in that. You can build in some other of your own indicators around this strategy as well. So you modify it and take it and use it the way you see fit. But I wanted to make sure that you saw this. So whether you're a day trader, like I was going and using it here for it helped me win the trading competition last week. Now, hopefully I'm going to bring Lex and Molly in here too to see if there's any questions that I missed. But I want you to see that now, hopefully with hindsight, you can see what I was looking at the time. The market was going up, right? So we had this market going up. And then at the same time, we were getting these IRBs and classic IRBs and reverse IRBs. So the market kept firing off these signals. So I was looking at multiple long side trades there. And ultimately that helped me win the Champions Cup over in Italy last week. So Lex, Molly, we'll bring you guys in here. I want to keep you on your time, but I'm happy to answer any and all questions that you'd like me to from the audience. And one thing that I guess I just want to share with the audience, I do want to keep you on time, is that this is where they can go to. I like to remind people why I do this craziness that I do. And I love representing our country in the big competitions over in Europe, and for these little people here, my lovely bride Sarah. But if you go to joinwealth365.com, you'll be able to see it'll pull up a little landing page here, and you can just sign up with my picture there, and you'll see Lex and Molly and Dan will all be, along with many other wonderful speakers, about 60 over the course of 6 days, but they'll be there as part of that as well. So with that, what questions can I answer for either of you, of course, and or the gang as a whole?
Sure. Great. First of all, great job, Rob, as always. Your stuff is always interesting. You get a lot of sevens, right? Love the sevens.
Thank you.
I have to say, you are such a pro at this whole thing that we're doing here. It's just it flows so well, and there's such an involvement in everyone who's watching. So thanks. It's really fun to be on these with you.
Yeah.
No, absolutely, guys. Love to be here with you. And if I said, well, at the Wealth 365 event, we had that people really like to say, here's the strategy, and now here's the option strategy around it. So I think we should do that rapid fire again. They just love the two of you. And
cool.
That was great.
Together. So
I love your voice. I feel like I love your voice. I need a cup of tea and just relax listening to you. It's really great.
Yeah.
Thank you.
Let me do this, Rob. We're tight for time. I'm going to throw a couple questions up here. Here's one of them.
Okay.
And I assume this means your platform, the Wealth Charts platform. So what's your answer to this one?
Yeah, well, certainly we have volatility and indices, and we're adding new products in all the time. We have we just brought in CME feeds, CME, CBOT, COMEX and NYMEX feeds direct from the exchange. And of course, we have the Tradier feeds. So we have all the Tradier feeds that you provide, as well as the futures. As you know, we were the first to launch futures with you. So we have a lot of futures users. I just won a trading competition with futures last week with the Tradier brokerage platform, right? Awesome. So using Wealth Charts and my Tradier platform or brokerage account. So yes, we're always adding new products and volatility. We have a lot of volatility related tools, and the tools that we don't have, it's more like, please email support@wealthcharts.com. Tell us what you need, because we continue to grow those, as you know, every day. I mean, even you, Lex, in the time you've known me, you've seen how many features we've added for options traders and that. So if we don't have something, we want to try to make it available. So
got it. Good. Are there any rules you follow to not be in a trade? Now, what I mean by that is, are there any days of the week, like a FOMC announcement or CPIs coming out, where you just say, uncle, I'm not going to play today? Or is it just, you just go?
No, that's a great question. So a couple of things there. Usually it's not that the whole day is eliminated, but like CPI, like in fact, we had the CPI the morning of the trading competition. I told everybody in the audience, I'm sorry, I'm not trading, during the CPI here, and I'm going to give it a little while for the CPI to shake out. And I actually waited till right after the US Open before actually seriously engaging the market, because I want to get the open volatility, see if that would reverse that huge spike that we had. And so, yes, I don't typically trade those first few minutes before or after key news announcements. It can sometimes be 30 minutes or longer. Like an FOMC is typically 30 minutes or longer for me. A normal CPI report or so. I mean, this was a pretty big one last week, as you recall, with the volatility. So, I'll wait at least a handful of minutes. I also don't trade typically right at the US Open. I usually give it a few minutes to shake out, unless it's an options trade, which has got a much more bigger horizon, like a swing option trade where those few ticks up or down are irrelevant. But if it's a futures equity index trade, that's, then I'm going to want to see those first few minutes shake out. As far as to summarize a particular whole day of the week that I don't trade, no. But around key news announcements, it gets a little bit too gambly for me. And the key to my overall success has been, the stats, the statistics, focusing, putting the probabilities into my favor. When I follow my rules, I tend to make money. When I tend to break my rules, I tend to lose money.
All right. One more, one more, Rob. Sorry, I'm such a rush here, but we got to get moving.
Yeah, no, I completely understand.
What about the rise of these algo trading bots mechanism versus the technical side? Can you incorporate the algo automated part into what you're doing? Is that possible, or are you already doing it?
Yeah, so WealthCharts is actually building in to the back end, and you've got some great partners that do some of these wonderfully. You had Kirk on earlier. I know Dylan does like his thing, with the bot trading and everything. So you guys, there's a lot of great algorithmic and bot like trading out there, and so WealthCharts, of course, is integrating a lot of these different technologies as well as I'm speaking, so that we there's the people that want to fly the airplane, and there's other people that want to let the airplane fly itself. So WealthChart's focus is trying to really help. There's people that just want to use whatever indicators are available to them out of the box. And, there's other people that want to build their own indicators and make it their own. So WealthCharts is trying to focus on all of those different groups. So you'll be hearing a lot more on the algorithmic and bot trading side as we go along. We actually delayed the release of some of those things right now because of some of the wonderful new exciting announcements coming out for Tradier here very shortly. So, so for the people that love bot and algo trading, we support you, and looking forward to watching you grow with us and giving your feedback as we launch some different things, and hopefully do a lot of great things with like Kirk and Dylan and all the wonderful people you already work with.
Perfect. Good. Great answer. Thank you.
I'm hoping in the future that your bots, somehow integrate with Optimus, and Optimus in the morning hands me my cup of coffee and tells me my returns are, and go, and I'm somewhere headed to the beach. That's our near future.
That's what we all want.
Right.
That's what we all strive towards, I suppose.
Right.
Yeah.
That's right. Well, Rob, thanks so much. Awesome presentation as always. Great to see you. Congratulations on your victory.
Big win.
Thank you.
We'll chat soon. Bravo.
Thanks, guys. I appreciate it. Thanks, everybody. Thanks for being here with me today. Have a great rest of your day, guys.
Thank you.
Bye.
All right. There's a lot of noise and opinions about trading and investing, and it's always at your fingertips. Also, trading today is digital, and having a trading idea is crucial. We hope to deliver substance to help our community make good trading decisions and make good investing decisions. The Hub will serve as that haven for knowledge and collaboration. All right, Mal, guess what time it is? It's time for our first ever Kahoot quiz. Now, everyone, hang tight. What's going to happen is we're going to bring in a screen. It's going to be the Kahoot quiz. There are 10 questions. You will have a QR code. So I need you to get your smartphone out and ready, get the camera on. You're going to snap a picture of that QR code, and it's going to ask you to put in a username. I think maybe your real name as well, but make sure you do that. I think you hit submit, and then we'll give you a little bit of time to do that, and we're going to get into the quiz. 20 seconds per question, roughly. And it's based on accuracy and speed at which you answer. So the system will compute that for everyone who's involved, and will show a dashboard toward the end of who's in first, second, third, fourth, fifth, I believe. That's as far as they go. And we're paying out winners at first, second, and third. First place, real quick, $1,000 into your Tradier brokerage account. Second place, Tradier Pro, free for a year. Third place, Molly's favorite, the Tradier Hub swag bag. So with no further ado, let's get this baby rolling.
And wait, wasn't fourth prize we're passing out your number?
Yeah, that's right.
No?
No.
No, we next that. Okay.
All right, let's see how this works. We got to show the quiz, I believe.
Drum roll.
Drum roll. Someone's going to add the quiz to the stage. Here it comes. Would you look at that? Okay, here's what we got to do. So everyone, the production folks in the background can tell how many people are signing up. Start taking pictures of that baby right now, and we'll give it a little time here for you guys to do that. And I'll get a notice when we're ready to start. We'll just give you a few minutes to figure that out. I see some people coming in. There we go. Now you got it. That's the idea.
Wow.
A lot of people to get going. Who's going to win this thing? There you got it. Good. Molly, you can't play. You probably know the answers.
Wands? No, we don't know answers.
All right, I think production team's going to give about 3-ish minutes for everyone to get logged in here.
Look at that.
Isn't that cool?
Way to go, guys.
We need a big group. Let's get a big group in here. Keep adding.
This music is bringing me back to my Nintendo days. I'm just saying.
Right?
I feel like
I promise you, Mal, you're going to be able to answer at least one of these questions.
All right.
Promise. So I would say the questions are very beginner to intermediate, and that's about it. There might be one little hard one in there, but it should be pretty good. Come on, there's a lot more of you on here. We only have 42 players. Let's keep rolling. Let's get to 1,000. What do you say? There you go. While we're doing this, just so you know, if you are one of our 3 lucky winners, what we're going to have you do is email your information, which will be your name and obviously your email, which we'll have, to hello@tradier.com. Maybe if one of the production folks can throw that across the screen in a banner if they have some time, that'd be great. But we're going to you'll correspond with us through hello@tradier.com. All right, growing. Come on, we can get more in here. Let's go. Only about a minute left. To sign in, everyone, someone's asking how to sign in. Take a picture of that QR code in the top right. That's with your camera. Put your camera on that. Something will pop up, and it'll give you the template to fill your name in. I'm signing up. That's all there is to it, Mal. I'm not gonna.
Is there someone out there who's doing like 20 signups?
I'm gonna come in.
No ideas.
Oh, it works easy. All you need to do is get your phone on that. I just did it. Just get up there. I put my email in now. All right, here we go. And once you sign in, go get yourself a cup of coffee. I just signed in, Mal.
Woo, the excitement reigns.
I think this is it. Here we go. Molly, you got to answer. You got to go fast.
No way. I'm not answering. These are you. It's on you. Unfortunately, I can't see the screen, so it's on you, Lex. Go for it.
A lot of answers coming in. Remember, it's a speed and accuracy quiz. And you will have the timers on the left side there. 3, 2, 1. Answers. Bang. Looks like I'm guessing the yellow. I don't know if it's A, B, or C or not, but the yellow is the first. Oh, Lexinator's in second. No fair. I'm not answering the next one. Luis, look at that. You beat me. Number 2. What does it mean to buy a call option? Answers coming in. Here we go. Six. Expecting the price of the underlying asset to increase. Calls do a little better when the stock goes up if you're long them. So makes sense to me. Let's see who answered that correctly. Oh, I dropped off. I didn't answer that one. I decided not to play that one.
You can't play, Lex.
I'm not playing. I just want to do the first one. Which term describes the price at which an option can be exercised? That's an easy one. Let's go.
Oh, I love that. Is that where you can see who's on? Is that a geographic location? We know where you live.
It's a good.
Are we IP address tracking?
The strike price, Mal. That's
Hey.
the answer to that one. Easy enough.
All right.
Let's see how it goes. Whoa, we have movement. Who's going to catch Luis? Number 4. What is the term for an option that can be exercised at any time before it expires? Come on.
Is it to see how fast you can put these questions in AI to answer for you?
Pretty much. Ooh, an American option can be exercised before term or its expiration date. European cannot. So good. That's a good question. I like that one. How do we do? Ooh, look at the top 2 up there. They're killing it. It's actually everyone's really close.
That's a great thing about zero DTEs, actually.
That's right. That is true. What is meant by writing an option? Boy, look at these fast people. Look at all the speed demons.
Right.
Right?
Right. Kirk is on the other side with 1,000 bots just answering.
2, writing an option is selling an option contract. Typically used when you write calls against your stock. So covered calls would be a good example of that. All right. Let's see how we did. Oh, look at that. That board is looking good. I love it. All right. Get ready. Next question coming up. What does the expiry date of an option refer to?
And it's not getting drinks at the bar.
Well, it could be. Back in the trading days, that's exactly what
That would be. Right. Cocktail time.
Oh, there you go. Last date on which the option can be exercised. So this is it either converts to a stock if it's in the money or it expires worthless, right? The expiration time. All right, let's see what happened here. Woo, look at the top 2 guys are close. It's getting tight. Come on, everybody. Go fast. Here we go. Be ready. 7th question. What does in the money mean for a call option? Ooh, a little slower here, Mal. One second. Bam. So, and in the money on the call. So the strike price would be lower than the current stock price, right? For a call. That means all that difference is parity or intrinsic value, the difference between the stock price and that strike price. Good one. Uh-oh. Here we go. Number 8, I believe. Yes. What is options Vega?
Ooh. You'll know this if you've seen the movie Contact.
Great. The boards are changing as we get later here.
Love the Greeks, Lex.
I do
This is
love
your
the Greeks.
wheelhouse. Yeah. What's
All
your
right,
favorite?
here we go. Whoa. An option price sensitivity to a 1% change in implied volatility. So as that volatility changes, how much does that options price change is what Vega is referred to as. Okay, let's see how we did. Yep. I guess we didn't see how people did on that one. We're going fast. Ooh, this is a tough one.
Read it out, Lex, just in case someone's listening.
What strategy involves both buying a call and a put option on the same asset with the same expiry and same strike prices? Second to last question, I believe. A straddle. Excellent. Same strike, same expiration, buying call, buying put, or if you're selling the straddle, selling call, selling put. Let's see how we did here.
Good when Fed numbers come out.
Okay. Luis is taking a commanding lead here.
Go, Luis.
Last question. It's a close one between second and third. Which of the following best describes a protective put? A little bit slowness here.
Key in volatile markets. Very, very key.
Buying a put option to hedge a long stock position. That's a protective put. Very good. I think that's the end of the quiz. I think it shows the winners here. So if someone could take down, well, maybe we could take down the winners of this. Third place, Securiosity.
All right. Oh, I like that
Second
tag.
place, Mines Forge. First
love
place, Luis.
Hey.
All right. So here's what we need to do. You three folks, we don't know who you are, but send us an email with your information to hello@tradier.com, and we'll work through the prizes that way. Okay.
And those look like Xbox tags. So we'll find them on Xbox. If we
I
can't
love
find
that little quiz. We should do that on the show, Mal. It's my favorite.
That's really good.
That was good. All right, we're gonna get moving right into it. Sorry for the short break, but we have to move along. Join the Tradier Futures waitlist. Access the gold, oil, index, currency, and crypto markets with Tradier Futures. Make sure to join the waitlist now so you know when we launch this powerful product enhancement. All right, Mal, next up.
Rockwell Trading.
We had to go to the bullpen for this one. Mark Hoge, and I'm probably saying his name wrong, but Mark is I've been with Mark on summits at Rockwell Trading. He works with Marcus there, one of Marcus's business partner. Mark is a wealth of information, and they do a show together all the time. So I'm really looking forward to his presentation here. We are going to let him get started, and Mark, when you're done, Molly and I will be back in for a few questions. So have at it, Mark, and fill in the blanks that I didn't fill in. Here we go.
Fantastic. Well, hey, thanks for having me, Lex. Hello, Molly. Glad to be here. And yes, I am filling in for Marcus. If you've seen Marcus before, then you probably know that I'm a little bit shorter. I don't have as much hair, and I like to think I'm a little better looking, but don't tell him. I might just have a better joke or two as well if you've been following along with our Coffee with Marcus and Mark show. But I'm happy to be here. And I mean, that was a lot of fun. But I did get the expiry date wrong. I thought that was the last time you take someone to dinner. Yeah, maybe, maybe not. But hey, what I want to do is I want to go ahead and share my screen here and make sure that we're looking at things together, because this is all about options, as you know, with the Tradier Option Summit. And just to kind of get a feel for the type of traders that we have here, Luis and Mindsforge, you don't need to answer this one, but I'm just curious. How many of you are beginners where you really haven't traded options before? How many of you are intermediate traders? I know this can vary depending on your definition, but let's say you've been trading options for at least a year. And then for those of you who are more advanced, maybe you've been trading for a couple of years, you know the ins and outs of options. I'm just curious what type of traders we have here, because to me, this is a very important approach to trading, one that I love to trade, and one of the key strategies that we focus here when we're trading at Rockwell Trading. Okay, so I see advanced options trader as one response. Okay. Probably a little bit on the intermediate to advanced side for this type of summit, which is great. I know that Tradier attracts a lot of more experienced options traders, which is fantastic. Wonderful. Intermediate. Okay. Well, today, and full disclosure here, Marcus, these are Marcus's slides. He loves baby pictures, and I think they're cute. I think that they work, but he put these slides together, and I'm just running with it. So today, I'm going to share a strategy, and we're going to cover why I love this strategy. I'm going to give maybe 2-3 real life examples of how I traded this strategy risking money. And then I'm going to share my trading plan, my rules for the strategy. And that's what we're going to do. But first, let's focus on why I love this strategy. And this is where at Rockwell Trading, our goal is to focus on SRC profits. This stands for systematic, repeatable, and consistent profits, because it's easy to get distracted where you're chasing that high flyer, something crazy. Maybe GameStop's going crazy and you think you could capture some of that. Maybe DJT is going crazy. You think you could capture something like that. But for us, that doesn't make sense. It's not repeatable. It's not consistent. It's something that you can't rely on all of the time. And instead, we want to approach the markets and trade a strategy where SRC profits are possible. This stands for systematic, repeatable, and consistent. And I think that the best way to introduce the strategy is to think like this guy here, Warren Buffett. If you don't find a way to make money while you sleep, you will work until you die. And they say that when you're successful, the number one thing to do is to keep your secrets to yourself. The number two is, okay, well, I'm going to share a secret or two. But, this is actually a strategy that Warren Buffett has used. And I think, why not follow one of the greatest investors of all time? You should all know who Warren Buffett is. But if you don't, he has led Berkshire Hathaway. And look at this stock going back just decades. What a performance. I mean, this is the type of company that is the epitome of success. And he's just been a successful investor. But there are a few secrets or tips that I think we can learn from him. When I first got started with trading, I actually, in 1996, I was an intern for a brokerage that was at the time Dean Witter Reynolds. And it became Morgan Stanley Dean Witter at one point. I was actually in the Sacramento office, but the movie The Pursuit of Happiness was a Dean Witter office in San Francisco, not too far away. And I got started at the brokerage. And I remember the broker that I was working for, he said, my goal is just to own 100 shares of Berkshire Hathaway. Now, back then, it was still a nice little retirement plan. But gosh, if you invested in Berkshire Hathaway in 1996, when I first got interested in investing and trading, you would have done pretty well for yourself just being in Berkshire Hathaway. So this guy, he knows a thing or two, right? The S&P 500 has performed 4.3.5%, and the Berkshire Hathaway, their A shares, actually have definitely outperformed the market. So pretty smart, right? And this is where there's all of these little articles, but you might miss that there are a few secrets, a few tips, a few things that Berkshire Hathaway and Warren Buffett does. And here you see, if you really want to be rich, use these 3 Warren Buffett trading techniques that nobody ever talks about. Well, I'm going to talk about it today. And this is selling put options. So you know that Warren Buffett wants to buy shares and that he's an investor and he thinks long term, but there's definitely an opportunity out there to be an option seller. So we're getting paid, we're collecting premium, we're taking advantage of a situation where they say that options are typically expiring worthless, whether or not that's because they're closing before or expiring at expiration. The bottom line is that, as you know, theta or time decay, collecting that premium, getting paid, that's a nice way to be profitable in the options market. And this is something that Warren Buffett has done. Here, another article, this naked investment strategy helped Warren Buffett make millions. And this is a perfect example. Years ago, when Coca-Cola was around $39, Warren Buffett sold 50,000 put options with a strike price of $35, making $1.50 per share, where he collected $7.5 million waiting to buy shares of Coca-Cola. So if those options were exercised, if those puts expired in the money, then he'd be the proud owner of Coca-Cola at $35 a share, but he got to keep that $7.5 million no matter what. That sounds like a great deal to me, and this is how I like to trade. So we get paid to buy stocks at a discount, right? Not too bad. I also like to think of it as getting paid a dividend up front, right? If you get paid a dividend before you ever even own those shares, that's not too bad when it comes to trading. So let's talk about the strategy. What is it? Well, we like to trade the wheel strategy. And with this strategy, we start by selling put options. So we're an option seller. We're collecting premium. And with a put option, we have a strike and we have an expiration. And if we sell a put and the stock is below that strike at expiration, then we are obligated or committed to buy shares at that price. But I'm figuring that out before I ever put the trade on. I'm saying this is a price I want to buy that stock at. So why not get paid to buy shares? And this is step 1. Now, a stock can go up, down, or sideways, as we know. I actually like to say that stocks move in 5 different ways. A stock can go nowhere, right? That's one way. A stock can go up a little bit. So a minor uptrend. A stock can have a major uptrend where it makes a substantial move higher. And a stock can have a minor downtrend, so a minor move lower, small move lower, or a major downtrend, a major move lower. Now, if you sell a put out of the money, so a little bit below where the stock's trading at, then you're actually putting yourself in a situation where you could be profitable 4 out of 5 times or 80% of the time, right? Because if you sell a put below the market that's out of the money, if the stock goes nowhere, you collect that premium, you've made money on the trade. If the stock moves up a little bit, you've collected that premium, you make money on the trade. If the stock has this huge move, you still make that money, it's still profitable. Now, maybe another approach or strategy would have helped you capitalize on that big move higher, but it's still a winning trade. And then a minor move lower, you could still make money and be right. When there's a bigger drop, that's the last scenario, and one that we don't really want to have happen with the wheel strategy. But because we're picking a stock that we want to own to begin with, we're okay with that. So step 2 with the wheel is getting assigned, taking ownership. And this is where we are now the proud owners of shares that we wanted to own anyway. And to get assigned, it traded lower than it was when we decided that we wanted to own shares. So not too bad. We're able to buy shares at a discount. Step number 3, selling calls. Once we take ownership, once we own those shares, we want to get paid again. The stock could go sideways, it could go up a little bit, it could drop a little bit, doesn't matter to us. We're looking to sell call options now to collect premium to get paid, and the wheel goes round and round. So that's what we're looking to do. That's the strategy in a nutshell. But what I want to do is go through some examples and also show my trading plan, so you can really see how this works and what I'm looking for. My plan very similar to Marcus's when we are trading this strategy. So let me jump over to the software that we've developed here at Rockwell Trading. And I've actually been working with Marcus since 2006. I started stock trading in the late 90s and really got interested in options in the early 2000s, when I realized that the .gone era had come to an end and options were a nice way to capitalize on market movement. I came across Rockwell Trading in 2005 when it first got started, and a year later, after working with Marcus for a while, he asked me to join the team, and I've been head coach at Rockwell Trading ever since, working on strategy development, also helping Marcus from a coaching perspective with our mastermind program where I work one-on-one, and also provide some insights into the strategies that we use here at Rockwell Trading. So we're going to focus on the wheel. And what I want to do is I'm going to show a couple of examples. And Oxy to me is just a fantastic stock to trade the wheel strategy with. So with Oxy, this stock just trades in these nice ranges. And you see here, speaking of Warren Buffett, right? When Warren Buffett started to invest shares, or Berkshire Hathaway started to buy shares and pick up shares of Oxy, they have to file the shares that they've purchased with a 13F filing. And once that became known, everybody got excited and jumped on the bandwagon. This is where you see this huge spike in volume and this rally. This is the Berkshire Hathaway effect, or the Warren Buffett effect. So this propelled this stock higher. Once it started to find these ranges and some nice support here, I was excited about trading this one. I traded it in 2022. I traded it in 2023. But instead of buying at these higher prices, I decided on every dip that I wanted to sell puts. I sold puts at 57, 56, 58. I believe I sold it at 59. I know Marcus did. Every time it would come down to these levels with a wheel strategy, I'm looking at that stock continuing to move sideways or slightly higher so I can get paid. And then if the stock falls more, I'm getting signed shares. I'm taking ownership. I'm buying the shares. I have an obligation to do so at that strike that I've sold. And then as the stock starts to move higher, I'm looking to sell calls. So this is a stock that we've traded over and over, and I just wanted to give it as an example. But let's look at some other specific trades and stocks that we have traded. And one recently has been Apple. So Apple, I think, is another great way or a stock that is a great candidate for the wheel strategy, right? Is Apple going to go to the moon? Probably not. Can it rally? Sure. Is it going to go bankrupt? No, at least not anytime soon. Can there be pullbacks along the way? Yes. And this is where once we start to see a nice range here, I'm all over it. I want to trade it. And so when I looked at this chart here, I was interested, especially once we broke down around the 180 level. I wanted to own shares at 167.50, and I was selling puts at 167.50. So this is a situation where actually before earnings here, right? Because after earnings, you look at that pop and, it's always easy in hindsight to say, oh, Apple, of course it's going to move higher and I'm the best trader in the world because I bought Apple. Well, I have a plan where I'm looking for systematic, repeatable, and consistent profits. And here, when we broke down to these levels, I sold puts a couple of times at 167.50. But here, I want to look at this particular trade. Actually, so on March 5th, we could use this as an example. March 5th was a day where I sold the 167.50 put, collected 70 cents. And that was good for just a couple of days. It expired worthless. So on March 8th, it expired worthless. Stock closed above 167.50. And I have a 3-day trade where I have made money and I'm done with that trade. So I collected all of that premium. And that was step one. Now, did we go to step two? Was I assigned? No. The stock did not close below 167.50, where I decided I wanted to be a buyer. And instead, I got paid. If the stock dropped below 167.50, I own shares at 167.50. But as long as we stay above 167.50, then that option expires worthless, and I look to start the wheel again. So we did not move on to step two in this first example. And then on March 25th here, March 25th, let's move on. So we started to find this range here, maybe between 170, 177.50. And then on March 25th, I sold puts again. I sold the 167.50 again. I got 85 cents. And here, this was the March 28th expiration. This is March 28th. The stock closed at 171.48. I've made a commitment to buy shares at 167.50 by selling that 167.50 put. This time, this expired worthless. No, I'm sorry. Take it back. The first time it expired worthless, I bought these shares back at 7 cents. I sold them for 85. I bought it back for 7 cents. And I'll show my trading plan and my rules. But if I can close that trade for 90% of the max profit potential, I'm going to go ahead and do that. So if the stock drops lower, I have another opportunity to put on another trade. That's what I did in this example. All right. So April 1st. Here, stock's hitting 170. It's sitting around here. And I am interested in owning shares at 170 now. The reason why I wanted to own shares at 167.50 before was that we were moving lower, and looking at this chart, we had this zone of support here, looking back at prior levels where there was less selling pressure and the stock started to rally. So I was a little more conservative at 167.50, but once we started to see a lot of trading around this 170 level, I was interested in owning shares at 170 because there was a lot of trading here. And here we have this indicator in our chart, which we call the lowest close indicator. This is a reference for potential support. On April 1st, I sold the April 5th expiration, the 170, which is here, and we closed at 169.58. So I had a commitment to buy shares at 170. I was assigned. So step one, sell a put. Step two, get assigned or don't get assigned. First time I didn't get assigned. Here I'm getting assigned. I now own shares at 170. And then on Monday, we open up at 169, $1 below where I own shares. And on Monday, April 8th, I'm able to sell those 170 calls for $1.42. Now, this is a lot of premium for just being in a trade for a week. And you see here, did I know that this spike was going to happen? No, I didn't know if we'll get a 4% move to the upside, 1% move to the upside, 1% down to the downside. But what I do know is that $1.42 that I said I wanted to take, and with an obligation now to sell shares, because if we're selling calls, we have an obligation to sell shares at the strike that we've sold. When we're selling puts, we have an obligation to buy shares at the strike that we've sold. And here with step three, sell calls, there was a rally. And at the end of the week, we closed above 170. My shares were called away. So here started with selling a put, and then step one coming to an end, repeating step one, selling a put. On the second trade, I sold a put based on my plan. So much of the premium had disappeared that it made sense to buy it back at 92% of the max profit, and then went back to step one. Then I sold a put again. I was assigned at 170. So step 2, was I assigned? Yes. I move on to step 3. That's sell calls. I decided to sell 170 calls because we were trading below the assignment price that I had, and that 142 was a real nice ROI for me. We'll talk a little bit about ROI and what I'm looking for in the plan. And then step 3, if I sell calls and I get called away, I go back to step 1 again. And that's what I did. Going back to step 1 on April 16th, I went back, and on April 16th, there was a little more volatility here in the market. And also we're starting to establish another low here around 167.50. So I actually went back to the 167.50, said, hey, let's sell this. I got 85 cents for step 1. And then at the end of the week, this was April 19th. April 19th, the stock dropped. Oh no, on April 19th, it was trading at $1.65. So at this point in time, had I just bought shares for $1.70 on March 5th, I would be losing money. I would be losing $5 a share if I just bought shares. Instead, I sold puts 4 times. I sold calls once. I collected all of this premium, 70 cents the first time, 77 cents the second time, $1.42 on those calls. I actually got $1.50 on the 170s, and then I got 85 cents on this. So even though it's trading at $1.65, I'm making money even though the stocks drop. Well, we get assigned, and I sell those 167.50 calls again now for $1.30. I'm getting paid. And then the stock starts to do this. Well, I have a situation where at the end of the week, it is possible for me to actually roll those calls, meaning that I'm buying back the short calls and selling a week later. And I would have been able to get $2.20, collect all of that premium. But we were going into earnings. So for me and my plan, I really prefer not to hold trades into earnings because to me, earnings are more of a binary event, which are less predictable. Yes, we could look at what's happened in the past. We could look at expected moves and what options are pricing in as the potential for the stock to move based on what options traders are betting. But for me personally, I would rather avoid that earnings risk, get out, have a guaranteed profit. And if the stock rallies, no big deal. If the stock drops, then I'll do the wheel again, right? Instead of holding in to earnings and having this extra risk, I'll just sell puts again if I can at these lower levels. In this case, Apple Gap Tire. Marcus, since Marcus and I work together, he played this a little bit differently. I like the way he played it, but it just goes to show that you can have different plans and you could have a different risk tolerance and trade the same strategy. He actually sold the 172.50 calls on this pop. So I sold the 167.50. I still had an opportunity to roll. He sold the 172.50 calls that were expiring Friday after earnings. So there was all of that volatility priced into those calls. I think he got $3.10 and also had the opportunity to make $5 on the stock because he was assigned at the same price I was at 167.50. And this turned into a beautiful trade for him without having a whole lot of earning. Well, he had earnings exposure, but he had so much premium priced in that if you take your cost basis, the price you bought shares at 167.50 and subtract all of the premium that was collected up until that point, I want to say that his break even on the trade was about 160. So he could lose about $7.50 and still be making money because of the wheel strategy. And this is what we like to do to put the odds in our favor, right? We never know if a stock's really going to move up, down, or sideways, but we know that if we're trading these high quality stocks, that they're more likely to have more or less significant moves to the downside, but give us this nice premium potential where we could be option sellers and make money by selling options, but then also make some money by owning shares of stock. So I want to share my plan here because we could talk all about where I got in, where I got out, but I want to share exactly what my rules are. And so in PowerX Optimizer, we have a scanner that is searching for trades based on my rules and how I trade the strategy. And let me go ahead and go over to here because I have my trading plan written down here. Let me zoom in a little bit. And let's talk about the actual rules. So, stock selection. I like to trade stocks. So there's really two components when we're trading the wheel strategy. There's the stock side and there's the option side, right? Because I don't want to trade the option unless I like the stock. With some option strategies, you're just focusing on the option itself, right? The premium, the volatility, all of the pricing components of that option, and that's dictating what you trade. Here, I need to be comfortable with the stock. So I need to analyze both the stock and both the option. That's where the scanner helps me out in finding opportunities. But from a stock perspective, I don't want to trade stocks less than $15. I don't find that there's really nice premium there. And what I wanted a little more meat on the bone. I also don't trade Chinese stocks. And this is because we're always going to have economic risk where there's something that happens in the market and we have some exposure. That's part of trading. We're going to risk money for the potential reward that we're after, of course. But with Chinese stocks, I believe not only do you have economic risk, but you also have political risk where overnight you could see a substantial move in a particular stock because of a government decision. So to avoid that situation, I think it was go to education, where the Chinese government just decided that education companies were no longer able to be for-profit companies. They had to become nonprofit, and you lose like 80% of the stock's value overnight. Sure, there could be something weird that happens in the US as well, but it's more likely to take place in China. So that is why I have no Chinese stocks as a rule. I also do not like to trade leveraged ETFs. Leveraged ETFs have some great premium on the option side, but we could be blinded by premium where our focus is just on how much we could make on the option without thinking about the risk on the stock side. So that's something for me that's a little too aggressive. I also stay away from biotech stocks. We know that biotech stocks can have these great moves, but they can move significantly to the upside and downside. I don't want a situation where I'm in a position and then there's some stage 3 clinical trial and some stock just takes a dump because the phase 3 trials were horrible and the whole company is based on the success of this one product. That's not what I want exposure to. I also don't trade crazy stocks or meme stocks with huge out-of-touch rallies. This to me is defined as 100% gains in weeks or months that cannot be sustained. Examples would be GME, AMC, DJT. I don't want to sell calls on these companies. I don't want to sell puts on these companies. I would rather trade something like Apple, something like Oxy, something like GDXJ, where we have more stability for those SRC profits. Company fundamentals, again, on the stock side, I want to make sure it's a quality company. And this is where I look for stocks that have a PE ratio less than 100. Now, the S&P average is about 25, and that's typically what I go for. But I like to have just a little more that I could analyze and look at in case there are certain sectors where there are higher PE ratios because of the sector or industry, and it's normal for that sector to have a slightly higher PE ratio because sometimes it varies from sector to sector, industry to industry. I also prefer a stock that pays a dividend. So if I'm in a stock and we get below the assignment price and I can't sell calls, I'm still getting paid. Right now, I'm in a UPS position and I've been collecting dividends on that. I'm comfortable with the position and holding it, and I'm getting paid with a dividend. I don't need the company to pay a dividend, but it's a nice bonus. And for me, if it doesn't pay a dividend, then all of my other criteria must look really good. I also prefer that it's a profitable company. And for me, it's net income being positive 4 out of the last 5 years and 4 out of the last 5 quarters. So there's the short-term trend where we have positive net income. It's a profitable company because especially in a higher interest rate environment, a profitable company is usually going to be stable, where a company that does not make any money and is not profitable Yes, you're trading based on future earnings, but then if you have a lot of higher rates that are just cannibalizing the profit potential of a company, and it has the risk of going bankrupt, that's not something that I want to trade. I also look at correlations, and so I would rather trade stocks that are less correlated. And this is something that I can look at with our correlation tool. From a chart perspective, I want to trade stocks that are sideways or slightly higher with clear support, like I showed with Oxy and also Apple. And then from an earnings perspective, I do not like to trade stocks going into earnings, but I will take an earnings play where there's an overreaction to earnings and it still meets the criteria that I just mentioned, but you have this negative quarter, you have this overreaction, and there's still strong support. I'll definitely trade that. Now, when it comes to options, I only trade stocks with weekly options. In my opinion, it doesn't make sense to go out a month or more because I don't know what's going to happen in a month. It's hard enough to guess what's going to happen in 1 week. So I want to focus on something that's more consistent for me. And in the long run, I see there's more profit potential trading weeklies with less risk. This is where, from an earnings perspective, I don't sell puts unless there are at least 2 expirations before earnings. And then I'm typically looking at this week's expiration on Friday, Monday, and Tuesday. And then on Wednesday, Thursday, and Friday, I'm looking at this week's expiration and next week's expiration. So I'm only going out potentially 2 weeks max when it comes to the expiration. The bottom line, is it a stock that I want to own? Is it a strike I want to own the stock at? And if I'm not comfortable potentially owning a company for 3 to 6 months, if things do not go as expected, I don't want to take the trade, right? When I sold puts on Apple, I was totally okay owning shares of Apple for 6 months. It wouldn't have bothered me in any way. And if the stock moved lower, I'd be totally comfortable picking up more shares at a lower price. If I loved it at 167.50, I'd absolutely love it at 150, right? As far as puts go, I sell a put when the strike is at or below support, which is that lowest close level. And that's easy to see visually with the chart, but we have an indicator in PowerX Optimizer. If the VIX is really low, I might go a little bit above that level. If the VIX is high, I definitely want to be at or below. Option premium. This is where I like to see that I could get 30% returns based on the premium I collected for the period that I'm holding that option or I have that exposure. If it gets too crazy, I want to check the news to make sure I'm not missing something out there. On calls, I sell calls at my assignment price or cost basis when markets are in a downtrend or volatile. And if things are just plugging along, there isn't a whole lot of volatility, then I'd like to sell calls maybe 1 strike or 2 strikes above, so I have the potential to make money on the stock, which actually really helps in that situation, boost the profit potential. On the option premium, we see here 30% ROI. And if there is 100% ROI, I'll consider a higher strike price. On the exit side, real quick, 90% max profit up until Friday. So if I could sell a put for $1 and I could close it for 10 cents up until Friday, I'll do that. So I could reload, take the trade again. If the option still has enough premium where I can't do that on Friday's expiration, then I'm either going to get assigned or I'll let it expire. If there's a 1-day trade where I could get that 80% max profit in a single day, I'll do that. And that works for both puts and calls. I'll also consider closing the entire position if I could get 90% of the max profit potential to move on. I like to manage 5 to 6 positions. And this is where I will roll calls out if I get 60% annualized. I'll roll calls up if I'm bullish the stock and there's a potential profit at a higher strike. I don't roll puts. With my style of trading and with the wheel, the goal is really to get assigned. I want to get assigned. And so I'm not rolling puts. Rolling puts to me is defensive. And if the stock gets below my strike that I've sold, I'm offensive. I believe that now is an opportunity to make money, so I don't roll puts. And as a general rule of thumb, sell puts on down days, sell calls on up days. I don't trade when I'm sick or distracted. And if I make a mistake, I liquidate. I'm done. I close the trade and I move on. So this is the wheel strategy in a nutshell. This is my trading plan. My trading plan is not following this guy. Here, Marcus likes his baby pictures, probably because he remembers these guys from a broker that is not as great as Tradier. We love Tradier. I mean, actually, right now, Tradier is the only broker we support in the PowerX Optimizer software, which makes it really nice because we could actually trade directly through the software using Tradier's brokerage or platform. So let's hey, you want to forgive? Marcus is offering this, rockwell.rocks/audiobook. If you want to listen to the wheel strategy as an audiobook, it's pretty cool because when you access the audiobook, it will actually send you charts and all sorts of examples. So we wanted to make sure that that was available to everybody here for free if you are interested. So in a nutshell, that's the wheel strategy. That's how we trade it. And it's a great strategy for income and one of our core strategies here at Rockwell Trading. So looking at questions here, let's see. So the wheel strategy has a lot of similarities with Phil. Yeah. This is where the strategy itself, again, it's a stock and an options trading strategy as well. Sometimes selling premium is all about the option side, but by combining the stock purchase, I believe it really helps accelerate some of those gains when you pick up shares at a low price at a discount, and then you're able to sell calls.
Now you're at the end, right? Because we're here.
Yeah, there we go.
Hi, Mark. How are you? Great presentation as always. I love it.
Thank you.
Super easy. The bad news is that I have all these questions and you answer them all. You're so thorough. You answer them all along the way.
Appreciate it.
That's terrific. I wanted to know, what strikes you choose for the short strike for the put. You answered that. I want to know about the short strike for the call. You answered that. I guess the one thing I would ask though is, and I think it's embedded in your 30% ROI computation. But do you look at implied volatility for selling big fat premium or not selling too low premium, or is that all embedded in that 30% number?
This is a great question. And this is where, honestly, with the software, I get to cheat, right? Because if I didn't have the software, then implied volatility would help. And also maybe even delta would help. But with the scanner and it just working for us to find these 30% opportunities, then it's kind of all embedded in there. But yes, having some volatility is important. And then I'm also looking at where that strike is just on a chart relative to where I want to own it, right? Sure. Because if there's no movement, and here we will see like the drop in percent, which is the difference between the stock price and the strike. Normally in volatility like we have right now, I want to be maybe 1 to 2%, 1 to 3% below the current stock price. In a higher volatility environment, it might be 5 to 10%.
Okay, great. Let me throw a question in the screen for you. Can you see that, Mark?
Yes. Can you hold a stock for more than 6 months if necessary? You could hold a stock for as long as you want to hold a stock. I mean, you could choose to not let it go and just wait to sell calls, or, as it's moving higher, just, sell calls just outside of where it's closing to keep that stock. In general, I've found that for our style of trading, we're in a trade for 4 to 5 weeks if we get assigned. Most of the time, though, 80% of the time, the options are expiring worthless and We're not getting assigned.
Molly, I'm gonna go to you with your green background. By the way, you're muted. Oops.
So we're always talking. Can you hear me?
Yep. Yeah.
So I really love that you talk about fundamentals a lot. And, Rob Hoffman calls them techno fundamentals. Love that. And you don't invest in Chinese stocks. And with everything that's going on with BRICS and geopolitics, how do you, and you spoke a little bit on correlation, but how would you look at those companies invested in what's happening over there right now? And how would you incorporate some of those correlated stocks and balance, your strategy?
So I think that there's two key questions you need to ask. Is it a company I want to own? And is this a price I want to own the company at? And that's the strike price. So if you have any concerns about holding the company, in my opinion, there's other things to trade. There's always going to be something to trade. So if that doesn't sit well, like during the rate hike campaign, I stayed away from home builders. In hindsight, it was a bad decision because home builders went up. But if I got assigned shares, I would have not wanted to own home builders. I would have been frustrated if the exact opposite happened. All right.
Right,
So
fair
you
enough.
have to want to own the stock. And then as far as correlations go, this is where there's a calculation to see exactly what the correlation is based on 1 year, 3 years, or the historical data. I like to see that the correlation is below 0.6. So, that's kind of like portfolio theory where you're reducing your risk by having less correlation in the market. And that is something I look at.
And you seem that's a great answer. And you seem like the right person to ask about discipline. So you said you made a wrong turn there. What are your mental tricks when you're kind of in the thick of it?
Yeah, I think that we want the outcome, the gains, right? We want to make money. That's the only reason we're trading. We're not trading to lose money. But this is where at some point you have to focus on the process, the execution, right? The right decision. Am I following my plan? Am I trading my plan? Did I make the right decision? Not necessarily focusing on the outcome. I know it's hard, but I mean, this is where there is a little bit of luck. How else can we explain the success of those that we don't like?
Can you use, Mark, can you use ETFs as more from a macro market sort of standpoint? Do you do any of that at all? Or is it just pretty stock specific?
Yeah, and are there ETFs focused on the wheel strategy?
Oh,
well, yes. So as far as trading ETFs, I have no problem trading ETFs, but many times the ROI is going to be very low for the puts and calls that we're selling. IWM, though, works great. Typically, GDXJ, the gold miners, GDXJ, normally really good. And yes, there are covered call ETFs. And I had someone message me who's planning on creating a wheel ETF, but on the covered call ETFs, I've done a deep dive there. They're using synthetics. I believe that you could time things better without having that downside exposure like a lot of these popular ETFs have right now.
Cool. One more question. Sorry, Molly. You can't ask 10 more. Apologize. Only one. You have it, or am I going to ask it?
No, you go ahead.
Okay. So any ability to have, do you ever look at any sort of diversification with the portfolio of things you're looking at across the market, or you don't want that? I think you might have said that. So I just want to make sure I understood that.
Yeah, I don't want things to be too correlated. And this is where there's correlation tools out there. We have one built into the software. And so basically 0.5 correlation based on closing prices over 1 year. That to me is a little bit of a warning, and 0.65 would be a no. So I don't want to trade like QQQ and NVIDIA and everything together, or everything oil. I'd rather have a little, like, there's going to be a certain amount of correlation because the market moves higher and they move together, or they move lower and everything moves together. But I like to be slightly diversified from a correlation perspective.
Perfect. Okay.
I do have one more. I'm curious. So we have the Mag 7, and they're, like the Brad Pitts and the, whoever guys for Jennifer Aniston. No. Give me an actress, you guys.
That's good.
Who do you love?
You're doing good. I like it.
Okay, Angelina Jolie. So they're the major stocks, and they get the spotlight, and everyone's heavy on those. So the wheel strategy seems like a really good way to go if you're, the underdogs that you're not quite sure of. So do you play those ever? And if so, are you careful how?
So I'm absolutely okay trading the Mag 7, right? NVIDIA, Microsoft, Apple, Google, but it could be that sometimes there isn't a whole lot of volatility in those names if they're just, moving up slightly. Also, if they're getting away from a level that I would actually want to own shares at. So I wouldn't necessarily say I want to focus on the underdogs, but I'm absolutely okay trading some lesser known names as long as it's a profitable company that meets the fundamental criteria that I mentioned in my plan.
Cool.
Okay, got it.
All right, Mark. Great presentation. Thanks for staying with us for a few questions. Yep.
And congratulations on making LA Weekly cover. I know that was a bit ago, but
congrats. Yeah, I saw that. Marcus
Yeah,
was
That
on.
was the guy with the bigger hair than I
There
have.
you go.
But,
like
yeah, I'll pass it along.
Germans living in Texas on an LA cover. I'm like, how do you do it? I don't know.
Yeah, it's fun working with Marcus. It's he's a character.
All right. Well, say hi to Marcus for us. Great job, and we'll talk to you soon. Thanks, Mark.
All
There you
right,
go.
take care.
Bye now. Remember to visit hub.tradier.com. Join the Tradier Hub for free for all your market insights, trading ideas, market news, and daily live shows with industry experts covering all aspects of the financial world. All right, Mal, moving along. We have
Mandy.
from the SIBO, Mandy Zhu, who is the head of derivatives market intelligence at the SIBO Global Markets. Chatted with Mandy recently over at SIBO. She's a smart lady. And she's going to give us some insights, I believe, on some SPX data, some DSPX. So I'm going to let her go to town. We got to get out of her way because she's got some stuff to do. We are going to come back in after about 20-ish minutes. Mandy will cue us when to come back in. We'll have some Q&A after about 20 minutes or so.
I'm really into this. She has great articles about volatility and Volmageddon and all that from SIBO's perspective. Really great stuff. So go check her out. And here she comes.
Here she comes. Bing.
Great. Thanks for having me here. Thanks, Lex and Molly. And thank you, everyone, for joining. So as mentioned, I'm Mandy Zhu, head of derivatives market intelligence at SIBO Global Markets. We are the oldest and the largest derivatives exchange in the US and the home to SPX and VIX options, as well as many more. And what I wanted to do today is give a very short presentation on themes that we're seeing in the derivatives markets. And then I'll turn it over to Lex and Molly for conversation, for more of a discussion style. But I thought, it's interesting. It'll be interesting to start with some high-level themes and trends that we're seeing at the SIBO, as well as some commonly asked questions that we're getting from investors, both retail as well as institutional. So if we could cue up the slides. Perfect. I know the theme for today is navigating volatile markets. And I think, the first question that people are probably going to ask is, where is the volatility, right? And that's a very fair question. If you look at the VIX index, what has really perplexed a lot of investors, I think, has been the very notable and large decline in volatility that we've seen over the past year, right? So this is just a chart of the VIX index. And so you can see we went from an average of about 26 in 2022 down to 17 last year, and year to date, we're on track of averaging just 14 in terms of level of volatility. For those not familiar, the VIX is a benchmark measure of volatility in the market. It specifically measures how much the S&P 500 index is expected to move in the next 30 days. And what we're seeing in terms of levels of volatility right now, it's near it's one of the lowest, I guess, year-to-date averages that we've seen in recent years. So on the back of that, I think it's surprising to a lot of people given the macro backdrop, right? We still have a lot of uncertainty regarding level of inflation, direction of interest rates, as well as escalating geopolitical tension. So a lot of headlines recently and chatter around kind of why is volatility so low and is it somehow being suppressed? And a lot of the headlines and the conversations have focused around this idea of the short volatility trade getting too big and therefore suppressing levels of volatility or levels of the VIX. So let me kind of back up a little bit and describe what I mean by short volatility, right? So typically people use that term to talk about trades where you take a view on level of volatility, where you make money if volatility declines. So that's what it means to go short volatility. And there are many ways you can do that. Traditionally, you can do it through, VIX options, VIX futures. You could do it with VIX ETPs. Obviously, you can do it through S&P options, typically delta hedged, as well as some, over-the-counter instruments like variance swaps. But lately, a lot of attention has focused around the growth in what a lot of people call derivative income funds. So these are ETFs and mutual funds that sell options for income. The most popular of which are your cover call overwriting funds. So selling call options on top of stock positions, right? And as you can see in this chart, this is a chart looking at the total assets under management of all the derivative income funds in the Morningstar database. So a pretty comprehensive database. And you'll see in terms of total AUM, that has gone up from about 20 billion in 2019 to now over 130 billion. So a growth of over 6 times in the last couple of years. And why this is coming into the conversation is because these funds, as we mentioned, sell options, right? Typically sell call options for income. So when you sell an option, you are quote unquote selling volatility, you're short volatility. So a lot of people are kind of pointing the finger at these funds and the growth in AUM of these funds as kind of the reason why we're not getting a lot of volatility in the market. I strongly disagree with that. I think that is a misconception of what these funds do. It's a conflation of the term or a misunderstanding of the term short volatility. So kind of let me explain. So why do I not think these funds are part of the reason why volatility is low? Well, first of all, when we typically talk about short volatility trades, right, we're talking about trades that, again, your P&L is directly tied to levels of volatility. These funds, think about a traditional call overwriting strategy or call overwriting fund. Yes, they're selling options, but they're selling options for income. They're not selling options to express a view on volatility, right? And think about a case where, the stock or the broader market sells off, volatility spikes, let's say it even doubles. Well, what happens? Well, you're actually making money in this case on your option position by selling the call, right? You're better off having sold that call versus just holding long stock because now you get to keep the premium. So your P&L is absolutely not tied to the level of volatility. That's number one. Number two, why people look at short volatility trades and are so concerned with the size of the quote unquote short volatility trade is that a lot of times these trades are levered bets on volatility, meaning that if volatility spikes, you will have to cover your trade, you'll be forced to unwind, and that forced unwind can actually exacerbate the volatility move. That's exactly what happened, for example, in February of 2018 during the Volmageddon spike that we saw in the VIX, as well as partly one of the reasons why volatility went to 90, VIX went to 90 in March of 2020. The key thing to keep in mind with these derivative income funds is that they are unlevered, right? They are cash secured, either selling cash secured puts or more commonly covered calls. There's no leverage. Again, market sells off, you're not forced to come up with additional capital as a result of it. So speaking of, okay, so the growth obviously in these strategies, could these strategies, be the reason why volatility is low in the equity market? To me, the most convincing evidence why these are not to blame is the fact that if you look at volatility levels across asset classes, the decline that we have seen is felt or is evident across asset classes, which to me means it must be macro fundamental driven, or to quote James Carville, it's the economy, stupid, right? So the fact that volatility has fallen is not for some nefarious reason or due to growth of any particular strategy. It's really a shift in the macroeconomic outlook that we've gone from everyone fearing a recession, expecting recession, to now firmly on track for a firm landing. We'll see ultimately if we do get that firm soft landing. But certainly that is the consensus expectation right now. So what this chart shows you, there's a lot of squiggly lines, but essentially it's a cross-asset comparison of volatility across the different asset classes, and we're standardized it by the Z-score. So the way to read this is that each line represents the volatility of a particular asset class compared to its own long-term 10-year history. And the Z-score tells you the current level, how many standard deviations above or below average it's trading. So if it's +2, that means it's rich. It's 2 standard deviations above average. If it's negative, it means it's trading cheap or low. Say it's -1, that's 1 standard deviation below its own long-term average. So what you'll see is, if you look at the start of this chart, which is October of 2022, at that point in time, every single asset class, whether it's rates, whether it's credit, it's commodities, it's FX, every asset class had volatilities trading between 1 to 4 standard deviations above average, right? So that was kind of during the peak, Fed hiking, fear of inflation, fear of hard landing, very elevated volatility across asset classes. Now you fast forward to now, and every asset class, again, with the exception of interest rates, it's trading below average now. And if you look at the red line, which is equity volatility or the VIX, it's firmly kind of middle of the pack, right? It really doesn't stand out as being particularly low or particularly high compared to, say, volatility in the credit market, volatility in the currency markets, or volatility in the commodity market. So to me, again, the fact that it's so broadly felt and experienced across asset classes, to me suggests that the decline volatility is really just a reflection of the improvement in the macroeconomic backdrop. But if we kind of shift back to the idea of kind of short volatility trade and whether or not it's getting too big, one of the things you can look at to really gauge that is the volatility risk premium in the market. So in simplistic terms, what the volatility risk premium measures is the difference between the implied volatility of the market, in this case S&P, versus the realized volatility, how the market actually behaves, right? So this risk premium, this VRP, is historically always positive, typically, right? It's what rewards option sellers. It's, you think about the insurance premium, if you will. If we were to see a lot of sellers in the market, if the market is now being kind of inundated by option sellers, volatility sellers, what we would expect, all else equal, is for the volatility risk premium to shrink, right? For the implied volatility, the difference between implied to realized to be lower than what you typically see. But in fact, what you'll see is over the past year, the volatility risk premium has actually doubled and is actually trading right in line with long-term historical average. So that to me suggests what we're seeing in the market is not a market that is being flooded by volatility sellers or option sellers, because if we were, you would not see this, richening of the volatility risk premium in the market. And then specifically, we focus on the call overwriting trade, which has been, again, in the headlines a lot. A lot of people talk about the growth in the cover call writing. What's really interesting, and this is a chart, and I'll explain what this chart shows, is this is a chart of S&P call skew. So it's a little bit maybe esoteric, but what skew typically measures is the difference between, say, the volatility of puts versus calls, right? So skew typically, you can think of it as a sentiment indicator. When skew is high, it typically means there's a lot more demand for puts versus calls, and people are a lot more bearish to the market, a lot more demand for protection. When skew is low, it's the other way around. This chart in particular focuses on the call side. It's looking at call skew, and it does so by looking at the difference of an out-of-the-money call option versus an at-the-money call option. Now, when this line is high, what it means is there's actually a lot of demand for those out-of-the-money call options. That the out-of-the-money call options are actually very expensive relative to the at-the-money. Whereas when this line is low, it means the opposite. It means that there's very little demand for those out-of-the-money call options. People are not very bullish on the market, and call skew is low. So the reason why I think this is relevant is that, again, if you think the dominant kind of theme or flow in the market is call overriders or call sellers, you would expect this line to be very low, for the out-of-the-money call options to be very cheap, as we see a lot more sellers in the market. In fact, what you see is actually the opposite. Call skew is actually at a decade high, meaning that the out-of-the-money call options on the S&P right now is extremely rich relative to the at-the-money. And it's rich because the dominant force actually in the options market right now, in the S&P at least, it's upside call buyers, people chasing the upside, right? Trying to get that upside exposure through buying of out-of-the-money call options. And we're at levels that's pretty unprecedented, at a 10-year high in the market. So I thought that's interesting. And this demand for upside call option, that's been something that's getting a lot of focus from investors, both institutional as well as retail investors. And a lot of questions I get has been around this idea of, is this kind of complacency in the market, lack of demand that we're seeing for put options, the record high, near record high demand for call options. Are investors too complacent? And one of the things that I always point investors to, kind of, you just look at how the S&P is behaving. So forget about what is being priced in the options market. Just look at how the S&P index has been behaving. What's really remarkable is that recently we've seen more volatility on market up days than market down days. So the outsized moves, the big moves, have come on rallies rather than sell-offs. And that's very unusual because typically, I mean, as the adage goes, right, the market takes the escalator up and the elevator down, meaning that the down moves are always more violent moves. And that's why typically, puts trade at a very significant premium to calls. But if you look at how it's behaving year to date, we're actually seeing more volatility on up days than down days. And it's been actually the case for now going on almost 2.5 years, right? Ever since 2022, we've seen this inversion in the market in terms of behavior. And if you look at it going back further in time, the last time we've been in a similar environment where the more violent moves have been to the upside, you'd have to go back to the early 2000s, right, on the heels of the tech bubble bursting, to really find a similar dynamic. I think that's why you're seeing that demand for the upside calls, because people buy options. Part of the reason is at least to manage volatility. And what we're seeing in the market right now is higher volatility on up days. So I think that's really interesting. And certainly, I think it's a reflection or partly driven by positioning, the fact that over the past year, especially if you think about the beginning of last year, consensus investor sentiment was just so bearish. Everyone was underinvested into equities, underallocated to equities. And then obviously on the back of the rally, people having to chase, so using call options to hedge their upside risk rather than downside risk, because that was the risk that they were most vulnerable to. I think that explains why some of the dynamics that we've seen in the options market. Okay, so having said all that, where are we seeing fear in the market, right? We're not really seeing fear in terms of where S&P put options are trading relative to call options. As I mentioned, there's actually been a lot more, the call options are actually really rich right now compared to the put options. Well, one area we are seeing fear in the market, and we talk about navigating volatile markets, where we're seeing record activities, is actually in VIX options. So the first chart on this slide shows you the average daily volume in VIX options, looking at annual averages. And what you'll see is over the past year, we've seen a very significant pickup in VIX option activity. Last year was actually a record year in terms of VIX option volume. And this year to date, at least, we're on track to exceed last year's record. So we're seeing even more options trading this year than we saw in 2017 in the lead up to 2018, the big Volmageddon spike. And if you look at where that volume increase is coming from, it's very much driven by demand for VIX upside calls. So investors buying upside calls in VIX, kind of playing for or hedging against a volatility spike in the market. And it's really notable, and especially because we're not really seeing an equivalent explosion in VIX options. So I would say the difference between hedging with VIX options versus, say, S&P put options is that VIX options I think of as more of a tail hedge, right? It really pays out when we get that big black swan event that causes volatility to really double or triple. So people buy VIX upside call options for that convexity, right? That explosive move in the VIX when we get that big tail event that hit the market. Think, March 2020, for example, when VIX went to 90, or Volmageddon, again, when VIX spiked very quickly over the course of a day or two. And it's easier, obviously, to get that big move in the VIX when it starts out at a low base, right? So when VIX was trading in the mid 20s, as it was in 2022, it would take a big catalyst for it to double or triple. Whereas now VIX at 12, it doesn't take a lot for VIX to go from 12 to 24 or from 12 to 36. So part of it, I would say, is a function of just lower levels of volatility to begin with, right? You can, more easily see a jump in volatility, hence the increase in interest. And again, it's not surprising that the previous previous record that we saw in VIX options was in 2017, which was a record low year in terms of volatility for the broader equity market. But I would say that's, one factor. Certainly is not the only factor, because you've seen years in the past, for example, 2019, which was also a low volatility year, where there was positioning. And this is particularly for institutional investors as they get more and more levered, or as they, increase allocation into equities, that demand for hedging naturally increases. And right now, in terms of what people preferring, they prefer VIX options because of the fact that it kind of holds with VIX at, when you buy an S&P put option, the market continually kind of goes up, your put option becomes worthless much quicker than, say, a VIX option. But I do want to just flag the kind of the record activity that we are seeing in VIX options. This flag last month, April 12th, if you recall, that was the day when Israel had that, that potential escalation that, people were really worried about. We had 2.6 million contracts trade in VIX options on that single day, higher than any point. If we flip to the next slide, in terms of catalysts that people are focusing on, one of the things I think is worth highlighting is just what is being priced in. Action might be having a problem. Hold on one second. There we go. Okay. So I do want to highlight kind of what is currently being priced into the volatility markets for the US election. And already we're seeing a pretty healthy risk premium being embedded in the VIX futures curve. So VIX futures curve, what I'm referring to is, VIX futures. So, of different tenors. So you'll see in the first chart, you'll see where the spot, which is where VIX index currently is trading. And then you'll see the price of the various different tenored futures, right? The May future, June future, July, et cetera, going forward. And what you'll notice is a very big bump for the October future relative to the September future. So right now it's about a 2.5 point premium that is being embedded into the October future versus the September. So really reflecting the expectation that volatility is going to be about 2.5 points compared to September. Now, what's really interesting about this election risk premium that we're seeing in the VIX future curve, first is that we're seeing it a lot earlier than in previous election cycles. For example, in 2020, at this point in the curve, now it's 2.5. Right, so it's a lot bigger, and secondly, given all the headlines and potential talk about contested election, what is also notable is that that's not what is currently being priced into the market. If you look at the November future, it's actually showing lower levels of volatility compared to October. So expectation that volatility will normalize, will subside post the election. Now, one of the reasons I think that we are getting this kind of meaningful election risk premium being priced into the market this early on is the fact that the last two elections have produced pretty notable increases in volatility, right? So the second chart kind of shows you the increase in the VIX index in the month leading up to the election for the last 30 years. And you'll see is that outside of 2008, which if you recall, that was during the global financial crisis, right? So I would say that's a very unique case. So if we exclude 2008, the last two elections, any other election cycle in the last 30 years. So I think due to this recency bias and the fact that we have similar slate of candidates running this time around, I think the market's getting ready for that volatility pickup, a lot sooner than typical. So with that, I'm going to pause here. I do want to, flag that we are publishing both a weekly note as well as periodic notes around themes and flows that we're seeing in the derivatives market. So if you are interested and you want to subscribe, There is, I've left up on the screen a QR code where that will take you to a web page, as well as a periodic note around notable themes and flows that we are seeing in the derivatives market. In addition, I'm also running a monthly webinar, usually with guest speakers from around the industry, around relevant topics, as well as new products that the SIBO is introducing. So, please subscribe if you're interested. And then last, but I want to invite Lex to join in the conversation.
Hello, Mandy. How are you? Can you hear me? I think Mandy might be having a little bit of internet difficulty.
Hopefully my connection is okay. I know it was a little spotty.
Yeah, it's a little spotty. That's okay. We'll work through it. Great job, though. That was awesome. You know what thing strikes me a lot is when you mentioned the call put skew, and you said calls were inverted what to the upside in the skew, which is generally unusual. Myself being a contrarian says that the end is near. That scares me a lot, by the way. Any more comments on that one? We're used to seeing a skew where puts are over calls, and it sounds like calls are over puts, or at least flat with puts. And that to me says everyone's happy on the bullish Kool-Aid right now.
Yeah, so to be clear, the skew in S&P is not inverted right now. It's just the lowest it's basically been on, right? So it's less negative than it used to be. So to be clear, yeah, so puts are still trading at a premium. It's just a very small premium relative to calls. In some other indices, however, they have gotten inverted. So what was notable was in December this year, as well as I believe in February, the Russell 2000, if you look at the small cap index, that skew actually did get inverted, meaning calls were trading at a premium to puts, which you almost never see at the index level, right? Because again, indices, as we know, it's markets grind up and crash lower. So that was really interesting that in the small cap space, we did see an inversion in the skew. Now, if you look at single stocks, of course, it's more common to get inversion in the skew because we do have obviously, some names that are very known to have these outsized upside moves. But at index level, it's very rare, but it is very low right now. It's a historically low levels of skew. So the theme is still very much And whether or not you think that's complacency, euphoria, certainly, up for debate, but I would
opium, right.
That's like all the above. I'll take a shot of bourbon, a shot of tequila, and a shot of vodka. Okay. We're not going to let you get away without talking about zero DTE a little bit.
Oh, yeah.
So we got to go there. You okay with that, Mandy? All right. Of
course. Yeah.
Yeah. I had a question on zero DTE a while ago, and I think you tell me the statistics, you know better than I do, but it seems like that complex has grown tremendously. It's massive, right? And someone asked me, is it people who used to trade farther dated options have now moved into zero DTE, or has zero DTE caused an inflation of the whole C rising in and of itself? So is it more volume first, and not people shifting? So what do you think the answer is there?
It's the second. It's more volume. So zero DTE has been by far the fastest growing segment of the options market. And people often think because it's the fastest growing that it's taking share away, that it's taking volume away from the other longer dated tenors. But when we look at absolute volume, the non-zero DTE option volumes have also been increasing in recent years. So it's not that people stop trading longer dated options and are just shifting to zero DTE. It's the whole pie is growing, and the zero DTE segment is growing the fastest. And I think it's growing the fastest is because we're opening up a whole new risk premium for investors to trade using options, namely intraday risk, right? That was not a risk that you could efficiently and effectively monetize using options prior to the listing of a daily expiration every single day. And now that we have that in SPX and as well as Russell, and the fact that it's very liquid, it's very easy to trade, electronically and through the screens. We're seeing a lot of people using 0DTE options to play intraday momentum, market reversals, as well as using 0DTE options for hedging purposes, as well as income generation purposes. So it's opening up a whole new risk premium that wasn't available before. While the traditional use cases for longer dated hedges in the market, that still exists, and we're still seeing steady growth there. It's just not as obviously fast as the growth that we're seeing in 0 days.
Okay, got it. Mal, I'm sorry. Did you have a question before I interrupt you?
Zero TDs, and I don't know if you want to brief. We have a lot of new guys on here, so I don't know if you want to briefly to just say what a 0DT is, but it feels like the machine's revving up and it's getting faster and faster, and it's a big month for Cboe because it's the window close of T+1 settlement testing. So with T+1, I don't know if you think that with same day settlement that this will improve risk, will it affect liquidity? What's your take on that?
Yeah, sure. So I think for those who are not familiar, 0DTE options refers to, so it stands for 0 day to expiry options. I think one common misunderstanding is that people think it's a brand new product that was just recently introduced to the market, when in fact, all it refers to is trading an option on the day that it expires, right? So in that sense, 0DTE trading has always existed. It just didn't used to be that many opportunities to trade a 0DTE option. It used to be quarterly, then monthly, then every week on Fridays. And now we have daily expirations being introduced in SPX and Russell 2000. You can actually trade a 0DTE option every single day. So that's all it refers to. In terms of the size of the market, it's grown to a year-to-date average about 48% of all SPX, S&P 500 index options.
That's incredible.
We're in 0 day options. It is a humongous number, and that growth, it's been very steady. So, last quarter was a new quarterly record. We'll see what this quarter brings, but it's been very steady and very impressive growth, through the past couple of years. And in terms of settlement, I think, one of the reasons why people trade 0DTE options on SPX index is for the cash settlement, benefits, if you will, of index options compared to, say, ETF or single stocks, where you have that physical settlement risk. So that is one of the distinguishing features between index versus, ETF or single stock options.
Sure. And who are you seeing, Mandy, using that 0DTE product mainly? Is it a big retail flow? Is it institutional? I know the market makers are always on the other side, but who are you guys seeing using this product the most, do you think?
That's a good question.
Sure. It's actually pretty balanced.
Oh, good.
With a caveat to say that obviously it's hard to know exactly who the end investor is. I can give you some stats, right? As an exchange, we obviously see a lot in terms of the flow. About 80% of the flow that we see in 0 day options at SPX originate from a retail brokerage firm. However, and I would caveat that saying that a lot of retail brokerage firms also service institutional investors. So that's not the best that's not the most realistic breakdown. When we look at other criteria, for example, frequency of trading, size of trading, things like that, our estimate is about 60% of the flow in 0DTE is what we would call like professional or institutional investors, and about 40% are more like retail flow. So it's pretty balanced between the two, I would say. And what's I think interesting is that even among the retail segment, I think there's a misunderstanding that people think, oh, the retail activity in 0 day options in S&P is very similar to, say, the retail activity that we see in, meme stocks, right? Like in GameStop or AMC, when in fact is actually very different. So we're in SPX 0 day options, we actually see a lot of option selling for income, not just option buying for leverage, for speculation. So it's a pretty balanced use case between investors using these options for income, selling these options for income, as well as buying these options for directional leverage.
Right. Good. And then I can't let you get off 0DT without this question, right? Because everyone talks about this. Does the zero DTE options pose a systemic risk to the markets? Is there a Volmageddon coming? There's been papers written on this.
You've written a couple great ones, by the way. Go check those out. I love those.
Check Mandy's work on this. I have an opinion on this, but I'd rather hear the professional's opinion on this.
Right. By the way, professional being Yale grad over here. That's a big deal. And, economic.
Harvard grad.
Oh, Harvard. Oh, sorry. Oh, someone told me.
Now she's mad at you, Mal.
Someone told me.
So what do you think?
There's a rivalry too. There's a rivalry there too. Yeah.
What do you think about that, Mandy? The Volmageddon kind of
okay,
comment.
so in terms of systemic, yeah, no, for sure, that's a very fair question, and I think again, the fear of zero DTE really comes from the fact that it's huge in terms of notional volume, right? I talked about 48% of SPX options now 0 days. We're talking 1.5 million contracts a day, 800 billion in terms of notional. So when people hear the big number, they think, wow, this must be having a huge market impact. If everyone is, one way in these directions, in these trades, it must be making, it must be making an impact on the market. And the key thing I want to emphasize here is that notional volume does not equal risk. High volume does not equal high risk. What matters is the balance between buys versus sells, right? And the reason why I say that is because you think about it, like 100,000 contracts trade, right? It's a huge in terms of volume, in terms of notional size. But if 50,000 of those contracts was customers buying and 50,000 was a customer selling, the net, despite 100,000 contracts being traded, market makers on the other side of the trade actually have zero risk to hedge because the flow is perfectly balanced. Now, in reality, is it perfectly balanced? No, but it's pretty close. And I think that's what people are surprised to find out is they think 0 day options, everyone's speculating, everyone is buying these options, market makers are all short. Therefore, their hedging activity is going to have an outsized impact on the market. But like I mentioned before, a lot of people are actually customers are selling these options for income. So the customer flow on a typical day, we're talking 51, 49, 50.5, 49.5, like extremely balanced such that the net risk, we're talking a couple 100 million of quote unquote gamma for market makers to hedge, which in the context of S&P liquidity of 400, 500 billion, it's less than 0.1% of the S&P daily liquidity that is actually being going through in terms of market maker hedging. So it's very de minimis as a result. And the second thing to kind of emphasize is if you look at customers when they're selling these options, vast majority of the trades are happening in capped risk format. And I cannot emphasize that enough. People are not naked short puts and calls in S&P 0 day, or very few. Less than 5% of the volume is that. Most people, when they're selling options, are doing it in spreads. So they're selling put spreads, they're selling call spreads, where again, your risk is defined and limited at the outset of your trade. And that's why I think, a lot of the risks around, Volmageddon is overblown because it's all in capped risk format.
Right. Great answer.
It's so neat coming from you because, there was some slack given on the Volmageddon deal. And so you have the inside scoop because you see the data with SIBO. And that's really important to point out that you don't really hear about on the news. So it's important to go get your information direct from Mandy here. And also, Lex, you as a market maker, also smooth things out. So there's that component as well. So it's a really interesting, I love Volmageddon. I loved what happened there and the ins and outs. And it was, I loved your articles. I read them a couple of times. It was really good.
Cool. Well, Mandy, thanks so much for coming on. I know you're traveling, and I really appreciate you doing this while you're traveling. This was awesome. You are a wealth of information, so terrific job. Thanks so much for coming to the summit.
And Mandy is actually at the pool, so that's why she has the fake background in the background. Yeah, she's getting a tan.
That's right.
Yeah, I'm actually at a conference in Las Vegas, so you're not too far off.
Perfect.
Vegas. That's great.
Yeah. Awesome. All right, Mandy. Well, okay, great. Thank you so much for coming on. It was awesome. We'll catch up later. Thanks for coming. Yeah, the noise factor, right? So when I traded, all I had to do was react. I was on the floor, I was a market maker. Very much different from what you have to do today in the digital world. There is a lot of noise. So you hear a lot of opinions, you hear a lot of ideas. You have to have the ability to sift through what the noise is and what is important. In addition to being able to do that, you also have to have a massive discipline. If you don't have discipline in this industry and you can't get the emotion out of your trading, you're going to struggle. We really hope that the hub will give you a place where you can communicate with like-minded people. It's a great community. People will think like you do. They'll have ideas like you do, but you also have to find a place where, you know, something matches your personality and what your ability is and where your risk tolerance lives, right? And if you first step is to get all that noise out of the equation and then focus on what fits you as an individual. It's super important. That was a little commercial. I didn't even know I did that one.
Is that you? Who's that good-looking guy in there?
Oh, go on. Okay, let's keep moving here, Miles. Sorry to be so fast, but we got to keep it rolling. We got a lot to do.
Good. Keep us on track.
Yes.
Lex.
Next up, Mr. Luis Silva from Opcion Sigma. He's a great friend, great entertainer, just unbelievable trader. We are so excited to have him. I'm not going to say any more about Luis. Everyone knows him. You can see all the quotes coming in now or the comments. It's going to be a lot of quotes in Spanish, just so we're clear.
Yeah, we have a lot of Spanish people. So he estado todo el día esperando todo el día ver la presentación de Luis. So gracias por su tiempo y bienvenidos al Summit, Luis. Y let's go. I'm really excited to see this one. I've been waiting all day to see him. So this is
all right, Luisito. We'll catch up with you at the end of your presentation. Have at it, buddy.
I like the way that you introduced me, Lex. He's a great entertainer. So, well, let's go. Let's do it. How you guys doing today? ¿Cómo están todas las personas de habla hispana? Okay, we're gonna present. I don't know if I can share my screen. Probably if you don't know me, my name is Luis Silva. For those that know me, yes, it's still my name, Luis. So we're gonna talk about best times that thrive on volatility. This is a very emotional topic to me because I was here last year at Tradier Summit and we talked about volatility, but the conditions at that time were pretty different. Now, well, as you can see all day long, what's going on with the volatility nowadays, well, is a challenge, especially for those who are like me, who sell volatility every day, basically. So, but we're going to figure out a way that we can deal with this market with low volatility. It doesn't mean that this is the lowest. We can see even lower levels, but we'll see what happens. So, just to recap, what is implied volatility is just the forecast of the movement of the stock price over an index. Is used also to price the options contract. Is the most critical, I will say, variable to price the options contract. So when basically this is the general rule, when we have like a down market, a bear market, the volatility increases, and when we have a bull market, the volatility decreases. This is a topic that actually Lex touched in our last Sigma Summit. By the way, Lex, I loved your t-shirt, the Sigma Summit Volume 2. Basically, we haven't seen like a lot of volatility during the past months. And also, so for some people, volatility is something that scares them. It's not supposed to scare you. Well, that's for beginners, that's for newbies. It's something that you can navigate with. Así que la volatilidad es algo que no deben tener miedo, es algo que realmente deberíamos navegar. So we're going to switch between Spanish and English just to be fair with our audience who speaks Spanish. So that being said, So where is the volatility? Where is my volatility? Because last year we were talking about so many strategies when the volatility was high. We have a VIX over 22 or 23, as far as I remember. Now I saw the VIX this morning under 12. This put us some pressure for us who always just do some strategies like iron candles, iron butterflies. So we want to have some volatility to play those strategies. And those strategies play really well when we have an environment of high volatility. But what happened when we have these conditions? So we don't know if the volatility is going to continue dropping for the next in the future, in the near future. But for sure, we will see some strategies that you can accommodate in order to deal with these low environments of volatility. So lo que vamos a ver es que no sabemos qué va a ocurrir con la volatilidad durante los próximos meses, durante el futuro próximo, pero lo que sí vemos es que podemos lidiar con algunas estrategias que se adapten a estos mercados de baja volatilidad. So this is the historical performance of the VIX during the past year, as you can see. So we have some peaks during the past year, but the higher that we have got is on the 20 area. Now we are under 12. So this is the historical volatility between 2019 and 2024. As you can see, a peak during the pandemic, during the COVID, so in like March 2020. Now we've seen like the lowest level probably in how many years? Probably 5 years. So we got to go back to 2019 in order to see these low volatility levels. We have some low volatility levels on 2021, around mid 2021. But yeah, so we were very comfortable playing with the volatility around 15, 16. I'm talking about implied volatility. I'm not talking about VIX. So when talking about VIX, so we feel more comfortable to play some strategies when VIX is above 20. That is not the case, right? This is what happened during the past year. Okay, so the volatility, as you can see, is decreasing, and this is a good thing. So if we open some strategies, long-term strategies selling volatility, well, this is a good thing because the volatility has dropped dramatically, and also we've seen our revenue and our profit and loss. You can see some gains because this drove volatility. But guess what? This is not going to happen all the time. This is a very, very special, I will say, moment in time, moment in history that we've seen continuously during the, I don't know, maybe 12 months, probably 18 months, a continuous drop in volatility. So that's a good thing. But what happened when the volatility again tried to rise? When the volatility start picking up again? So this is something that we need to overcome. This is something that we need to live on. This is something we cannot avoid. This is something we need to like embrace and try to play with it. En este caso, pues lo que hemos visto durante estos meses es que la volatilidad ha caído dramáticamente y este es un evento que no vemos continuamente. Lo que hemos visto durante los últimos 18 meses es que la volatilidad ha caído dramáticamente y está en unos niveles terribles, en donde vean la volatilidad histórica que está marcando. Esta es la volatilidad histórica, by the way. This is the historical volatility from XPX. Esta es la volatilidad histórica del SPX. So that being said, if we continue to move lower, probably that's going to put some pressure on the strategies we're gonna play. Because if we're like used to play iron condors or iron butterflies with this low environment of volatility, guess what is going to happen? Cuando hacemos estrategias como los iron condors y como los iron butterflies en estos niveles de volatilidad baja, adivina qué es lo que pasa. So what's going to happen is that we're going to see a decrease in the premiums that we're being paid. So lo que estamos viendo es que hay un bajo nivel de los premiums, de las primas que estamos recibiendo. Hablemos de una recesión de primas, and that's not a good thing for people who wants to like sell premium all the time, like me. So what is the goal? If the volatility is rising, and hopefully is rising again, and we're going to see some events that the volatility is going to peak again, probably, I don't know, next Fed meeting or next release of macroeconomic data. So we're going to see some volatility, probably not the best, but we can have some strategies like a double diagonal. They can like when the volatility is increasing, you can benefit from these type of strategies. There is another one, a reverse item butterfly. If we play a reverse item butterfly, which is basically a straddle, but we're going to benefit from a large movement on the market, but we have some wings. That's the difference between the straddle and the reverse item butterfly. So es básicamente un straddle lo que tenemos con un item butterfly, and if we play with it within the low implied volatility level, probably is going to benefit, because once the volatility increase, so the options premiums are going to increase, and since this is a debit position, so the person who's playing this strategy also is going to benefit from the increase in the volatility. But what happened we have a drop in volatility? That is what we've seen during the last year. So as you can see, we can play like short strangles, we can play short straddles, we can play iron condors or iron butterflies. Actually, the best strategy we have played during 2024 is the iron butterfly. It performed really well during January, February, March. April was not the best month. No, April was good. May hasn't been a great month for iron butterflies, because we have the credit we're receiving when we put, and I'm talking about 0 days to expiration. So en el mes de enero, en el mes de febrero, en el mes de marzo, incluso parte de abril funcionaron muy bien, pero cuando vemos que hay una caída en volatilidad, los premiums son menores, y eso hace que de alguna manera tengamos un poco más de riesgo, estemos más ajustados, porque los movimientos, un pequeño movimiento puede hacer daño. So what's happened when we receive like a lower premium is like a very, very small movement can cause us pain. So that's why I like to play with more volatility when the volatility is higher, because you can cover yourself a little bit more from the movements that the market produce. So this is a good strategy. Like I said, we've been testing this strategy, not the iron condor, the iron butterflies, for basically all to 2024, and this is working really well. So could we come up with a strategy that does not require like complicated technical indicators, or doesn't require a lot of knowledge, more than just study options and see how it performs? Something very straightforward. So I'm trying to give like the new investors a way that they can like start to invest in options very responsibly without technical indicators. Yes, so we came up with this strategy, and actually that benefits not from volatility, is from probability. So I'm going to show you guys. We in the community of Option Sigma, there are like a few people who are contributing to this, and we came up with this. This is the Analytica of XPX. So basically, in our resources, you can see the performance of this, the journal of this strategy that we have been using into 2023. So basically, we have done 66. It's a little bit more because it is up to date until May 1st. So we are putting everything together in the Analytica tab. But as you can see, we have 66 transactions, and 61 positives, 5 negatives, and the total profit just doing one contract is over $7,000. So the risk that we take every day average is $1,200. And the time we spend in the position is about 44 minutes. La mayoría de las personas de Opción Sigma ya conocen esto, así que no se los tengo que presentar. But for the English audience, I'm pretty sure probably if you're not aware that there are these type of strategies, well, you're aware now. So we have this tool, the Analytica of XPX, which is basically something that we create in Sigma Option. So we've been tracking the iron butterflies. We're going to start tracking also iron condors, but we've been tracking iron butterflies for a couple of years now. So we have not the amount of data that, because we can backtest, but I strongly believe that the best backtest you can ever put out there is just doing the actual operation, doing the actual transactions. So we basically came up with this. So, and I'm going to say a big hello to Seba, un saludo muy especial a Seba, who has been building this magnificent tool for the Option Sigma community and the Sigma Option community. So basically, we start tracking iron butterflies opening at 9:30. This is Eastern time. So when the market opens, we open one. Now the other one at 9:40, the other one at 10:30, the other one at 11 a.m., and the last one at 11:30 p.m. And we came up with the best pairs. What mean the best pairs? So if you are able to take, let's put this in actual dollars. If you're able to take $300 in profit, your stop loss shouldn't be more than 170. That's the best pair you can get to get. Sorry, this is for every day. Let's put it in 9:30. Okay. Every day, this is every day. Okay, so you can filter with news or non-news. So this is the best pair you can have for, just put one contract. Okay, there you go. So your take profit should be $240 and the stop loss is $150. So basically what we do is open an at the money item butterfly with 30 points wide of the wings. You're gonna buy the wings 30 points from yourself. And the best pair is to take home $1,500 is going to be taking $240 every day home, but the day is not going to, the day that the strategy is not working, you're going to stop at 150. So that gives us an expected movement of 0.15. And this is a pretty cool tool that I would like everyone to use, because we have tracked now the 940, and we can give you now the best pair. Let's give it a couple seconds. Okay, so basically, even let's see this one. This is a very good case, because some people think that we need to win more than we lose. This is not essentially true. We can have more negative days and less positive days, and even though the strategy long term is going to work, so we need to flip the coins so many times with the system, with the mechanic that really works. So basically what we give you guys here is the best pairs that you can play this strategy. And it's basically opening an item butterfly, which is selling two at the money, one at the money put, one at the money call, and buy some wings. In this case, is $40, 40 points wide. So for the 1031, you see that we have a better ratio, and the profit and loss is better as well. Well, this is 3 contracts. This is only one contract. So far, we have found that the 941 and the 1031 are performing really well, even better than the 930, because I do this mostly every day. And also, well, we have the other ones, which is the 11 a.m. and also the 11:30, that they're performing really well. But we need to see what we need to do. Basically, this is the worst performing one. But we need to do basically is keep track of the plan and do this every single day of our life. It's simply, if the strategy worked today, hey, I'm going home with $260. If it doesn't work, hey, I'm taking a stop loss at $50. So this is available, and we have here some strategies. So basically, we have a heat map here. Let me show you. We have a heat map here. So basically, it tells you what will be the best pair to play these strategies. Like I said, we've been tracking iron butterflies, and now we start tracking iron condors. We've been tracking only SPX, but from a couple of weeks. For the last couple of weeks, we've been tracking the NDX as well. The problem with the NDX is the liquidity. That's why we like better the SPX for sure, but definitely something that we need to pay attention to. So this is a strategy that it doesn't require any knowledge of technical indicators. Esta es una estrategia que no requiere indicadores técnicos, no requiere realmente saber entradas de puntos de soporte y resistencia. The only thing that you need for this strategy is just how to play. You need at least level 3 at your brokerage account. You need like what are the options for? So what is the role of the sell call? What is the role of the buy call? What is the role of the sell put? What is the role of the buy put? Just when you get to that understanding, you're gonna fall only in probability. So basically, if you toss a coin several times, well, what is the probability? 50-50, right? But you can throw a coin like 5 times, and you can have heads 5 times in a row. So the long term, the more I toss a coin, the more predictable the model is going to be. So that's why we're tracking it. We're going now. Right now, it's available only at the Sigma Option website. However, so we created this platform. We are connected with Tradier. So we're so happy because we are almost reaching within our first year of launching this platform, 3,000 users, which is a very decent, honest work. So almost 3,000 users are using the platform right now. So I'm basically the platform. We have pre-built the strategy. So if I need to do an iron butterfly, we have a pre-built strategy. So that makes it easier for our community just to place an order. So let's see, I'm going to put here SPX, and I'm going to put here an iron butterfly. Let's see, an iron butterfly. And you see, I can select day, but usually we do this 0 days to expiration. By the way, the data I just showed you is 0 DTE. So basically, we try to build this platform to trade very easy. And here in the analytics tab, you're going to have access soon to this tab, to this panel, to this dashboard I just showed you. So one more reason to trade with Tradier and trade with Sigma Trade. By the way, Lex, do you know who won the contest of Kahoot? You like Kahoot, right? This morning? Guess who he is? Guess who he is? So for this strategy, you just need discipline. But I would like to bring to your attention, guys, that everything is possible. You just need discipline. For the mechanic of this strategy, you just need discipline. Just need a system, just need to be disciplined, and this is going to work long term. Now, talking about the contest. So this Luis is actually me. This is Luis Silva. And I said, I'm going to do something with the $1,000. It's not for me. I just want to create awareness of this project that we've been carrying is this one. I'm just going to plug the microphone a little bit. Just give me a second. I'm going to show you right away.
Significativo aporte, el cual recibimos con mucho cariño su enorme compromiso con la niñez piñonera.
Ayúdanos a fortalecer nuestra educación.
Agradecido por todos estos detalles, tener en cuenta esta comunidad.
Este detalle nos ayuda a seguir estudiando.
Que ama esa tierra.
La alcaldía distrital de Monpós se dirigió a los corregimientos de Los Piñones para hacer entrega de unos kits escolares. Gracias a la gestión de la empresa Opción Sigma Sigma por el gran apoyo y aporte que se tiene con la educación, al alcalde San Nicolás y a la gestora social Melissa Ricardo por el gran apoyo que hoy se dio en este territorio. La educación es la clave del éxito.
So, $1,000 are going to this project that I believe education and discipline will make you succeed. So we are putting our little grain, we are putting our 5 cents, and the $1,000 are going to this project so we can give more people under, unfortunately, poverty conditions an opportunity to learn, an opportunity to have education. Yes, from Option Sigma, that's some of the things we're working on. Not only trying to sell projects or sell courses or sell platforms, we're trying to do something in actually for this society and to give back something, because the education has been a great asset in my life. So I believe that people can get educated as well and could have an opportunity as well. Well, that's everything. I don't know if we have a space for some questions. Lexito and Molicita. Where are you guys? Let me do something. Do you think you're the only one who can do something? Let me do something real quick. Look at me, Lex. What do you think now? So we're ready for some questions?
Look at you. Hey, what is that?
Sigma Summit. Look at you.
Did I take care of you or what? Huh?
Look at this one.
I like that.
Yeah. Do you know who gave this to me?
Maybe me.
Yes, that was you. My good friend Luisito.
Great presentation, Luis. We love it. You have such an energy and a zest for life. I love it. Your personality is so infectious.
That's good, huh?
That's a good thing. That's right.
That's a good thing, right?
I love it. So let's have some questions. What do you think? We have a few minutes here for some questions. One thing that you mentioned along the way, and I might have caught this in Spanish and not in English, so I might be messing it up.
Okay.
Did you say that you're trying to get $300 of profit on, I'm guessing per certain lot, and then $170 is your loss target, or not target, but that's what we're gonna.
It doesn't matter. I mean, whatever you're trying to profit on, it doesn't matter. It doesn't matter whether it's $100, $150, $200, but you need to have a system. So if you're willing to take $300, this is the maximum stop loss you need to take in order to profit from this strategy from the long run. But also, so taking a smaller stop loss doesn't mean that the strategy is going to work, because sometimes the stop loss is reached very easily. So we need to give it more space. But we can see, so we try to pair the best match, the best take profit and the best stop loss. Sometimes we have to take, let's say, $150 take profit and $200 stop loss. Probably that's the best match. But in other circumstances, so probably the best match is taking a little bit more of profit and take a lower stop loss.
Okay.
But that's going to depend also on volatility as well. That's going to depend on the times. But for sure, this is something that we've been doing in 2024, and is working really, really well in this environment of low volatility.
Okay, great. Mal, do you have a question? I'm gonna let you talk this time. You're on mute, Mal.
Am I still on mute? Can you hear me?
No, you're good.
Okay. So this is really nice to have you on here. So there's obviously, I'm going to ask a very reductive question, but across demographics, there's different trading styles. So how do you feel that this community trades differently than any other cultures? And is there a difference, or is everybody the same?
Well, I will say it's a little bit different. I told Kirk when we had the opportunity to talk in the summit, in the past Sigma summit, but one of my teachers back in the days was Kirk, and also was Tom Sosnoff, and also Tony Batista. So that type of trader. That was my school back in the days. So basically, I tried to sell on probability all the time. I use some technical indicators, but the one I use probably the most is simple moving average. It's just to understand where I am positioned for, let's say, for iron condors or for some directional strategies. But other than the simple moving average, I don't use any other technical indicator. None. That's it. So I rely on probability. That's one of the message I give to my community. So you have to have a system. You have to have a system that is impossible to crack, because mathematically it's going to work in the long term. So what I need from you, so I give you the data, and the data is available everywhere. But I provide you the data. What I only need from you is discipline. That's it. Discipline. The only need to do is open this position, sell it at this take profit, close it at this take profit, close it at this stop loss, period. And do that every single day of your life. This is going to work, because based on the statistics, this is going to work. So basically, I don't know if you're familiar with the martingale.
Mm-hmm.
Well, when you go to a casino, and if you have black and red, so you basically, what these people do is double the position until it makes a profit. So we don't need to go into a casino mode. We just need to learn from probability. That's it. And the casinos are the best examples out there. Maybe why we don't put that in. I don't know if I am frozen. Do you hear me?
Yes.
No, you did the thumbs
good.
up. When
Okay.
you do this on an Apple machine, it
Yes,
does
but
crazy
it wasn't my Apple machine. It wasn't my camera, my Sony camera. Yeah, so we don't need to basically enter in the casino mode, I was saying, but we can learn from what the casinos taught us, from the owner of the casino, not from the player point of view.
Right.
Right.
For the market makers.
So
Exactly.
do you ever, so you mentioned you trade a lot of these zero DTEs, and whether they're iron butterflies or iron condors, depending on implied volatility, where those levels are. Do you ever let those go all the way to term, meaning expire?
No.
Explain that again, because that's an important point that I try to make.
This
and I
is
want you to hit that one more time.
That's not going to work. Can you show my screen?
You know what? I don't know if we can. Maybe they can. Oh, there we go. There you go.
Someone asked me yesterday about it. What if you let them expire? And I told him, no, this is not going to work long term. And this is easy to understand. Let's put it 931. And this, if I'm going to get a credit around $700 average every day, so let's say I'm going to try to take, I don't know, to take them to expiration and get at least, I don't know, $1,500. So that means if I'm taking an iron butterfly $30 wide, that means that I'm putting at risk around what? $1,300, right? A little bit than $1,300 average. So let's say that in my stop loss is going to be $1,300. Well, actually, to be, let's say, $1,298. Okay. Just one. Look, this is going to work. This is not going to work. So you're going to have only, so during this year, let's say in 2024, you're going to have 44 negative days. And you're going to have just one positive day if you let it expire. Okay. If we can reduce it a little bit more, right? But definitely this is not going to work. So, and you should actually, if you go and see the graphics, let's say trading view, and see the graphics of SPX. In the daily one. Okay. So what you see, candles, right? What means that you have a candle? It's movement, right? So basically, if you have a day like probably like this one, is going to work, right? But most of the time we get candles. Candles meet movement. Candles meet lives. Right? So this is not going to work because, so you can let it like depreciate for a couple hours, for 3 or 4 hours, and the strategy is going to work. But if you let it expire, I'm talking about the iron butterflies, zero DTE. I'm not talking about iron condors, but because the iron condors, okay, they are different.
Mm-hmm.
But for the iron butterfly, definitely not.
So is there then a percent max profit you go for? Let's say you can make $1 max. You sell something, that's the most you can make. When it gets to 50%, are you taking that off, or is it something? Is it time of day that matters? Or you might not even be profitable at the time of day. You just say that's the time of day. I'm done.
Usually, I trade from 9:30 a.m. till 10:30 a.m. Eastern time. So
okay,
that's
so
it.
right at the opening till about 10:30 is when you keep these on.
Okay, so we open for 10:30. Usually, it's gonna take about an hour to reach either the profit or the stop loss.
Okay. About an hour.
You can see it here. Actually, we've been tracking it in the tool. So, for instance, if we take, let's do the 10. You ask for the 1031, right? Let me.
Yep.
Okay. So 1 hour and 18 minutes average to reach $260 or stop loss of $330. Is average 1 hour and 18 minutes.
Okay.
Okay.
Mm-hmm. So, and the Option Sigma software tells you these things. There's analytics behind it that you're pumping in data here, and it just spits out,
right.
Good timing.
So, what are we gonna do, Lex? So all the Tradier community can benefit from is this is only available for people in the Sigma Club. We call it the Sigma Club, but we're going to put it here at the platform. So basically, if you have a Tradier account and you trade under Sigma, you're going to see it here also in analytics. So, and it's going to be available. As you can see, you can trade in English as well. We have both. Languages, but for now this platform is available in English as well, but we haven't fully integrated here yet. So but this is going to be an easy move.
Okay, awesome. I'm going to show a question here, Luis. Can you read that and answer that one? EOD is end of day, by the way, if that you don't know that.
And maybe just read it in case anyone's just listening.
Yeah, I'm going to read it in Spanish.
Okay.
Este aproximamiento serviría para abrirlo en el día anterior a la expiración y cerrarlo la mañana siguiente. I've doing it, but I haven't tracked it.
Okay.
So I don't know. Sometimes it works, but you have to deal with the overnight gaps, and I don't like it. So unless okay, I have enough more data. So basically, 80% of the time, the SPX moves between minus 0.6%, 60%, minus 0.60%, up to 0.60%, 80% of the time. So essentially, it will work. So that's the base we construct last year to play with iron condors when the volatility was higher. So it worked for iron condors. Well, we open it at the end of the day, and we close it next morning. So we did basically one DTE at that time. I haven't done it with iron butterflies. I mean, I've done it, but I don't have a record to show.
Okay, that makes sense. Okay, good. The other thing, you used to trade, if I remember correctly, I thought you used to trade farther dated strategies, 30, 60 days. And so have you changed your outlook there a little bit?
Yes,
or still doing both?
The last during 2022 and 2023, it worked really well because the volatility was higher. So the volatility was decreasing, so it worked really well. But with these volatility levels, definitely it's not going to work. It's going to be a risk because it can be a movement. As you can see during the past months, I'm expecting a drop in the market for like quite a few weeks now. It hasn't happened yet, so it's gonna blow your calls at any moment. So
okay,
I don't feel comfortable playing those strategies with the bigs under 20.
Okay, cool. Here, try this one. This one's in Spanish. So can you repeat it? Can you read it, Luis, and then tell it to us?
Neutral strategies and directionals like the inverse condors and butterfly. Which one would you choose for the days? I will say, I don't know if this person is talking about 0DTE.
Okay.
But which one I feel more comfortable with, like inverse item condors and butterflies, both either directionals or neutrals. I will say I will live day by day. Yeah. I don't know. It's really hard to forecast anything at this time. If you, I don't know. I'm expecting a drop in the market, like I said a moment ago, and it hasn't happened yet. So any forecast you make is probably gonna stab in your back pretty soon.
Okay, I gotcha. All right, Molly, you have one final question for Luis. We have to probably get rolling here.
¿Cuál es tu consejo para mantener disciplina?
Do exercise. So go every day and just at least go and have a walk.
Yes, right.
Or jog. I will say the best way to build discipline is exercise, and you will get, if you're able to wake up every morning and do exercise, man, that's discipline. That's the hardest part.
Saying that.
Go to McDonald's. It's easy to go to buy food, and it's easy to go. It's really hard to wake up early and do exercise. I think the best way to build discipline is to exercise.
Yeah, I do Tracy Anderson, and the whole family knows. Like, don't bug me when I'm in the gym.
Yeah,
I couldn't agree more. Get the hard part out of the way first. Get the exercise done.
Now you can focus. Yes,
that's right. All right, Luis, that was wonderful as always. I wore this just for you.
I wore this just for you. I need to wear one for you, Molly, next time.
Oh no, you'll have to wear something like this. You'll have to.
There you go.
I'm gonna be bad.
All right, Luis, thank you so much for that. That was awesome. Your community was always enthusiastic. You're the best.
Luis.
We'll see you soon, buddy.
Con mucho gusto.
All right,
los quiero, los amo. Chao, chao.
Ciao, ciao.
Ciao.
You know, the inspiration behind the hub, I think, it came from the great traders of our time. Now, there's the great traders of my time on the floor are totally different from the great traders of this time. Again, coming from the floor to coming off floor is a completely different environment, and the skill set is very different. So we're bringing together the great traders of the off-floor retail world who know how to teach this community and can give kernels of wisdom to the community, because it's very difficult, first of all. I mean, it really, really is tough. So the inspiration is really about those people who may have adapted from a floor life to the current off-floor life and can teach it. And we have some great, great talent who are going to be able to talk about their transition and talk about their trading abilities from an off-floor retail perspective. I didn't know I did that commercial either, Mal.
I know.
Go figure.
How would you do it all, Lex?
I don't know. I think it's a talking doll. It's not me. All right. Moving along here. Next up. Are you ready?
I'm so ready.
Stephen Kalesian's next. He has
spent some time with this guy. Yeah.
Yeah. He's been in the market longer than I have, which is a really long time. I think he's saying about 40 years now, man. That's pretty good. So he's been around for a long time. He trades everything: stocks, futures, options, currencies, dirty socks, crypto, you name it. He trades it all. And he is very, very good at what he does. He's got a chart reading thing that he does himself. I don't understand it, but he's so good at this. We're going to let him come on and go through it. He's with Trade Easy. Great technician, great trader, great guy. So let's get to him right away. And Steve, when you come on, we're going to talk to you right afterwards at about 40 minutes or so. So we're going to let you get rolling right away. So let's have at it.
Hey, everybody. Welcome. And thanks for this great opportunity. Thanks, Lex and Molly and Dan Raju. Great firm, Tradier. I'm really excited about the announcement that Tradier has made about getting into futures. And that's why I'm here for this next 40, 45 minutes. You know, there are so many different asset classes. And there are so many people who want to learn about futures. Matter of fact, it was just right before I came on here, someone just texted me and said, can you please teach me how to trade futures? I'm seeing an enormous growth potential in the from people all around the world that want to learn how to trade futures. And again, I'm really super excited. Hopefully the beginning of June, Tradier Futures will be alive. And, they're a great firm, and it's just going to be a great asset to be able to have in their firm for people to trade all around the world. And, trading futures is, people you say, oh, trading futures, you get scared, because, I don't know anything really about it. Well, the same thing, if you trade stocks, or if you trade options, or if you trade crypto, or you trade currencies, it doesn't make a difference. And the most important thing is to understand you need to be comfortable in the asset that you're looking to trade. And trading futures is really, for me, because of where the markets have come from November, 4,100 on the S&P up to 5,300 and change, you now say to yourself, right, that, well, you get 4 to 1 intraday if you're going to trade stocks, and then margin on trading futures. Some firms have margin on what is called a micro, which is $500, and if you're trading a big one S&P contract, it's $1,000. So you really get more for the margin purposes as far as trading is concerned. And the CME many years ago, I actually had dinner with the head of the CME one night, and he was shifting from taking all the people on the CME platform to actually going into who are paper trading, and then came up with what is called a micro. And it really has revolutionized so many people gaining the confidence, instead of going from paper trading into the big S&P futures, but they're going from paper trading into micros. So one of the things that I stress on is technical analysis. I'm not a fundamentalist in any way, shape, or form. And technical analysis, I've studied this, and I built software. It took me about 9.5 years to build it. When you're trading the futures markets during the U.S. session, it's really important. I have examples to show that you just can't look at the S&P futures on just looking at the chart. You need to look at the underlying ETF. I've taught this to top hedge fund managers in the world recently, just one of the biggest in the world. I taught this to, and you really have to take a step back and understand that if you're going to be sitting in front of a screen all day long, you really need to look at the S&P futures, which is called the continuous contract, or the NASDAQ futures, or the 30-year bonds, or gold, and use the underlying ETFs. For gold, it's the GLD. For the 30-year bonds, we use the TLTs. For the S&Ps, we use the spiders. And for the NASDAQ futures, we look at the Qs, right? So it's really important to really look at the overall asset and then combine the underlying ETF. I actually look at the reverse ETFs at times too. I'll look at the SQQQs with the Qs, with the NASDAQ futures, the S&P futures. I'll look at the spiders, and then I'll look at the SDSs. Now, in my approach, as you're going to see as I go to the slides, I use what is called multiple combination of time frames. I look at 5 time frames when looking at the index futures. I look at the 3-minute, the 5-minute, the 15-minute, the 30-minute, and the 60-minute time frame. What I do is, when I look at these multiple combinations in trading the futures markets or looking at any of the markets, it's important to understand that the multiple time frames will tell a story. So there are 5 conditions that I look at. You can have a trend, you can have a buy reversal, you can have a sell reversal, you can have a correlation, and you can have a disconnect. All this is significant meaning, because each of the conditions, there are 2 strategies per. So you have 5 conditions and 10 strategies. The hardest thing in the world as a trader is to identify buy and sell divergences. And that's what I teach each and every day. And mastering the futures markets, or any markets for that matter, is the first thing you have to do is set a goal for yourself. Every single day, I tell all my students, all the people that come to me, who I guide, I educate, I say, this is the game plan. You set a goal for yourself. When you hit that goal, you stop. And then you gradually keep increasing that goal. There's nothing greater at the end of the day than to walk away from knowing that you accomplished something and taking money out of the market. There's nothing worse than being up money and then giving it back at the end of the day and then being in the red at the end of the day. So let me start by looking at some of the slides here. Oh, okay. Let me just go to this one. Okay. All right. First of all, the first thing, you have to have a plan. And the first plan is you have to say to yourself, how much time do you have to trade during the day to really focus on this? Do you have time to be able to sit in front of your screens? Do you want to trade from your phone, listen and trade from your phone? Do you want to be able to have automated alerts sent to you? So everybody has to have their own plan. And the plan basically starts by waking up, understand a lot of people have full-time jobs. How much time do you really have to trade? Do you want to trade during the Tokyo session? Do you want to trade during the European session? And so that's a really big part of, really understanding the amount of time that you need to commit to learn, the amount of time that you need to really focus on trading. All right. How much time do you have to be mentored by someone like myself or any of the guests that were in the summit today? Basically, you really want to be able to fully understand the time allotment that you have. I don't like the word pretty much education, because it's like, for me, it's like too labor intensive. I always say I like to guide people, and I like, to be more or less guide them in a way that can help change their lives, right? So taking the time and the ability to understand how much time you have to really absorb what someone's teaching you. I always tell everyone this is a journey, not a sprint. And so that's a really big part of the plan here. Understanding margin requirements, getting a broker like Tradier, right? Understanding the margin requirements for a micro, and then going into a big contract, an S&P contract or a NASDAQ future or a gold future. Understanding the margin requirements if you want to eventually go from a micro to a full-size contract. Using technology and technical tools, right? That's what I do, right? I have technology, I have technicals, and that's what I teach each and every day. And everything I do is based upon visualization and repetition. And there are people who are new, and there's a complete learning guide to understanding the software, understanding my terminology, and understanding these strategies that I feel repeat themselves on a daily basis. As I stated, I use multiple time frames upon my approach, and that is very, very important. You just can't look at a particular time frame. My research has shown me that you need multiple time frames when you're looking at any market, whether it's futures, stocks, ETFs, currencies, crypto. It doesn't make a difference. As I stated, when you're looking at the futures markets, it's important. As I said, I've taught this to thousands and thousands of people and some of the top hedge fund managers. You really need to look at the underlying ETFs, because what I take the data coming in on an ETF, I look at the markets from 9:30 to 4, which is real time trading hours. I don't look at pre or post market data. And what I do then is then combine it with the continuous contract on the S&Ps or NASDAQ futures or bonds or gold or oil. And then those markets trade 23 and a half hours in a day. So when they correlate and when they line up, there is a really big move happening. So that's why the spiders trade 6.5 hours in a day and the S&Ps trade 23 and a half hours. I'm just using the S&Ps as an example. And so it's important to use the underlying ETFs when you're looking at when you're trading futures. It's really important that I tell people, when you're starting to trade, whether it's stocks or futures or whatever, it's important to really understand that there's no shame in paper trading and learning how to, use various different platforms, whether using a matrix, what I call a ladder, entering orders, learning how to be able to scale in and scale out of positions. But it's important to really focus, right, on how to paper trade and build your confidence up to a level that you're then ready to go to the next step. Whether you're going to trade, a micro from a paper trading, you go to a micro futures contract, and from a micro futures contract, you go right into the big contract. So that is really important. So I always tell people there are steps before you keep growing. As you're growing, just continue to put one step in front of the other. You need to set goals for yourself. I set goals when I first started trading. I set a goal for $100 a day, and then the next week $200, then $300, then $400. And believe it or not, there was some mornings I made $100 the first week, and I sat on my hands from 10 o'clock to 4 o'clock. That's discipline, right? That is really super important. I'll get to my 5 key words, but you really need to set goals for yourself. And as hard as it is, you have to really set goals. And that is really, really powerful. If you can maintain hitting your goal and stopping, as I have people in my live room on a daily basis, and they hit their goal, they're gone. Some of them hit their goal and they continue to watch and learn. But again, setting goals are really important. This is a big one, revenge trading. When you get to a point where you're comfortable and you're trading, you have to learn how to take a loss. And I've taken losses, losses that, pretty big losses, but I didn't revenge trade. And what I did was I just waited for better patterns to set up, and then I attacked it and I attacked it and I attacked it and I went. But I didn't revenge trade. Sometimes I would have to wait, sometimes 30, 40 minutes before I saw something, and then I would go into the market and then trade it, right? So what I've heard this story in the last month, I heard people like saying, well, I want you to help me, but I'm down $1,100, and then it keeps growing because I just jump right back in, and that's revenge trading, and that's why for me there's no place for that in trading. You're just going to end up really hurting yourself in revenge trade. Let's go to the next slide here. Okay, let's see what's going on here. Okay, can't move the slide. Okay, so I have 5 basic conditions in the market. As I said, you can establish a trend. A trend can be up and or down. You can have a buy reversal. You can have a sell reversal. You can have a correlation, which is the ETF correlating with the continuous contract, or the continuous contract on the futures markets correlating with the underlying ETF. And then vice versa. You can get a buy reversal on the continuous contract, and you can still be in a sell mode on the underlying ETF. And that is what's called a disconnect. And so these patterns tend to repeat themselves each and every day. And the most important thing is to identify it. And that's what we do each and every day. And so when you get these correlations or disconnects in these 5 conditions, each condition, as I stated, has 2 strategies, a buy and a sell divergence. So let's look at some buy divergences in the positive trend. This is my own software that I've built, right? I studied this, I built it. Took me about 9.5 years of my research. Again, you'll see how I'm looking at two time frames in this example. I'm looking at a 15-minute time frame. I'm looking at a 5-minute time frame. And what I'm looking at, every time I look at the market, I always go left to right, top to bottom. So I'll start with the 15-minute time frame. I'll go over to the left, and then I'll look at from top to bottom. I use 4 indicators to my left. I use indicator 1, indicator 2, indicator 3, indicator 4. Indicator 1 is a MACD, and if you hear me ever say during my live channel, you'll hear me say a MACD, which is the indicator is yellow over blue. You'll hear me say it's a positive MACD, and if you hear me say a MACD is blue over yellow, you'll hear me say it's a negative MACD. Indicator 2 I use as another gauge, which is big buying and selling pressure based upon each individual time frame. Each individual time frame will have different math. So when you're looking at something like this, in this example, you're seeing gigantic buying pressure on this particular time frame, which is very, very bullish, right? Indicator 3, I used only the cayenne color, which is an overbought, oversold oscillator I created. And that basically helps me identify when I'm looking for entries in this particular trend. Indicator 4 is my own predictive analytics. So it's helping me tell me which way the market is going. Because the most important thing is you want to be on the right side of the market. In this example here, the 15-minute time frame, okay, pulled in. After we gapped up, we kept on making new highs. And then when we got this pullback, about 2 hours after the opening, we got this really big pullback on the Qs, right? And you can see how not only was indicator 3 getting oversold into the positive MACD, it was getting oversold into the big buying pressure on indicator 2, and then it was getting oversold into a positive trend. And that pretty much told me we're going right back up. And that's exactly what happened here. When you look at indicators 1, 2, 3, 4, using the technical studies I have, basically indicators 1, 3, and 4, I'll use 85% of the time. And indicators 1, 2, 3, 4, I'll use 15% of the time. So in this example here, you really told you not to be short the market, but to look for pullbacks, especially with this monster gap up and the big buying pressure that we had on indicator 2 on the bigger time frame. Now, again, in this example, I'll be looking at the 5 and the 15, but again, the 30-minute and the 60-minute also come into play, and that's really important as well, because you really need to understand when you're looking at the market, my research has shown me you really need to be looking at the 4 or 5 big time frames. If you don't want to look at the 3-minute, you could look at the 5, 15, 30, and hourly, and that really should be sufficient enough as well. So this is what's called a sell divergence in a positive trend. So again, this is one of the conditions I look at. If you see here on the S&Ps here, you can see that when we made a new high here, that indicator 1, the MACD did not confirm. This is a non-confirmation. So when we got this big push up on the S&P futures, right, we never got the confirmation. The MACDs did not confirm like the prior example. You can see as we're making new highs, the MACDs were going right up with the price action. But when we made the new high here, the MACDs did not confirm. So this again is showing a non-confirmation in a positive trend. The positive trend being that indicator 4 was bullish on all the big time frames, as you can see. So once I got the excuse me, overbought condition on this particular time frame, on the 60-minute, you can see that it never confirmed, and then we got a significant drop. And then when it got oversold within the trend, we pushed up, then the MACD started to reverse positive, and there was really no shorting after that. Once the MACD started going positive and started inching up higher as the S&Ps were making new highs there. Again, non-confirmation, sell divergences, same type of approach, same mindset. And it's important to really see this, as I see this dynamically, to be able to take advantages of long and short opportunities. Here's a buy divergence in a negative trend. So again, left to right, top to bottom, we can see that the MACDs were crossing up from below the pivot, which is my solid white line right here. I call this pivot line basically as a way for me to understand which way the S&Ps, which way, I'm sorry, the MACDs are crossing. If the MACDs are crossing up from below my solid white line, my pivot line, then I know that there's something happening here. And then you can see indicator 4, which is I'm in a negative trend here. But the 5-minute time frame reversed to buy. So now I have a buy divergence on the 5-minute time frame in a negative trend, because going back, knowing this pattern, as I remembered, the 30-minute and the 60 minutes were still negative. But what happens is, I would say about 75-80% of the time, when you get a buy divergence like this in a negative trend, the odds are probably about 75% that you're going to start seeing a buy reversal on the 15-minute, then the 30, and then the hourly eventually. So in this example here, once the MACDs turns positive, there was really no selling pressure, right? There was only a little bit of a buying pressure on indicator 2. And then the 5-minute time frame reversed to buy. And then you can see how the price action just continued to move higher and higher and higher. So again, this is one of the conditions, a buy divergence in a negative trend. And when you're trading futures, it's important, or any asset, and to see how these patterns repeat themselves. As I said, everything I do during my day is all based upon visualization and repetition, and how these patterns just tend to constantly repeat themselves. Here's a sell divergence in a negative trend. So what am I looking at here? Well, again, looking from left to right, top to bottom, I can see that the MACDs are negative, right? Blue over yellow. I can see I have some good selling pressure here on the indicator 2. My overbought oversold oscillator was getting overbought into the negative MACD, and indicator 4, I'm in a negative trend. So now in this example, I'm using all 4. So I'm 100% in on all 4 of my indicators. And that there is showing me I'm not going to be long the market, right? And nor am I going to, teach or guide people to be long the market there. This is telling me that this opportunity is setting up for shorts. And that's exactly what happened. So when you see a push up to this magnitude, right? When that, first of all, indicator 4 on my work right here reversed to sell, the MACDs were negative. I had selling pressure, and indicator 3 got overbought into that negative MACD. Well, that's nothing but a disaster here. You really need to now take a step back and say, okay, shorts, we're going to look for shorts. And that's exactly what happened. So on the S&P futures on that particular time frame, which is the bigger time frame, the 15-minute, that is a monster sell divergence in a negative trend. And then you can see exactly what happened after that. You can just see nothing but, it took about 40 minutes or so, 45 minutes before it started to really push down. It pushed up here again to make a lower high, and it just got absolutely sold off here in a matter of about, I would say, let's say 10, 30, 1 hour, okay, 2 hours, about 2.5 hours, you can see the big drop here off the 15-minute time frame. Oh, back. Here's a sell divergence after a buy reversal, okay? So we had a buy reversal here on the 15-minute time frame, and you can see the algorithm is now positive, but the MACDs are negative on the 15-minute time frame. So when I got the push up on the 5-minute time frame, you can see that the 5-minute time frame pushed up into the negative MACDs on the 15-minute time frame. So that there was a sell divergence after we got a buy reversal. So it was really calling for shorts. So again, one of the conditions that I had, right? So on that pattern right here, what we're looking at, we can obviously see how the overall market is in a bullish trend, right? But we can still have a sell divergence in a bullish trend. And that right there is to be you're able to understand that when you get these divergences, they're very, very powerful. And the moves are very, very they're very, very big moves in either way. And whether it's a buy divergence or a sell divergence, you're going to see really big moves as you're seeing right here. All right, this is a, a sell divergence after a sell reversal pattern. And so what we're seeing here is we're now seeing that in gold, we're seeing that the MACDs are negative, right? Left to right, top to bottom. And what we're able to do here is you can see this solid white line. So in this MACD is now above my pivot line. It's now flipped and reversed to sell, right? Blue over yellow. And now indicator 4 reversed to sell on the 15-minute time frame. And what do I look for? Now I switch to the smaller time frame, the 5-minute time frame. I'll wait for a push up, and then I'll look for short entries on that particular time frame. And so now that the 15-minute time frame correlated with the 5-minute time frame, I'm in the mindset of, okay, I'm looking for shorts, right? And so now I'm going to use the smaller time frame, the 5-minute, wait for the push up, wait for an overbought condition in a sell reversal, and I'm looking for a push up into the negative MACDs on the 15-minute time frame, and then the push up will give you the ability now to look for short entries. And that's exactly what happened. Gold futures, just after that push up within the range, drop very sharply. And again, these are patterns that repeat themselves all day long. You know, people say to me, you know, indicators lag, and that's true. Price leads first, right? But the way I have things set up is when you have the price action, right, dictating the move, and now when you use combination of multiple time frames, when you use combination of multiple indicators at the same time, then everything is working in sync. Right. So people say to me, aren't indicators lagging? You're right. Indicators do lag. But the way I have it set up is the price will lead, and then you take the multiple time frames, you take the multiple indicators, and then you can actually then see the patterns develop right before your eyes. All right. All right. Buy divergence in a positive trend. Okay. I think we went over that already. Okay, so here's a buy divergence in a positive correlation. So a positive correlation, if you look at gold, this is a Picasso, all right? You can see that the MACD is below my pivot line, and you can see it's very powerful. I'm trying to get some big buying pressure, and my algorithm reversed to buy. You know, something like, well, you know, they're overbought. No. I can show you markets that get overbought, right? If you know how to use your overbought oversold oscillator properly, you can get hammered, right? You can get really it. So in this example, even though gold was overbought on the 15-minute time frame, the big buying pressure really was able to alleviate the overbought condition to a degree. So now, after the 15-minute time frame correlated with the 5-minute time frame, you can see that the MACDs are crossing up here, and you can actually buy, you know, using the indicator 4, because I have the math where it's going to get the buy reversal. A lot of times they'll buy it when it touches that number or goes through that number, and then because the MACDs are positive here, we're going to look for a pullback on the 5-minute time frame for entries. And that's exactly what happened. That pullback was a beautiful pullback on the 5-minute time frame. right here, okay? And we can see the push up that we got afterwards. So we waited patiently right after the 5-minute time frame went positive, as we saw right here. The MACDs were very strong, very powerful. You had some really good buying pressure. Here was a nice little pullback right here, above the moving average, the weighted moving average. And then once the 15-minute time frame reversed the buy, and then it just up off to the races. And then gold proceeded to make new highs. It pulled in beautifully on the pullback. Again, we use smaller time frames for entries and exits, and that's exactly right there. So you have a buy divergence, which was the oversold condition into the positive MACDs on the 5 and the 15, and then the push right back up. Okay. All right. This is a buy divergence in the positive correlation, right? So looking at the 15-minute time frame is way, way, way below, as I showed you before. Again, this time there is a little selling pressure on this on the 15-minute time frame. The 15-minute time frame reversed to buy, and then looking at the small, beautiful, beautiful MACD on the 15-minute time frame, and then we use the smaller time frames on the 5-minute for entries and exits. Now, normally when you look at these patterns, if you're looking at a 5-minute time frame, my research has shown me that the trades will last anywhere from 1 to 8 bars. So if you're looking at a 5-minute, anywhere from 1 minute to 40 minutes. If you're looking at a 3-minute time frame, when you get a big buy reversal like that, the trades should normally last anywhere from 1 minute to 24 minutes. So it's, again, 8 bars. Normally, my research has shown me that on any asset, you're going to get 4 to 6 great trades per day. That's what my research has shown me. Now, sometimes in high volatility days like today, the FOMC, there was probably about just between the time the minutes were released today at 2 p.m. I'm counting on the S&Ps 1, 2, 3, 4, 5, 6 patterns already. That's because a news event was the driving force behind it, and then we're able now to see that it's a high volatility session from 2 to 4 after the FOMC minutes, and sometimes there's some aberration, but the norm is 4 to 6 great trades per day on any asset. This is a buy divergence here in a positive correlation. So again, left to right, top to bottom. This is exactly the chart before. From looking at the gold futures, this is the underlying ETF that now you can see exactly the same oversold conditions using the smaller time frames where we're able to look for entries. So when I look at gold, I have the gold futures, I have the GLDs right underneath it, and I can see when they correlate. And when they correlate, you better be going in that direction. All right, so this is a tricky one. This is a sell divergence in a positive correlation. So again, I'm looking at the bigger time frame, the 15-minute. You can see it's in the buy mode here. But every time we made new highs here, the MACDs did not confirm. So you can see the high here, the overbought conditions on both the 15-minute time frame, on the 60-minute time frame, but the MACDs did not confirm. When you're making new highs like this MACD, this MACD on the 60-minute should make a higher high and confirm. And this is, again, a non-confirmation. This is a non-confirmation. This is a sell divergence in a positive correlation. So this is how, when you see these, and again, they happen daily, and when you see a new high on the futures contract, right, and you're seeing this, but the MACDs are not confirming, and you get significant overbought readings, I say you short them. That's what I would do, right? All right. Sell divergence in the positive correlation. Again, you can see here on the Qs, you can see how we're making new highs here on both on the 60-minute time frame. the overbought reading, but the MACDs did not confirm. Very, very powerful. Again, a sell divergence, non-confirmation, very, very powerful. Okay, this is a buy divergence in a negative trend. So when we got the price action making a new low, the MACDs did not confirm the low. Now, this happens a lot of times. I see these patterns a lot of times on the opening. Like today, for example, we had a big push up on Microsoft right after the opening, and the MACDs on the 15-minute time frame were nowhere near confirming that. And Microsoft dropped about $2.50, I think, $3 towards the end. Okay. If anybody has any questions? I think that's about the time we have left here. And again, you know, these patterns repeat themselves, and learning the futures markets are a great way for people who are interested in, you know, taking another asset and understanding that there's ways to trade the market, especially, you know, if with the rule of having the $25,000 to trade stocks. And so many people are really, as I told Lex a couple of days ago, I just see the futures market is just going to be booming, and I'm so happy that Tradier Futures is going to be launching sometime in early June, and I'm happy to be part of it.
Cool. Thank you, Steve. That was awesome. I appreciate that.
A little technical, a little bit over the top, but
that's okay. That's okay. We like that kind of stuff. Look at this question for you.
After this.
Yeah. Let me put a question on the screen for you. Can you see your screen and read that?
How and when the futures can be better than options? I'm sorry, I'm completely ignorant about futures. So this is a question I get all the time. My first trade I ever did was an options trade. So I love options, but I'm more in love with trading futures. I think this to me is the great one of the greatest assets. You know, when I traded futures, this was something I really loved. With trading options, you have so many different. You can do butterfly spreads, calendar spreads. You can do synthetics, you can do buy rights. There's just so many things. You just buy a call or buy a put. But the thing is that people don't realize that when they're doing this, the premiums evaporate. We got a long weekend coming up, Memorial Day, and if you're long like a call on Meta or something like that, you're just going to see the premiums just eat away come that Tuesday morning. With the futures markets, there's none of that, right? And I think that what people have to realize is that. Sorry about that. That's my. I hear these bells in my head every night.
That's Molly's blender for a protein shake.
Yeah. I think what's really important is that understanding that the asset class that you're trading on options is going to be a lot different than trading futures, but the patterns remain the same. Meaning, if you're going to trade a stock like a Meta and you want to buy an option based upon the pattern, you buy at the money call. I think a lot of times what options traders, what they do is they get they see a very inexpensive option and they'll say, I'll buy out of the money call, and the stock just stays sideways or it drifts down lower, and the premium just goes right down.
Right.
And I think that's what for me, trading futures and guiding people to the futures contracts and trading. I think that there's none of that. There's no evaporation of premiums, and I think that's a lot of, and also margins are a lot lower when people are trading. So I think that's and Tradier's got great margins, from what I understand from Dan, for their new customers, whether they're micros or e-minis. So I think it's very, very advantageous for anyone to be looking at the futures markets, especially if they want to learn.
Okay. Great. Thanks, Steve. Where can folks find you? What's the website?
www.tradeeasy.com.
So it's Trade Easy. It's easy at the end. Easy.com.
Mm-hmm.
Awesome. Thanks so much, buddy, for coming on.
Thank you so much.
Thanks, guys. Good luck, everybody. Good luck.
Thank you.
Good job. Thank you, everybody. Thanks for hosting this.
You bet. Join the Tradier Futures waitlist. Access the gold, oil, index, currency, and crypto markets with Tradier Futures. Make sure to join the waitlist now so you know when we launch this powerful product enhancement. Okay, Mal.
Hey,
we're getting there.
Is it 5 o'clock somewhere so we can talk about wine futures yet?
Oh
When is that time?
Next
Futures are
Yeah,
yeah,
sorry.
futures are really great. They have, low margins, great tax deals. They have the 60-40 tax treatment. So there's some bennies there.
There's some bennies. I agree. All right. I want to get to the next group here quickly. Mr. Jim Iorio and Bobby Iancino.
The crew.
Yeah, the crew, the Futures Edge folks, they're ready to rock and roll. And they've got two great guests coming on, Cameron Dawson and Jim Bianco, rock stars all the way around. Jim and Bobby, the host of Futures Edge, part of the Chicago Trader gang, man. We're all part of that same little club
the
here in
outfit.
Chicago. So wait till you see them. Let's get right to it. I want to let them get going, okay?
All right. And I'm not worthy. You guys. Continue.
How about it?
There's a new. Did you see the new graphic? I'm even further ahead of you now.
Yeah, and you're
It moved me higher. You've been demoted, Robert.
This is literally going to. It's a formal protest now.
Yes,
formal protest.
Welcome to the special edition of the Tradiers, the Trader's Edge. I'm Jim Uriel. That's Bob Icino. We have some great guests coming on, but one quick question before we go. Today, copper gets hammered, gold gets hammered. Platinum hung in a little better than I thought. Is this big deal, little deal, just position squaring? The fundamental story's not changed.
When you looked at the initial volume, it wasn't as strong as you would think for such a large move, specifically in copper. So from that perspective, I'm going to look at it as more people protecting profits, speculators getting out. The China threatening the EU with tariffs, I thought was sort of a deceleration of the economy story, and that might have spooked some people. If we never got China mentioned, it spooks copper. But outside of that, I don't think the UK inflation numbers are enough to derail copper. So I think the trend obviously is still intact in a very big way.
You thinking about buying any more?
I am, as a matter of fact. I mean, I don't do it on the first day. The typical way that I do things is something collapses, I look for a rotation back up and see that sort of support got confirmed. I think it is going to get confirmed. By the way, the weekly, we're really far away from any support in the weekly. So it can go a lot lower and still that trend will be intact.
Good. Now, you guys, I say this every week. I'm going to say it again. You guys may think Bobby and I are full shit, blowhards, whatever you want to think, it's fine. But you cannot deny that we get the best guests. And today it's almost funny. This is going to be such an easy show to do. We're going to ask like 2 questions and let 2 of the Titans slug it out if that's what they want to do. We have 2 guests. We have Cameron Dawson, Chief Investment Officer of New Edge Wealth, who 2 years ago when I first met her and she was coming on her show, since it's an androgynous name, I thought it was a dude named Dawson Cameron, actually. And to my surprise, it was not. And we also have Jim Bianco, who is the president of Bianco Research. Bobby, what were you going to say?
Well, I thought it was a woman named Bianca James.
That's not true. Right. You are lying. But here they come.
Hey, guys.
Hey, how are you?
What's up, guys?
So,
I got a bone to pick with you. You're having this on the open because we're going to get NVIDIA's earnings
right now. Do you have a speed up?
Yeah, and like I said, NVIDIA's earnings are otherwise known as the open here. Everything until now has been, kind of pre-open trading until this moment.
I have both my things here showing me, waiting for it because it could. I mean,
so Bobby, we're going to have a 50 handle move here in about 30 seconds. Which way is it going to go?
It's going to turn around. I think the Nasdaq's going to turn positive on the future side of things. I don't, NVIDIA being so freaking important and so freaking large. I mean, I get it. But I think the fundamentals, man, I think we're still in a reflationary environment. And I have a question, but I'm just going to shut up because you 2 are here.
Well, no. Okay. Because as long as we're talking about this, let's start with Cameron. I like to talk about the big AI thing. So I just read Larry McDonald's new book, which I thought was mind blowing. And he talks about, the next 20 years possibly being this inflationary period where, we could be running 3 to 3.5% inflation, and that growth will not be the place to be in. Hard assets, the things that Dennis Cartman used to say hurt when you drop them on your foot. And I am long all those things, but I am still long some of the AI stuff as well. Cameron, where do you fall out? Is the AI thing overblown at the moment, price-wise?
we're still pretty early on in this, and we could be overblown in the short run price wise, but still be underblown in the long run in how the trend will actually play out. But I think it may not be one or the other. I think the bigger question is, are we going into a commodity super cycle that looks like the early 2000s? Because if you're going to make a own value kind of argument and don't own growth, then that's effectively the call that you're having to make. And, I think that Barry Bannister has done great work on those big commodity super cycles of where commodities trade relative to equities. And are you near a low in that? The challenge with that is that you could be a year, 2, 3 years early and still there be a big cycle, but still be early to these major turns and trends. So a lot of it depends on your call for a dollar. Remember, the dollar fell by 35%, I think, over the course of the early days of the 2000s. You had huge exodus out of capital flows from the US that led to this value trade, non-US trade, deflating of the growth trade. So at this point, you could have both. I wouldn't be so far to say that you should throw out all your growth stocks and jump into value. But I do think that there's still a good argument to make for having commodities, having exposure to more value-oriented parts of the
James, do you think we are at James? It was very formal. You deserve that sort of formality.
His name is Bianca. Okay.
Bianca, what do you think? Are we at the beginning of a commodity super cycle?
I think we are. I think that really what happened was the old cycle, the disinflationary deflation cycle ended in 2020. And so Larry McDonald's book, I'm right with it, that we are turning higher into more of an inflationary cycle. And I completely agree with him. When I say, you got to be careful. People think inflation's a loaded word, right? When you say, I think we're going to have inflation, they think Zimbabwe. And I'm thinking, no, like 3.5% inflation. And that's a problem. You don't need Zimbabwe to have it become a problem. And so, yeah, I do think we are in that up cycle. Now, within that, what's also happening with commodities too is I used to work with a guy named Howard Simons for many, many years. And he had a great line where he used to say, copper, cocoa, coffee, crude oil, and corn all start with the letter C, but they don't all belong in the same index because they're all completely different from each other. And so when you talk about a commodity super cycle, yeah, the general trend of all the commodities are going to be up. But don't confuse copper, corn, and crude oil. They're all very, very different. That one or two of them could be in a different cycle, like a bear market, while the general trend of commodities is higher. So, yeah, I do think we are in that kind of cycle. And probably the headline when it comes to the inflationary super cycle probably is gold. And with its move higher over the last several months, that kind of underscores that idea.
So, Jim, can you have a commodity super cycle without goods inflation? I mean, I think we've had them in the past, but given the current environment, can that happen?
I think it's hard. I think because commodities are about goods inflation in this point, So if you're talking about, I heard Jimmy talk about, our friend Gartman talking about dropping stuff on your toe. Goods are things you could drop on your toe too. And so if you're going to have copper and you're going to have crude oil, and you're going to have some of these other things moving higher, some of the industrial metals, it's going to feed into, ultimately goods inflation as well, because the inputs for goods is these raw materials. And it's just going to make the base for that to make those things even more expensive.
One thing on that point is that in the 2000s, you had this massive commodity super cycle. You had the BCOM up almost 100%, actually about 100% over the time from 2000 to 2007. What's interesting is that, yes, non-durable goods saw inflation. They were up in that period about 24%. But durable goods actually still saw deflation because of globalization and because of technology. But durable goods are a much smaller portion of the overall CPI bucket than non-durable goods. So it's a question of, if you have a commodity super cycle, but you also don't have a globalization super cycle at the same time, which is what we had in the 2000s, do you still see that kind of durable goods deflation that you had? Or is technology enough to bail it out and say that you could still see that kind of big, huge downtrend in durable goods? I think it's a big question that remains to be seen, that would be different this time than the 2000s cycle.
Well, so then the question that we need to ask, and let both of you take a crack at it. You first, Cameron. No, so I always argue that Paul Volcker deserves some credit. Reagan deserves some credit for breaking down the walls for globalization, but the internet deserves a hell of a lot of credit for breaking part of that inflation cycle that was going on. Right around the time we started to get out of the inflationary cycle, the internet came, did its deflationary thing. Is AI powerful enough over the next 3 years, let's say, to be the deflationary technology? Dramatic pause. I love a good dramatic pause, by the way. I like it a lot. I come with a big punch.
I think the last time you made me dramatic pause, we put the meme up of the dramatic.
Yes, it was a great meme.
I mean, I think this time it would show up more in goods. I'm sorry, in services would be my initial reaction. Is that is there disinflation or a cap on inflation in services because of AI? I would point out that in durable goods and in non-durable goods, AI could potentially make manufacturing processes more efficient. But my counterpoint to that is that this process has been going on for a really long time, and it's more incremental step changes. I used to cover the industrial names, and back in 2014, it was big data. And everybody talked about how big data would allow you to do predictive maintenance. And that's happening now with technology. It's finally coming to life where you're able to predict downtime for machines, so you can run machines more efficiently, which again feeds into your manufacturing process, maybe makes you a bit more efficient, but doesn't necessarily suggest like direct disinflation. So I guess you would look to the services side, but Jim, do you think that actually makes, so do you think AI is going to feed its way into services disinflation anytime soon?
No, I completely agree. I think that the internet and the availability of information really pushed itself into goods and helping to make the efficiency of goods, finding goods, trading goods, getting goods, moving around the world in a more efficient way. That was the internet. That's a 30-year-old technology right now. That's your father's technology. AI, I completely agree, is going to be more about services, and it's going to be more about making services, I want to say more efficient. And the implication about services is that they're going to become, that those prices are going to fall. But let's also remember there's, Northwestern University, there's a professor, Bob Gordon, in the economics department, and he's written a number of books about new technologies. And what he basically says is a new technology is a net creator of jobs. And you could see that all over the place, that every time we create a new technology, two things happen. The first thing that happens is everybody goes, oh, look at all these jobs we're going to lose because they're going to be automated away or something. And that's true, but it opens up the door for whole new industries, whole new businesses, whole new business models. Who knew when when Steve Jobs held up the first iPhone 1 in 2006, raise your hand if you said that's the end of the taxi cab business in 4 years because of Uber, or that's going to completely rechange the way that hotels work because of Airbnb. So I think what AI is going to do is it's going to take existing businesses, existing business models, existing jobs, and it's going to really squash their costs down. And there is going to be millions of jobs in whole industries that have yet to be created that are going to come on the other side of that. And so, yeah, it's going to be a big, big change, I think, for the services sector. And, what are those new jobs going to be? They're probably going to be more intellectual and content related because so many service sector jobs are about doing things. But now we don't have to do those. The computers can do them. Now it's going to be about thinking about things and about doing more stuff, in content and intellectual property.
Cameron, on May 20th, you wrote stocks celebrated slightly cooler than expected CPI data, suggesting that inflation, while still elevated and sticky, is not hot enough to push the Fed to hike rates further. Was there anything in the minutes, if you got a chance to look at them, that make you deviate from that a little bit, or no?
Yeah, it was the call of saying we didn't think that they would hike rates further over the next two meetings, right?
Sure.
And that that we know that the Fed is going to be data dependent. Nothing surprising about that statement. One of the things we've been thinking is that there is a much higher bar for further rate hikes than there is a bar for rate cuts. We still don't expect rate cuts. We don't think the data supports it, and for a whole host of reasons. The first one being is that the Fed has never initiated a rate cutting cycle in the midst of an expanding PMI. And I know PMIs dipped down in April, but if you look at things like South Korea exports, Japanese machine tool orders, all leading things for PMIs would suggest that there is still a recovery, an acceleration in some cyclical parts of the economy, which would then suggest that the Fed has zero historical precedence for going about us initiating a rate cutting cycle, given that backdrop with that data. Now, if the data changes, then that's where, we would say, look, like if we think that they'll react very quickly to a weakening in the labor market, whereas we don't think that they'll react as quickly to a reacceleration in inflation, which is not a bold statement to say because we've seen the reacceleration in inflation and they didn't react. They actually ignored it for 3 months straight before even acknowledging that it existed.
Yeah. So Jim, to that point, we do see PMIs kind of maybe not screaming higher, but rounding for sure. I mean, they're no longer decelerating as a whole, especially in the US. And you have Jerome Powell kind of leading the markets in the direction of expecting at least one cut. I think as of this morning, the CME Fed Watch tool had 2 cuts, or maybe one. 2 days ago, they had 2 cuts.
One and change.
What's that? One and change.
Like
Yeah, there you go.
34
One and change. I see nominal GDP somewhere around 5%, 5.5% nominal. And when I look at that and I see the Fed funds rate at 5.25, and they say rates are restrictive. Do you disagree with that statement? I don't think rates are restrictive.
Yeah. I mean, if you look at the data, and if I was to hand you some data, the current data, and take the name off of the economy and say, here's the data for the US economy. What do you think Fed policy should be? And I'll give you the funds rate. I don't think anybody would say, oh no, the Fed's got to start cutting rates. The only reason we're talking about this is because the Fed keeps talking about this. Mm-hmm. And that's the only reason that rate cuts are even being considered, because a data dependent Fed, which they say they are, shouldn't be looking at this data and talking about cutting rates. Now, we can debate whether or not they should be raising rates. That's a different question altogether. But I think the only reason that one and change and that 6 rate cuts back in January was ever on the table was because the Fed continues to talk about this. So yeah, when you look at nominal GDP, I share your thought that we're in the 5 range. I think that, there's a discussion that needs to be made at the Fed as to what is the neutral funds rate. And Powell came out at his last press conference and kind of reiterated the company line that 2.5% is what you would consider neutral. Neutral being what is the rate of the funds rate that neither stimulates or restrains the economy. It's the long run expected inflation rate of 2% plus 50 basis points, 2.5 or thereabouts. But it's more and more looking at some Fed officials have come out that said, no, you know what? The neutral funds rate is probably closer to 4 to 4.5, meaning that the Fed only has 2 or 3 rate cuts to get back to neutral, not 12. Rate cut being 25 basis points, not 12 like Powell is talking. So why does Powell keep, I think, talking about rate cuts, even though the data isn't warranted? Because he thinks that there are 12 rate hikes too many over neutral, because he thinks that 2.5 is the neutral rate. But if he starts thinking, no, wait, maybe the long run inflation rate is 3, and maybe it's not 50, R star, which is what we refer to as what should it be over the inflation rate? It's not 50 basis points. It's more like 100 or maybe a little bit more than 100 basis points. Then you get into that 4 handle for a neutral funds rate. And it makes sense too, because 5.25 to 5.5 is restrictive. But it's not that restrictive if you think that the neutral funds rate is around 4, which explains why the economy just keeps advancing despite all this, hand rubbing about high interest rates restraining the economy and restraining inflation. it's not because they're not that punishing that they like the Fed thinks they are.
Is it hold it, Cameron? I want you to, before you answer, I know you have something and I want to just weave this into it. Is it fair to talk about a good economy and not talk about a 1 trillion every 100-day elephant in the room that is the national debt? But then say what you're going to say and then address mine.
Well, look,
By the way, Nvidia's out. Nvidia's out. I hope everybody's long. Let's just put it that way. 10 for 1. 10 for 1 stock. 10 for 1 stock split, and
wow.
They beat on everything right now. So
is this where I say I was right or admit I was damn lucky?
You're in it. I'm out of it now.
Well, the question is, does it make it till morning? The move.
There you go.
Because I want to get back in, but not today.
So Cameron, what were you going to say?
Nvidia's up 5%.
Yeah, 5%.
It's up 5% right now.
Yeah. Okay. Well, I think, one of the questions is, I should calculate this is how much Treasury saved. Probably not a lot because coupon issuance compared to bills issuance has fallen, but how much they saved after the Powell pivot in the fourth quarter of last year when interest rates began to fall because Powell was talking about cutting interest rates. How much did Treasury save in that? Given the fact that they got a little bit of relief on interest rates, that seems to probably be a reason why Powell is doing what he's doing. If you're trying to come up with rationale for it, because to your point, Jim, they were actually, they've been eager and itching to cut rates and pivot multiple times. I think it was back in the summer of 22 when Bostic actually started talking about, hey, we could cut rates at the end of the year in the beginning of 23, started floating it. That's when you started seeing pressure within credit markets. Credit spreads really started to widen out that summer. So there have been multiple kind of attempts at this pivot. They seem inclined to keep wanting to do it. But what's interesting is that the entire time that their rate has been technically restrictive, so the Fed funds rate over the core CPI or core PCE, the entire time that's happened, the U.S. economy has grown above trend. It actually hasn't been a positive real rate based on that measure for more than a year. It only went positive, I think, in July of last year, and it's still not nearly as positive as it was back in the 2000s and in the 90s, where it was sustained at a much higher positive rate for much longer. So the fact that they've been talking about this for so long is just fascinating, because there's just no precedent for them to be as easy as they think they'd like to be, unless, to your point, Jim, that they're just way understating the neutral rate, which we think that they are.
Yeah, Deutsche Bank did a study on this late last year, and they refer to what we're in now as the 7th pivot attempt by the Fed since 2022. And I guess if they just keep doing it long enough, eventually they could get it right once and then proclaim that that's why they're the professionals, right?
Neither of you two have addressed, Jim, neither of you two have addressed the debt. Why in the world, what kind of Keynesian nightmare are we in where they're doing this spending as if we're in a depression, and then at the same time telling us the economy's great? How do you reconcile that?
But by referring to you as Comrade Uriel, and that the government is going to run everything. Two things about the debt and about the debt. The first thing is debt to GDP is, deficit to GDP is running at around 6%. So to put that in perspective for everybody to understand, let me back up a little bit. The U.S. government right now is spending about $6.25 to $6.5 trillion a year. That's about 23% of the economy. So a fifth of our economy is the government taking our money and spending it. About 73% of that 6% number that they're spending is covered by taxes. The other 27% they borrow, which is that deficit to GDP number of around 6%. And what's interesting about those numbers is when you talked about, Keynesian kind of a economy, we are, a pro-cyclical Keynesian thinking in the government. In other words, when the U.S. economy goes into recession, spend like crazy to try and stimulate it out of recession. But when it's growing, you're supposed to pull back, and then kind of save your powder for the next recession. Well, 22% of spending being in the U.S. economy and the deficit at 6%, we're spending more today in the fourth year of a recovery than we did in most recessions over the last 50 years. At the worst part of every recession, the government wasn't spending 22% of the economy. It wasn't running deficits of 6%. The two exceptions were the worst of the financial crisis of 2009 and obviously COVID, because that was a unique situation where we shut down the economy and mailed everybody money. But right now, the U.S. government is spending as if we are in the throes of a recession. And that's one of the reasons why I've often argued that whole soft landing, recession narrative, you can forget that. There will be no soft landing or recession if the government is spending at that level. They could single-handedly prevent a soft landing or a recession. Now, of course, there's a consequence to that, and that consequence is inflation. That's, this isn't a free lunch. Just let the government spend. Everybody gets a job. Everything goes up. You also have inflation being the other side of it. How does it end? Mike Wilson talked about this on his piece over the weekend. He's Morgan Stanley strategist. We referred to it as the Liz Truss moment. In 2022, Liz Truss was the Prime Minister of the UK. She's a Tory, a conservative, and she put out a budget. And the budget was, we're going to cut taxes, we're going to increase spending, we're going to blow out the deficit in the UK. Parliament, their Congress looked at it and said, well, we're cool with this. Let's do this. But their bond market, the UK gilt market, was not cool with it. It blew up. The Bank of England has 300 years of data on their interest rate market. The worst day and the worst week in those 300 years was in the fall of 2022, when the bond market imploded on itself, so much so that it created what was called the LDI, or liability-driven investing crisis, because the financial market couldn't handle that big a move in interest rates. So I know how this is going to end, that the bond market's going to put its foot down and it's going to say, you're done spending, and we're going to take rates to 5% or 6%. And politicians will say, well, it's too important that we keep spending for these reasons. Okay, we'll take them to 7%. And politicians will say, well, okay, we'll take them to 8%. Should I keep going? Because I will, until you freaking stop spending now.
Hold your cards.
Yes, I know how it's going to end, but let me say this. I don't know when. Is that later this year, or is that in 15 years, or somewhere in between? But what I'm trying to say is, there is no Jefferson and Hamilton we're about to elect anywhere in the horizon that's going to say, let's all agree to rein in this spending. If you want Biden, you're going to get $6 trillion of spending over there. If you want Trump, you're going to get $6 trillion worth of spending over here. You're going to get $6 trillion worth of spending. It's not going to go away until the bond market's ready to make it stop. And for right now, it doesn't look like the bond market's ready to make it stop.
Just a quick question to Cameron: Is that the recipe for a long-term steepener? I've had steepeners on and off this year and have made some money. I don't have anything on right now. Does this curve steepen out?
Well, look, maybe. The thing is, it depends on Fed's reaction as well, and the timing of how things react. I would imagine so. I mean, the question is, what if you get these dual things happening at the same time? Let's say it's August timeframe, right? We're going into Jackson Hole. The Fed starts talking about the neutral rate, and they're having a more serious discussion about the neutral rate being higher. In theory, that should raise some questions about how the long end of the curve is priced. At the same time, is that we've just gone through the conventions, and neither party's talking about austerity. Neither party's running on an austerity platform whatsoever, which just means you get that $6 trillion on both sides that Jim is talking about. We had a pretty big move in the bond market at the in the third quarter of 2023. Do we have another big move in the bond market where yields in the long end do pop higher? I wouldn't rule it out. What's interesting is that there's a lot of analysts, and there's been a lot of analysts calling for a top in yields. At the beginning of this year, when yields were closer to 4%, people said they're going lower, and they're going to keep going lower. People said yields have a 3 handle, or are going to target 3%. Our view at the beginning of the year was that yields were biased higher. Now you have a lot of people saying, well, the April high in yields was lower than the October high. Yields are in a topping pattern for the cycle, and they're not going to move higher. I'm still in the camp of not so fast. And that, yes, you can look to extend the duration in certain places, in building a portfolio, but if you're just making a call on yields, I wouldn't be surprised if that bias higher continues.
So we go through periods of time where we have to be experts on things for a short period of time. And what I'm talking about is, I like this comment, by the way, from Lewis. Taxpayer money is going from taxpayer to the big companies like NVIDIA. That's why the market keeps going higher and consumers hurting to pay bills. I asked them to put that up because I think that's what most people feel, whether it's technically correct
corporatism
or
world
not.
we live in. I mean,
Yeah,
all these companies
technically
get
correct or
shit
not.
tons of taxpayer dollars, whatever. Yeah.
Anyway, what I was talking about,
Stop
Cameron,
with the technical language, Jim.
what I was talking about is we become experts in things. So like in 2016, we had to be weather experts because there was a big hurricane season in the Gulf. Again, in
I'm from Florida.
2021.
I'm a weather expert always.
Well, you were born a weather expert, but yeah, weather and alligators. So
And
that
cheap
happened again.
beer.
And what?
And cheap beer.
Oh, cheap beer. I love cheap beer. Then it came to the point where we were expert in jolts. Like we all had to pay attention to jolts. In the oil patch, it was rig counts a few years back. Half the people had never heard of Baker Hughes rig counts, even though they'd been reporting them.
I thought of
for
getting a
about
Baker Hughes rig
71
count
years.
tattoo once, but
Now I think people are starting to tweak their knowledge of supply disruptions. And I'm wondering if this is to both of you, but Cameron first. Liberty Economics, which is a research arm of the New York Fed. And by the way, all of you guys watching, you can get the New York Fed's research. You can get any Fed's research just by signing up for it. They said this, May 2024 supply disruption, about a third of services firms and 48% of manufacturing firms reported at least some difficulty obtaining the supplies they needed over the past month in response to special questions focused on supply chain disruptions in the New York Fed's May business surveys. Then they compare it to the high stress point in 2021. But then down the bottom, it says 23% of service firms and 38% of manufacturing firms indicated they raised selling prices because of supply disruptions. Cameron and then Jim, do you guys worry about that rearing its head again? Or is these not numbers that matter?
I mean, look at the prices paid in the ISM. It was the only thing that came in hot. New orders was weak, employment was weak, but both services and manufacturing prices paid jumped a lot higher. The question is, was that because of the blip we saw in some of the supply disruptions? Not a blip, it's still ongoing, but you saw a spike in container shipping costs, for example, given what was going on in the Middle East. The question is, does that continue? I mean, the thing that's interesting in all of this is that transports broke down today, like really hard. Road and rail stocks look ugly. Freight prices still look ugly. And that's not to say that, that's the perfect litmus test, but typically in supply chain stress environments where people are grappling to get things, if the stuff is out there and there's stuff to move, but you just have to pay up for it, you would typically see it show up in freight pricing, and you haven't. So this is not 2020 or 2021. It has a very different flavor, but I wouldn't ignore those prices paid line in the PMIs.
Jim?
So let me just point out, Bobby, don't forget that we were all pandemic experts 4 years ago.
Hell yeah.
So we're whatever you need us to be an expert on, we could be an expert on.
Don't
but
bring
I
it to
completely
politics.
agree. Yeah, exactly.
The Middle East.
Right,
I don't,
right.
Max, can you put up Eric's comment? I sort of agree with what he said here, since there's a pretty heavy Chicago contingent here. Sorry, Cameron.
The correct answer is not Illuminati's, Eric. It's just not.
Well, I think he should have put what's the best deep dish pizza, and then that's arguable. But people from Chicago don't order deep dish pizza like every 2 days.
I was going to say I don't eat deep dish pizza, but then again, I'm also not 400 pounds either. So that's why you don't eat. That's why we don't eat it.
Yeah, Pat's pizza with the tavern style with the real crispy crust. That's one of my favorite pizzas.
So we have some of that style pizza here in New York. Ace's Pizza is amazing if you want a thicker crust and Emmy squared. But But I think it's
Let's get Dave Portnoy on the case.
Yeah.
By the way, before I ask, Jim was going to answer a question. Have you two ever met each other before? Have you two been on shows together?
Well, yeah,
They've
we
gone
spent some
fishing
time
together.
in a canoe.
You
went on a
went fishing
fishing
together,
trip.
so you're
Yeah,
genuinely
we
fun.
went fishing together. Yeah.
Why were we not invited on that trip?
Obviously,
You don't
why?
cut it,
I mean,
Jimmy.
it's
Sorry.
not hard to figure out why we weren't.
In the pouring rain, I was frozen. I think I got pneumonia from that trip.
I saw the pictures. It
but-
looked awful, except for the fact that you two were there.
Yeah, but we did our some pretty big damage on top of a perch hole. So
Yeah.
I
That was a lot of fun.
yeah, the butchers
Hell,
of
the
Maine.
perch hole.
Yeah.
Man, you are a Chicagoan. You got to get
that
out
means
and get a
something
fishing
different in
rod
my
one
old
of these
neighborhood
days.
than it probably meant on a fishing trip. Jim, you were going to answer that question, Bianca.
Yeah, I was
remember
going to agree with.
excited about it.
I was going to agree with what Cameron said, and I just throw out that if you look the IMF Port Watch the IMF has a new website called IMF Port Watch, and they track the daily movement of ships around the world through the 7,000 ports. And if you look at that data, what you're seeing is you're seeing a big drop off in the amount of goods being moved around the world because the Red Sea is closed and they have to go around Africa to go from Asia to Europe. And there's low water in the Panama Canal. What does that mean? A container ship is really a shuttle. It just basically goes back and forth between Asia and Europe or Asia in the West Coast of the United States 6 times a year. Just goes back and forth, all it does. And if it has to take a longer route, it now can only make 4.5 runs a year, not 6 runs a year. So how do you make up those other 1.5 runs? You take excess container shipping, and that's what we look at when we look at the spot rate for container prices. And that's what's been rising, is that excess is being demanded because these ships are taking longer routes. But in the process, we've got delays, we've got bottlenecks, we've got slow shipping. And as Cameron pointed out, it's starting to show up in prices paid, and it's starting to show up in some of the other indicators that would suggest that there is problems brewing in the supply chain. And that's what Liberty Economics was. I read the report yesterday myself as well, too, that Liberty Economics was highlighting. And a quick shout out, the Federal Reserve, I happen to think that a lot of their research is very good as far as when you read something like Liberty Economics, about what's going on with the supply chain, they'll give you excellent research about what is happening with the supply chain. Maybe their conclusion is a little bit politically oriented because of the Fed. They can only say things, but up until the conclusion, it's really useful stuff. So I would really recommend anybody to take a look at it to that point. And so, yeah, I think we are having a bit of a bottleneck with what's been happening in the Red Sea and stuff. No, it is not as big as it was in 2020, late 21, early 22, when the supply chains were reopening after the COVID shutdowns. But nevertheless, it is a problem. And it could show up later this year, especially in Europe, but more so in the United States. It could show up later this year as higher goods prices in an era where we're talking about the Fed trying to cut rates, and you can see goods prices going up. One last thing, well, that shouldn't affect the U.S., right? Because we've had, the Red Sea doesn't impact China to the West Coast of the United States. No, it doesn't. But a lot of those ships were trying to go China to the East Coast of the United States through the Panama Canal. They got low water levels in the Panama Canal, and they've been restricting the amount of shipping through the Panama Canal. So a lot of people have been going China, Europe, the United States, and now they got to go around Africa too. So we're getting hit by it, not as bad as Europe, but we're going to start feeling it as well too.
And I think just on that point we should appreciate just how much durable goods deflation and non-durable goods disinflation has contributed to the moderation in inflation. So as you start to see those things stall out because of some of these measures and other sticky things stay elevated, that's when you get to your 3.5%, 4% stickiness in the inflation, because you're losing big drivers of disinflation and outright deflation in the goods line.
So does any of this get solved? Just a quick follow-up. First of all, is there an actual effort to reshore things, or is it just too far down the line to worry about this particular cycle of inflation and possible supply disruptions?
Well, I'll go. Yeah, I mean, there is an effort to reshore, but you could say the words "let's reshore," but that doesn't mean it's going to happen. Intel's trying to build fab plants in Arizona and Ohio, and they probably are. We're going to make silicon chips here in the United States again in 8 or 10 years. And that's probably if everything goes well and the environmentalists don't get in their way, and stuff. But it isn't going to happen overnight. There was a great article last year about after they had all the problems when China was under zero COVID, and the Apple was looking to move more and more of the production of the iPhone out of China and into India. And the Wall Street Journal had this story that basically said, it is so complicated to understand these supply chains. We get stuff from suppliers who get stuff from suppliers who get stuff from suppliers, and we want to remove China from the mix, that even logistically at Apple, they really don't know how to do it. It's so complicated. Sure, they could move the final assembly of the phone to India, but that doesn't mean, and they are assembling more iPhones in India, but where are the parts coming from to put them together? They're still coming from China. And even if you remove one of those suppliers and use an Indian supplier, where's that Indian supplier getting his parts from? China. And so it's really difficult to reshore. Yes, it can be done. When I say difficult, it's time consuming. That's what I meant. It can be done. It probably will be done. But don't think that this is going to be something that's weeks or months or even a year or two. This is something that it will take a very, very long time to try and sort out with the reshoring.
The trade war started in 2018. It's now 2024.
Oh my God.
So if a trade war and a pandemic that shut down supply chains weren't enough to get you to be able to get over the humps of reshoring, then maybe it's just too hard to do, which means that some of these things are a bit intractable or just take a lot of time. And there are some companies who've been successful at moving as much of their supply chain as they can into localized places. But other companies, even defense companies, like US defense companies, rely on Chinese suppliers for certain parts of their manufacturing and production. It's incredibly intertwined.
So we had Vivek on our show, Ramaswamy, and I asked him this exact question. Like, if we are going to be cutting out China from this whole equation, we're talking about decades of a lower standard of living than we had grown accustomed to. It's just not that easy a thing. And he had and I like the guy a lot, but he had all these things we must, whatever. Is the question just, Jim, I guess I'll ask you, can we just make nice with China and go back the other direction if it proves to be insurmountable, or could we ever even do that?
I don't think we need to cut China out of the equation. I think what we need to do is make a credible threat that we would or that we are, and then they'll start playing nice. They'll start realizing that they don't have that monopoly control that they think they have anymore. That if they don't start playing nice and we're starting to reshore or moving more towards friendlier confines like India or Vietnam or something like that, then they'll start saying, look, we can't be doing the things that we currently do right now, like demanding any US company that does anything in China that they demand to see all the intellectual property that they're doing. They demand to see all the patents that they're using so that they could steal them. And we have acquiesced, many companies have acquiesced along the way. It's well known that in China, if you're talking about an iPhone or if you're talking about Motorola, there was this big story about this many years ago that Motorola was building some phones in China, and across the street literally was another factory that was building an exact ripoff of the Motorola phone to sell in China. They were basically just stealing the intellectual property of Motorola, and they were just basically ripping them off to sell a lower version in China. But Motorola tolerated it because they wanted those phones made at a cheaper level in order to sell to the rest of the world. China could get away with that. I don't know if in the future they can get away with that, but first they have to realize, you're in a competition with everybody else. Right now, they don't think they are. They think that they're kind of running the show. And so, no, we don't have to completely disengage ourselves from China. We just have to credibly disengage ourselves to get them to play by the same rules that everybody else plays by.
The same thing happened with Cat. Cat goes in, builds a huge business in the 2000s, sells all these excavators. Then all of a sudden in the 2010s, China starts undercutting them in price in domestically made excavators, and their China business, even though China was building new things, just goes poof. Same things happened with Starbucks, right? And you come in, even though that's not high technology, but still it's the same rinse and repeat strategy over and over. And I think it's a good question, Jim, if they can keep doing it.
My father used to refer to Starbucks as the rape of our culture. But my father thought every single thing was invented in Italy. So it doesn't even matter. He would call it all theft. Just real quick before we have to let you guys go. And I'll go Cameron, then Jim. In the context of this rally that we've been in, I said earlier in the show, I think we're in a reflationary environment, which means assets up, inflation up to me. That's what it means to me. What would you call what we're in? Is stagflation more of a risk? Is it reflation? What would you call what we're in?
I'll go first. I would probably call it an inflationary environment. As I said, I thought the deflation, disinflation era ended in 2020. And I think we are now in a new era of inflation. Another way to say that is the 40-year bull market in bonds ended in 2020. We are in a many-year bear market in bonds. That's not necessarily a bad thing for stocks or for anybody else because it's an era of yield again. We got a 5% yield. We'll probably have a decent rally in bonds somewhere along the lines. Maybe it's unfolding right now. But we're probably going to start to see us go higher. I think a lot of the things we've talked about, reshoring, the end of globalization, the challenges with the supply chain, all of these things are leading towards at least goods inflation going higher. I think that on the services side, let me talk about domestically in the U.S. I think that the labor market has had a tectonic change since COVID, and work from home or remote work, to be more specific, is probably the manifestation of that. What I think employees have finally learned is that they had more power than they ever thought they had. Oh, I can't really mouth off to my boss because I just been lucky that I have this job. Now they're realizing, remember, about 35% of the U.S. economy or U.S. workforce has a college degree, about 35%, 65% don't. So if you're in that 65% down and you're in a non-professional job, a lot of those jobs have become a lot more transactional. What I mean by transactional is I'll take a job, I'll work, I'll, save up some money. And then in the winter, I'll go hang out with Cameron in Florida because it's cold up here. And then in the spring, I'll come back and I'll find another job and I'll do some more stuff. But don't worry, it'll take me a week to find a new job. That attitude didn't exist 5 years ago. And I think that this is what is causing the stickiness in labor or stickiness in wages, stickiness in services, stickiness in goods. Again, as I said before, whenever you say inflation, people think it's a loaded term. Oh, no, it's not Zimbabwe. It's 3-4% inflation. Oh, what's the difference between that and 2%? It's the difference between 2 and 5% on interest rates is for a starter right there. And there's always the risk that it can go much higher as well. And lastly, Bobby, my name ends in a vol. I have an old Italian guy that was my father too. And they all think if you do a cup of coffee wrong, you've wrecked civilization.
I used to get smacked if I touched a piece of bread while there was still pasta in the plate because you can't eat two starches at the same time. I'd literally be sitting at the table, I'd reach for a pasta, my head would go like that because I just got smacked. No words, just a hit.
I just to add a couple of things of things that we're watching for, which is that I don't think that we've seen the full impact of the rate hikes that we've had thus far because of a long tail of QE, because of a suppression of the long end of the yield curve that in an unprecedented way with lots of liquidity allowed for the real tectonic shifts in balance sheets as well, in a way where we can look at measures like the percentage of usage of commercial paper balances being far lower than they were prior to the peak, and other cycles where corporate balance sheets on the large end are just immunized versus rate cuts and benefiting in some ways versus they did in prior cycles. End result being is that we still think we have a refinancing cycle that comes in 2025. The entirety of the current Treasury yield curve is above the investment grade average coupon or effective coupon today. The entirety of the yield curve, which just means that like you will have refinancing, you will have a repricing of balance sheets where interest rates or interest costs will eat more into profits. And I think that's the point when you start seeing a little bit more of what's been done with Fed policy start to bite. And to put a finer point on it, which is that even if the Fed cuts interest rates, the question is, do you really see a reaction in the long end of the yield curve if inflation stays hot, if the neutral rate is actually higher, if we continue to spend on fiscal policy, which means that you might be seeing the cash rate start to fall. So what you're earning on your cash start to fall because the Fed's cutting interest rate, but you're still refinancing at much higher rates, unless you get some big flight to safety that really pulls the long end of the yield curve down. And of course, that remains to be seen in an environment where is the risk of a Liz Truss moment actually present. So it's going to be a very interesting 18 months.
Nice. When I talk to you guys, my head spins because you guys throw so many different things at me, and I really like that. Normally at this part of the show, right before I goodbye them, I say, tell them where to find you, but you guys don't need to know where to find Cameron and Jim. If you don't know where to find them by now, you're a bunch of idiots. They're everywhere. We are so lucky that you guys are here with us, and thank you so much. We really appreciate it. And thank you guys for watching. Please stay around. There's more coming on what are we calling this event that Tradier is doing today?
We call it the thing.
We call it the thing that Tradier is doing, and then we're all here and we're having fun. But thank you guys very much. Good to see you, Jim. Good to see you, Cameron.
Thanks, guys.
Thank you.
Do we talk now, or there's Lex?
Wait. Last time I saw you guys, you were in my house drinking whiskey. What?
Yeah, and I left early. I heard you guys put another hour on, right?
We tacked another hour on the back.
Jim and I started telling old sob stories, and we hugged at the end. It was unbelievable.
Did you hug? Yeah, beautiful.
Can I say something real quick? So
Ollie,
because I stayed at your house an hour later, somebody almost got beat up at the airport. So I had a 6:30 flight, and I'm standing at my gate. I know it's 5 a.m. or something, and I'm just crabby because Lex's booze was still coursing through my body. And some guy keeps looking at me. The third time he looks, I just go, "What?" Turns out the guy was in high school with. And he just really,
oh my God.
Are you Bobby Ichino? I'm like, yeah, I'm the guy on TV. He goes, no. We played high school football together. I'm like, oh, Johnny Samise, how are you, buddy? But
awesome.
It was the whiskey problem, as usual.
I know. Jim did the Irish goodbye and then left Bobby and me to fend for ourselves.
Just to wrap it up.
Because I was having too much fun. That's when I know I got to leave.
And on a Monday night, why wouldn't you?
Good. Yeah.
Right. Yeah. Well, guys, that was awesome. That was really informative. I just want to ask one question. It came from someone along the way, and I think you covered it, but I just want to hear it again. What do you guys think the biggest risk to the market is right now? Is it? I know you talk about the deficit. I know there's a whole bunch of things. Is there one that stands out to be just the craziest ass thing that you can think of that's really a risk?
Here's what I think, and I think it's a risk to the currency, and it's a risk to our long end debt. On May 1st, the Federal Reserve came out and said they were going to do less QT than we had thought they were going to. They went from $35 billion a month to $25 billion a month. Mm-hmm. To me, that was kind of a tell at the poker table that they are concerned about the demand for our long end bonds. And guess what? They should be concerned. We were selling bonds to all these people around the globe, and then unceremoniously, we cut their value by 30% while they were holding our bonds as collateral. Some might interpret that as a bullshit move and be a little less willing to buy our debt. Many of them have to buy our debt. But I think if we get to a situation where they don't stop spending, or not stop spending, slow spending, even some level, and they keep issuing more and more bonds, they're going to get rates on the long end that they don't like. I think then the Fed will come in and start buying them again. And I think that could hurt the dollar. And that's why I'm positioned the way I am: copper, silver, Bitcoin, real estate, all that shit. Robert?
Yep.
Yeah. So this is the part where I tell you Jimmy's commentary there is 100% certain that it's going to happen.
Just when?
Here's the one that I'm not sure if it's going to happen. And I think it might happen shorter term. I think people are overestimating how much longer the consumer is going to deal with the prices they've been struggling with, just in a general way. Right. And here's one of my canaries in the coal mine: Walmart earnings. Walmart had bigger numbers from higher income people than they've ever had in their history. That means people in the middle class, upper middle class are eschewing Target. I don't know if I used that word correctly right there. They're going away from Target. They're going away from Macy's. Macy's didn't do bad. And they're moving down this sort of discount chain to Walmart. The next step is you start to see Dollar General and Dollar Tree have really good earnings. We're already seeing credit card delinquencies increase. And this may be something that the Fed is looking at with their rate cut talk. Now, the thing I want to caution people about was like, yeah, Fed's going to cut rates. They're going to save us. Be careful what you wish for, because aggressive rate cutting means the economy's weaker and stocks will not continue to rally if earnings start to suffer. Okay, you can't have it both ways. You can't have earnings just rallying through the roof and the Fed aggressively cutting rates. If the Fed starts aggressively cutting rates, you should worry, not celebrate.
Okay.
Can I ask a quick question, Lex, real quick? Did both you guys have a costume change since I last saw you?
You have like 20, Jim.
I've had 20 costume changes.
Okay, because I noticed before Molly had one sleeve and not one sleeve, which I thought was an interesting, and I was all on board with it.
That's
and
for
you
you
have like
guys.
an orange shirt
That's-
on. You look
we're
more like the
trying to
villain
impress
you
you
are
guys.
now.
I do look like the Joker, right? The little
You
villain
look like
I
a
am.
villain, which I like. I think I like it.
I like it. Very good.
We
All
both
right,
have
guys.
a villain vibe. Both Lex and Molly have villain vibes.
I know, right? I know. All right, well, we got to run, guys. That was awesome.
Yeah.
You guys are the best.
Favorite one of the
really
day.
interesting
Love you
stuff.
guys.
You can find these
Thank
two
you, Brad.
guys, Trader's Edge on your podcast, and then on the Hub, it's Trader's Edge on our podcast.
Right. And
Futures Edge on your podcast. So at the Hub, it's Trader's Edge, 4:00 Eastern on Wednesdays, right, guys?
Correct.
Yep. Either way, we got a damn edge. That's what we got. Is it?
We got a damn edge.
We're
That's for
edgy.
sure. All right, guys. Thanks so much. Good to see you. Awesome.
All right,
awesome
and wait
time.
until the next Goodfellas making pasta in the prisons, mafia moment. I went in on that one.
We should do that for
sounded
sure. I don't want to
fun.
go to prison, of course. We can reenact that for sure. I made
No
homemade
insider
pasta a
trading.
couple months ago. It's good. Yeah.
I don't want to go to prison again.
Guess what, girlfriend?
Ooh,
It's your time to shine.
it's the ladies.
Are you
So,
ready?
yeah, that was such a great topic. Little known fact that there is no reserve requirement at the moment. So I think our 20 costume changes was just to distract from
That's
that
right.
fact.
That's right. That was great. That last one. Those
It was
are
really
some
good.
big cats in the industry.
Yeah.
That was good. All right, Mala, it's going to be up to you to shut us down. This is
Yes.
the rise of the tech trader, a little panel with
Right.
your gal pals. I'm going to disappear and come back about 30 minutes from now.
Sounds good.
So are you ready for this?
Let's go. This is
All
gonna
right.
be fun.
Exit stage left for me.
All right, no boys allowed.
Bye.
Hey guys, we have a lot brewing for you. We have these powerhouse women here that they were actually market makers and floor pit traders. So the stories that we were talking about before we came on, I mean, it was like hours of just laughing. So we'll keep it clean. We'll keep it clean because the stories are insane. But we're going to take you from where we were, what trading looked like back in the day, all the way to artificial intelligence and quantum computation. And, we've had Kirk to touch on bots. Sandra Stone's going to show us a couple of automation tools. So it's going to be a fun-packed experience. So stay tuned. 5 o'clock somewhere. Grab your glass of wine. We're going to start to take it down. And I'm really excited to introduce you to these amazing people. Hey, you guys. Hello.
Hello.
All right. So we're going to get to you, Sandy West, but make sure you share your slides so the boys can set you up when you're ready. We have 3 amazing people. We're going to start off with you, Alicia Leslie. You are SIBO market maker, former SIBO market maker pretty tough. Right. And same with you, Sandy West. You are also on the floor, and Sandy's on the top right there. Sandra Stone is on the bottom right. She flew in Cessnas following the cartel. So really incredible woman. Yeah, it's the stories. We were having the best time before this. This is kind of like an afterthought. So we had a great time. But so Leisha, commodities future trader and executive chart analyst at Option Pit. Sandy West, you are BNP in the S&P 500. You saw the E-mini contracts start to sunset the open outcry, which is, hand signals and shouting on the floor. And now you've created a systematic trading platform in the Forex markets, which is huge. And then Sandra Stone, gunslinger, trading made simple. She's really about education and simplifying this complicated, intricate stuff so that we can all, lowers the barrier of entry and we can all take a bite out of it. So we're going to start off with some slides to take you back. I do have a phone call, excuse me. So yeah, Gordon, yeah, I will stories. We're going to talk about the floor. Just hold on. Gordon Greco. Oh my God. Okay, continue.
That's hilarious.
Sandy. So
Yes.
what kind of slides do you have? Can you take us through a visual tour of where we came from?
Oh yeah, I definitely can. Let me share my screen with you, and I will show you kind of where it all began, at least for me. Can you see that screen okay?
Perfect.
Okay, so really we're just, I think today we're talking about how technology has kind of, changed the trading landscape. And, we had open outcry, which was around for a long, long time since, the exchanges had started. This is a picture of the S&P Futures 500 pit in the mid 90s, where the people were making markets within the pit, trading their own money. And so this was where I started my career. Then what came down onto the trading floor was the E-mini S&P contract in 1997. This brave soul entered into the pit with these very aggressive men, and he was a brave soul because coming into that pit with that computer, knowing that computer was probably going to eliminate their jobs and their opportunity and their income and everything else, or at least make it more challenging. This is where basically the edge transferred from. So when I talk about the edge, you have, all traders are trying to get the edge, and the edge was in the pit. That was as close to the action as you could get. And then it basically transferred to the tablet, to the computer when the E-mini S&P contract came down onto the floor. Then after that, it kind of started advancing a little further, and it transferred into high frequency trading and algorithmic traders. So programmers were developing code, and I think now algorithms account for, I think, like 90% of the daily volume in the S&P 500 E-mini contract. So it's been a big deal, and it all pretty much kind of, I think, started when the internet came about in the mid-90s. So when that internet came in, that's when we really started seeing technology change, and at least in the trading world. So I have a person that I work with that is a quantitative analyst, and he's been doing this for 30 years, and we have developed systematic trading strategies in the futures, foreign exchange, and options market. This is an example here of vertical spreads being done in the SPY, which is an ETF. And so this tells you, it kind of makes it, we work with beginner traders to teach them options and what is a call, what is a put, and then putting on these positions either by being sent an alert or automating it where you can open up your account at Tradier and fund it and hook the automation through a third-party website that'll automatically execute the trades for you.
And we're going to do a quick shout out to Joe. Joe, if you're listening, we're This is amazing stuff. So thank you. And, just to give a real experience of what you two did, Max, why don't you throw up this video so people can actually experience this? Yeah, Robert Downey Jr. is not sure quite what's happening right there, but that's where you came from. And so, Leisha, so what was it like? And what was, we have tech now, so we have fintech and we have apps in our pockets. How did you chart back in the day? And tell us about the relationship between, the underlying stock and calls and put, and tell us that great story you were mentioning earlier.
Sure. Let me show you my pit. Now, my pit wasn't as large as Sandy's. I was over at the SIBO, and this gentleman right there is Lex's brother.
Hey.
So, yeah, my pit was probably about 20 guys, and this was only about half of them, but not any less intense though. We had our crazy days. Not every day. We definitely had boring days, but before this, as you can see, no one has a computer in their hand. We did not have handhelds in our hands. Before this, though, I clerked for a market maker, and it was about 1986, 87. And not everyone knew the relationship between the stock, the calls, and the puts. Because when options began trading over at the Board of Trade in like this little room, they started it in 1973, they only listed calls. So people would buy calls, stock goes up, and that's how they made money. Well, then they introduced puts, the people that really knew how options worked. And not all these people on badges, all these traders knew the relationship called the option synthetics of how calls and puts create stock, stock and puts create calls, and calls and stock create puts. They're all intertwined. And if you combine the three, you can have a risk-free trade on. And you can also price your options. So we would run our theoreticals upstairs on the computer, put them on cards so you can read the stocks here, the calls are here, the puts are there. Or you knew the difference between the interest and the dividend and what it should be. You could price your options without a computer if you knew just two things: the stock price, the dividend, the interest, right? And the strike price. Well, not everyone knew this relationship. The gentleman, the guy that I worked for, I wouldn't know if I'd call him a gentleman. Yeah, that's a whole nother story too. When he lost money, there were some tantrums being thrown around. Anyway, he knew the relationship and taught myself and another clerk, but other people did not. He would literally scoop dollars risk-free, knowing the option synthetics. Like he knew if he bought a call here where he could sell the put there and sell the stock, that he would lock in dollars, literally dollars. And now, when I left, we went to pennies and everything else. Our margins just did this.
Right.
So yeah, it was a crazy time, completely different time. Then I went into trading futures and into technical analysis, charting. I combine charts with pitchforks are my favorite charting. Here's an example of my pitchfork in the E-mini futures since October 23 and how well it's followed along. I'm bullish. I think we can trade up to the top of the pitchfork here before we decide to roll over. But also remember when these pitchforks were developed in the 20s, three gentlemen put them together in collaboration. And the one guy called the 29 crash, Babson. They were mathematicians. It's physics, it's math, all those things. And they were hand charted also. Now at least we can draw the pitchforks with the computer. I can't enter your order for you though, but I can tell you a good trade idea.
Right. And so
This originally started hand charting, but not any longer.
Okay, so this is incredible. So Sandra, take us to the next step. So now we're all the way into automation, and you speak about order flow and gamma data and how to gain that visibility that we otherwise back then would not have had. So what are some of the tools that you use, and why is that important?
So, hello everyone. So, I found it interesting as I was trading. I'm here in Southern California. We have to wake up really early, and I have to tell you that I learned automation for the sheer purpose of sleeping in the morning. And I know it sounds crazy, but it totally changed my life. And as I
Right.
teach others how to automate their trades, it changes your life. You don't have to be, glued to your screen manually. Um, as others have pointed out, you recognize certain levels that are triggered and you identify those levels. You can automate that. And, the first time that I was practicing this, I was still kind of practicing and kind of journaling and saying, I don't know if it's going to really work. So the first time I did a trade during automation, I did my homework the night before. I'll never forget, it was on Lululemon, and woke up to an $800 profit. And I was just floored. And I thought, that's it. Like, that completely has changed the way that I trade. I trade probably a good 90% of my trades are all automated. Even if I'm manually trading, I'll place the trade and immediately either have a stop loss or a conditional order that identifies my stop as well as my take profit. And I always say, if you don't program your take profit, trust me, your stop loss will get hit. So
That's so true.
After I started learning that, I started to share it with others, just kind of on social media, and then started training people on in free videos on YouTube and stuff. And I think it really has cultivated this, a new awareness for automation. Now we've, got into the era on the market maker side of automation, but for retail traders, there's only about 3% of retail traders, and we're really late to coming on board with automation. And so, just like Sandy was indicating, she was helping create some indicators. I think that's your first step. You're creating indicators to allow people that are beginners to start to identify how you can get into a trade and out of a trade. But to completely automate it is wonderful because you can see the level, you can enter it and exit it without even being there. And so we, as an example, I mean, that's my whole platform and community is about teaching automation. We're developing tools, of course, to automate with automating bots so that trades can, not only can you get into a trade and out of a trade one time, but the machine will do it over and over and over again, like 3-4 times in a day as that setup keeps happening. And so
Right.
as an individual trader, I can automate one trade as an example or another trade, but I can't tell my system each and every time on Thinkorswim as an example, that's the platform I use, each and every time this happens to automate it. And so I think this is where we're going. I think in 10 years, we're not even going to be looking at charts. We come from 12, 15 years ago when retail traders, we were just trend traders looking at charts. And then, we found option flow. And when option flow came, it was like, the heavens just opened up. It was like, we could see where all the institutional money was going. And this was just such a game changer for us to be able not to just look at a chart and look at candlesticks and try to analyze those patterns, but just to see the real money orders going into certain stocks that you could follow. And now, I mean, that was probably 15, 20 years ago, I should say. And now we have 10 years ago where we have gamma injects. Now, gamma injects is the market makers who are actually taking in the entire marketplace of orders in order to facilitate those trades. And their profit is basically that bid and ask price. They're not in this division is not in the market to bet for the market or Nvidia going up or down. It's literally just to facilitate this mechanism to create trades for everyone, to be the market maker and let the system run. So while it's doing this, though, we now can identify their hedges that they create in order to facilitate those trades because they're not making money except for the bid and the ask. So now we can actually see the market makers support and resistance levels. This really is gone from charting, with a hand chart with the graph paper, all the way to identifying where the market makers are actually identifying their support and resistance levels. I really do feel in the next 5-10 years, we won't even be looking at charts.
That's a good point. And, that's perfect. GameStop is in the news again. And, there was a feedback loop. So when market makers had to buy more shares to hedge your delta exposure, there's that acceleration that happens. And so, Leisha, what do you think about, and from a market making perspective, what Sandra said?
I think it sounds awesome and very cool that she has a machine that automatically,
yeah.
I mean, we're all automated. We can enter a trade and put our stop loss orders in and our profit order in. I mean, we can all do that, but for your machine to regenerate a new order without you inputting it, it's pretty cool. I think market makers do more than just the bid ask. I think they probably carry positions. I know we did. And I'm assuming they do, that they make a lot of money. So, but they do make a lot of money with that bid ask, even though it's been narrowed so much.
Yeah. It's incredible, some of the tools. So we have high frequency trading along with, and we have these bots, and it feels like this zero DTEs are coming online. And so with that, we also have these two behemoths coming towards us. So we have artificial intelligence and we have quantum computation coming forward. And so with fundamentals, you see artificial intelligence can really start to grab satellite data. Jim Bianco was just talking about the Red Sea closing and supply chain, happening, supply chain issues happening around the world. And, you couldn't quite grab that before we had the internet. And so artificial intelligence is coming in giant leverage for retail traders. And, there is this concept of first, second, and third contact. So first one be curation. It's a race. We see this with social, race for your attention. And then the next one is, to create real value so that and to connect, there's like an intimacy. But the third contact is no contact at all. So what happens when singularity happens? And, there's something huge. BlackRock has something called Aladdin, and they oversee 21.6 trillion in assets. And just to give you an idea, it's a little bit lower than the US GDP. So, but the question is, have you ever heard of Aladdin? And so so it's asset, liability, and debt and derivative investment networks. And Aladdin provides tools for risk analysis, trading, and compliance. But so how are you guys using artificial intelligence in some of your fundamentals, or do you just remain technical?
I still rely on my pitchforks and remain technical.
Okay.
At the moment.
Right.
Although now I met Sandra Stone, I would definitely be interested in what she's doing for sure.
Right. So that'll be interesting to see. So as far as the tools you use, so Sandy West, now you are not the lead drummer of the Runaways, just to be clear, correct? That's Sandy. Can you hear me, Sandy? Or maybe she's having a bad connection, but she might be. But
she's a drummer?
She what? No. So Sandy West was a drummer for the Runaways. So,
I did not know that.
Right. So
very cool.
So as far as automation goes, Sandra, someone can be overwhelmed and they don't know how to code and they get confused. So what's a baby step for someone just jumping in? Where do they go? How do they get to automation? How do they jump in? Because once you just do a little bit, you get the bug. And the great thing about automation is it removes this FOMO and it keeps that discipline. So give us a first step for someone who's never gotten into it.
Well, I'm really glad that you asked, because I'm just putting together a program that is strictly automation, even for a beginner trader. So even though you don't know technical patterns and price action and all the pieces to the puzzle, you can actually start to learn a little bit about automation on the platform of Schwab, Thinkorswim, and be able to follow along with me, basically. And within a couple hours, learn how to automate your trades. I provide an indicator that gives you the trigger levels, to either go long or go short. And really, this is just support and resistance. This isn't secret sauce. This is, the computers have support and resistance on 100 indicators. It's not hard to find, but really, I think a new person just gets so overwhelmed with all the information. I know that when I started to learn about trading, that I was really surprised, like, wow, every trader goes through this. I mean, it was just so much information. And automation was the last piece that I learned, and I learned it myself. So it took a really long time. So I really do believe that you can come in as a trader, a beginner trader, and utilize automation with these trigger levels and be able to automate on a Sunday night your weekly watch list, as an example, and be set for the whole week and not have to manually trade. If the triggers trigger and you got some momentum behind you, you're going to hit your targets. If it doesn't, it's going to fall flat. You have your stop loss in place. You got a defined risk trade, low risk. And then also you don't have any fear, any greed, because it's automatically done for you. And so I think that, is the first step, is just basically learning your platform. I think if you're fearful of your platform and you're making a lot of mistakes on your platform, which we all do, by the way, so it's okay. I think once you can master your platform with someone giving you some step-by-step directions and instructions that's easy to follow, I think once you learn how you can automate your trades, and you can simulate it where you're not even utilizing your own capital. So you could get on, as an example, I use and I teach Thinkorswim. So if you get onto this platform and you can simulate and you could document 30 trades on this program and witness to see if this is actually for you. When I did it, I simulated and I still couldn't believe it. And I didn't believe it until I took that first trade. And I even use automation as well for scalping. So it's amazing that you can utilize a template, getting in and getting out with however, either a percentage or a dollar amount that you're looking for. And you can automate your scalping as well with templates. So there's a lot of value through automation, whether you're a beginner or you're advanced.
Right. It's wild. You have to, Sandy West was telling us a story about how she had figured out, of where she didn't need to calculate. And I don't know if you can tell us that story quickly, if you remember that, but she had an edge on people because she kind of figured something out ahead of time. And I don't know if you kept that to yourself, but the interesting thing is, with all of these engines coming towards us, it's almost like, you can't not pick these new tools. You're almost being forced to make sure that you're aware and educated. So high frequency trading, there's a great book called Flash Boys, and it talks about latency arbitrage. And it sounds complicated, but there's great documentaries and, some other ones, like Gaming Wall Street on HBO. You can really have there's incredible resources. But, the neat thing about these two who have been on the floor is you really have to take this stress that's in your face. So a lot of times when you're in trading, or, how do you manage that stress and stay focused to your discipline and your rules of, that you've set in place for yourself? And I'd just be interested to see what you guys think in this day and age, to carry those tools that you've learned into this modern day that, we do have automation, but how do you handle the pressure?
First of all, I like to say that even if I had all my automated orders in and had everything all set, I still would have to go look at the chart.
Right.
I would still have to have some kind of control. I can't imagine myself just walking away from it. I don't know. I would have to, it would be something I'd have to get used to, but because I love the markets. I love watching it all day. I love, like you're in there. To me, if you're all automated, then it's not fun. It doesn't sound as fun.
I know. Take it all the way to the future. What if every single thing is automated?
I'm not as disappointed. I'm kind
of. Do you agree with me, Sandy? Is that what you're saying?
So her connection's a little buggy, but yeah, you know, I think another thing just to wind up.
Oh, I mean, I'm having a hard time. I have like a bad connection, so
don't worry about it. But yeah, so
yeah, I'm
our
sorry.
greatest-
I have a bad connection, so it's
worry.
going in and out. But I was answer your question in regards to like discipline. So we have the automation, right? And we manage the automation. We watch it trade while it's trading, and you know, for me, I can trade along with the automation. And unfortunately, I'm so bad. I break all the rules. I mean, I try to be disciplined. I sometimes I'm watching the automation or I'm watching my own trade. I catch myself holding my breath. You know, I start my day off at 4:30 in the morning and I go to the gym, and then I, you know, sit down in front of my computer at like a little right around when the market opens at 6:30 for me, because I'm on the West Coast. And you know, as much as I love to push that button, I really do. You know, it's just better to let the automation do it, because like I'll break all the rules, and then if I get pissed off, I'll blow I just want to blow the account up, because I get very emotional. So it's really better not to give me the button. And so I just more manage the automation and just be like, just do as I say, not as I do.
Great. So Luis from Sigma Opcion, he was on earlier and he brought up a good point, which is, you know, to stick with your discipline is to stay healthy, because the old technology is this thing, and this thing, you know, is hundreds of thousands of years old. So how do we upgrade this thing? And then if you look at the fusion of chromosome number 2, that gets really interesting. There's cognitive synaptic plasticity, and it's incredible. And so we know you golf, Sandy West, and we, you know, staying healthy. I'm a health nut. But neurotropics, to take a good look at that. So we have NAD, L-theanine, lion's mane, omega-3, but to not reinvent the wheel. So just like if you're getting into trading, to find someone great and model what they do. Just model what they do, mimic their trades until you start to get your feet under your and absolutely virtually trade and learn there. Lex gives the advice is to don't stay virtual too long, because you learn better when there's skin in the game. But health wise, I like Ben Greenfield. Anthony William is Brain Saver, great book. What do you guys do physically to keep your brain tip top?
I also work out in the morning. I just did a few weeks of that. Well, they don't call it Bikram anymore because of the gentleman that, well, he wasn't a gentleman. Again, I'm using gentleman where it's not applied. It doesn't apply. Anyway, the guy that created the hot yoga. I did a few weeks of that. I prefer the weightlifting though. I'm more of a weightlifter in the morning at the gym. My husband, all those supplements you just listed, my husband's got you beat by like,
oh good,
oh my goodness, he knows every supplement under the sun. Here, take this. I'm like, okay.
Brilliant. What about you, Sandra?
You know, I really think you know, you can,
sorry
about that. Is that for Sandy?
No, for Sandra, and then Sandy, go ahead.
Okay. So I was you know, I love to play golf and you know, love to work out and stuff. I think when you're running a business, you know, you get kind of preoccupied with everything that you have to do. However, I think for my, you know, the brain exercises that I like to do is I think it's really hard for people to identify, especially traders, that even though you have the ability to trade every day, that doesn't mean you should. And so, you know, when you wake up and you're, you know, I know it while, you know, I'm talking to my community, you know, my words are not as eloquent as normal, or, you know, I'm messing up on something, or, you know, I'm not quick to my platform, click, click, click. I recognize, you know, even professional athletes cannot be perfect every single day. And if you're not being, you know, perfect, if you know that you're not in pristine condition, why should you trade your own capital? So this is like really important to identify when you need a mental or physical day to just decompress and stay away from it, so that you could come back and get back at it and you're sharp. And so when we do this every day, it's just so important to be able to identify your own strengths and weaknesses, and recognize, oh, this might be a day where maybe I just watch or I simulate, even though you're a professional trader, just to take a break.
So
Sure.
brilliant. What about you, drummer Sandy West from the Runaways?
I agree. There's, it's really important to know when to place the trade, and it's, equally as important to know when not to trade. Probably even more important to know when not to trade. When, you might have a day where, like she was saying, Sandra was saying that you don't feel well and you're not, maybe you didn't sleep well, or you're aggravated, or something's throwing you off. And there's times when I know it's just better I don't step near that computer, today. I try to, like I work out in the morning. I'm huge into fasting, which kind of just comes along naturally because I'm always doing so many things out throughout the day that I don't even eat. And then by the time I eat, I basically eat to stay alive.
Right.
Cheese and crackers are my thing. I'm like, that's all I eat is like cheese and crackers and whatever's fast. But I'm a huge juicer, so I do get my vitamins in. I mean, protein. So I love cachava. I don't know if you guys have heard of this protein powder, but it's amazing. I use that and I put it in with like bananas and hemp seeds and chia seeds and flax seeds, and even though it comes with all that stuff, and there's a lot of good nutrients in there in regards to like mushrooms that I think you were referring to, with the lion's mane and the nootropics, and then also probiotics and just a whole bunch of good stuff.
Yeah, so
that
find
mud water, I have that one too. So
yeah, find a great nutritionist here in Hollywood. We go with Ben Greenfield and Anthony Williams, so they're everywhere. I do Tracy Anderson, love her. So find your shtick, and just we'll finish up with the greatest supplement of all time, which is sleep. So make sure you get it, and that's a big deal. So amazing stories. We're gonna have another show where we reenact the 2 hours where we were hanging out and just
that was something I struggle with.
Stories, so good. So thank you guys. Yeah, it was a great time. Check out we put those in the tags line. We'll be able to watch this again. And I really appreciate you guys coming on. It was really fun just building up to this as well. Great to meet you all. And thanks.
It was fantastic.
Thanks for having us on.
Ladies.
Yeah. Thanks,
Thank
guys.
you for having us. It was fun. Thank you so much.
Holy camole.
Hey!
We got there. We did it. Unbelievable.
We just did a women's panel, but I would like to raise a glass to all the men who really trailblazed trading. So cheers to you guys.
Very well done, Molly. I
with.
loved it. What a great day. Dan started off the day. Dan's ending the day. So a couple brief comments from Dan here, and then we'll thank some folks and get you on with your day. But really a great day. Go ahead, Dan. Sorry.
Molly, great job, Molly. Really enjoyed the show. The most inspiring part of that show was one of the panelists said that, they eat only to live.
Right.
I wish I could make that same statement.
Right. Yeah. Come to my house. I don't cook. You'll be fine. You'll just starve.
That's probably one way to go, is just stay away from food. But anyway, thanks everyone. Thank you so much. It's been a great day. What a wonderful event, right? And I was just talking to Jason and our production, the gentleman who helps us production, and we had 2,200 traders on the show today. It was amazing. Can you believe that?
Really. And thank you to all of them for coming to join us. It's a great compliment. So thanks.
Yeah, I know. I was just reflecting on it, right? When every time the challenge, at least mentally, I have with these shows is we're going to ask traders to give us a part or a day of their trading life.
Right.
And we have to deliver on that. And I think I always want to make sure we take their day extremely seriously. And I'm so glad that so many people trust us with their day. And, I hope Max, Molly, Lex, and all the other hosts have have given you the content that you look for. It's been an amazing day. 2200. I mean, it is
Dan is
really.
speechless. He's speechless. Look at
I know.
Dan
I
is
mean,
speechless.
I remember when we started this about a year ago, and we were just, incrementally going ahead and trying to get better. But one thing we always knew, right? If we bring good speakers, knowledgeable speakers who get up each morning and want to do right thing by the customers, eventually that community is going to get created.
Mm-hmm.
And we call that community the hub. And today we are so glad that, we chose the right topic, and so thankful for all the guests and all the people on the production side, marketing side, the people at Tradier and outside who have made this event happen. Every time we do these shows, we try to think, what's the right topic, right? What is the right topic? And, choosing volatility as a topic was timely. I think that was appealing to our traders. So I'm glad we went with that. But I think there's some huge emerging themes that actually came out, right? Automation of a trade has played a huge role in many part of the conversation. Adoption of technology is something that we have seen people talk about tremendously, both of which we see it on the ground every day. And last and most importantly is I think I see so many great educators talk about having a consistent plan, thinking long term, and staying on top of what your strategy is all the time. And I think that all these criteria combined with the fact that they themselves are good market leaders create so much amount of credibility. And I'm so thankful to everyone for coming to this event. We as a part of the hub community try to basically deliver the best platforms, right? The best content, trying to, the folks in Charlotte are trying to provide great service, and together we package it up in a way we are providing great value. I think we continue to provide what we think is probably the best value in the market. And I'm so glad that all of this is coming together through a content engagement and community that we call the hub. Once again, thank you so much. I really appreciate all the effort that everyone has taken. It's been a great event. You folks inspire us every day to do better. We'll try to top this off again. Thank you so much. And Lex, I mean, you've been a gracious host. Nobody's I guess you're a YouTube star these days.
Lex. It's Lex.
Lex, I mean, he's a YouTube star. I mean,
just drop the mic. Drop the mic.
So, Lex, great job at anchoring this together. You certainly pull this community together. Anyway, thanks everyone. Thanks for coming to the show. We'll try to top it off again next time.
Yes, sir. Well, thanks, Dan. That was great. Molly, thanks for your help this time. That was awesome. You did a great job. A couple more thank yous here. I'd like to thank SIBO as well for their sponsorship. They are always a great partner. I know this has been said, but the Tradier marketing and design team, thanks to you guys. Tradier production team, unbelievable long day. Molly, thanks to you and to all the great guests and panelists. It was just a blast to do this.
Bravo.
Really
Bravo, everyone.
Hope I didn't miss anyone, but we'll see you next time, and we'll have some words out on when that's happening. So stay tuned.
Right, I'm busy. I have to go now.
All right, everybody.
The world is evolving, and you are different. Choice, it has always been ours. You can chase the trend or choose to trade with purpose. It's time to find the signal through the noise. We'll meet you at the beginning.